Well, good morning, everybody, and welcome to Rise. My name is Patrick Kirby, and I'm from KPMG here in China, and it's my great pleasure to be welcoming you all to the Money Conference. I'll be here until 1 o'clock, and we have some tremendous guests. Well, one of the questions I often get is, what is a company like KPMG doing here? And the answer is very simple. We're committed to the success of the economy of Hong Kong and China. We're committed to the innovation and focus, and we want to make sure that we're able to translate not just from technology to business imperatives. So that's why I've got the great pleasure to be here this morning. And as we go through, we'll be joined by a host of different thought leaders and innovators, disruptors and others over the next couple of hours to be looking at emerging trends in fintech. So stay with us between now and 1 o'clock. With talks, we have WeChat here, we have Dian Rong, Ping An, Zest Finance and others. But to start things off this morning, and without much pressure, we have the CIO of Standard Chartered, Dr. Michael Goritz. Michael is one of the leading authorities of digital transformation within the banking industry, and he'll be sharing his insights on where that digital transformation is going here in Hong Kong and more broadly. So please, can I ask you to please welcome Michael Goritz to the stage in conversation with Wang Feng from the Financial Times.
Thank you. Thanks a lot. Thanks a lot, Dr. Goritz. Nice to see you again after our meeting in Dalian. Since we only have 15 minutes, let's get right to it. We were just told we're supposed to set a tone for this money conference in the next 3 days. So, as they said, no pressure at all. You are the Chief Information Officer and Head of Operations at Standard Chartered. Could you tell us a little bit about what's happening in the traditional banking world these days, and what a CIO with a lot of tech and industrial background like yourself is doing there right now?
Absolutely, sure. So let's look into banking, and if you look at the banking space, you should remember the number 5, why 5? Because 500 years the banks were invented. At least the longest standing bank there is about 500 years old. 50 years ago we introduced the computers, mainly in the back end. So we took all the ledgers, all the books we had, and put it into mainframe and other kind of computers. The third 5 is actually 5 years ago. More or less 5 years ago, the mobile banking came into play because with the distribution of mobile phones, and now virtually everybody in the world has a mobile phone. So at that point in time, banking really changed dramatically, because what was designed from the inside out so far now has to be seen from the other way, in order to be designed from the outside in. So with this little smartphone in your hand, the interface to banks have changed dramatically. So in the past, the banks were a place when you wanted to bank somewhere, you had to go somewhere in a place, in a retail branch or something like this. Now, if you want to bank, you have something in your hand, you do it. So if you look at this concept, it's quite powerful, because in the past, the trust in a bank was built on the personal relationship to your relationship manager, to the people in the bank you knew. But now, the trust has evolved in this mobile era into a series of fulfilled expectations. You have the expectation that my services I'm asking for the bank, they are done within 5 seconds. And actually, if I can fulfill these expectations, then obviously I have a trust in the brand, I have a trust in the bank. So banks have to learn, it's about these trust in the customer has to transform from a person into the fulfillment of their expectations. Right. So as a CIO, the title says, Chief Information Officer, I'm the master, actually with a lot of help from my people obviously, of quite a number of computers. And on top of it, I'm also head of operations. So if some human intervention is needed, they report it to me. So positively spoken, all the things which magically happen in a bank go through my shop. More on a lighter note, if something breaks, you can call me, because I'm probably the cause for the evil.
Right. You were talking about expectations. From a customer expectation point of view, the expectation these days is actually quite uneven depending on which market you're talking about. So coming from China myself, I would expect I never have to carry cash or credit card anywhere these days. In Beijing, with this phone, I can do anything. I go around, travel around the city, do all kinds of meetings and shopping. I don't need anything else. But in markets like the markets you are more familiar with, Hong Kong and Singapore and elsewhere, the expectation is probably not quite there yet. So how do you manage this gap of customer expectations between different markets, all these markets you're in?
This is absolutely a true observation. China has really leapfrogged the development, and now you can do virtually anything cashless. But the picture is actually a little bit broader than you just painted. Yesterday in Singapore, we introduced Pay Now, which is the answer of WeChat Pay, because Pay Now is a network that you can do peer-to-peer and peer-to-merchant pay only by the use of your mobile number or your national identity. So this is exactly the same concept and trends into the payless society, the cashless society. And beside that, there are more and more trends in other countries where, for example, with the help of digital identities, you make banking more convenient. India has paved the way with Aadhaar, a digital identity, where the government has built a registry for your data. And actually now, with an Aadhaar, you can open a bank account. The data is transferred into the bank's premises, and all the data, or virtually all the data, is there. Same thing happened in Singapore with MyInfo, where Standard Chartered participated in the first batch of banks to do this.
Right. So in the setting of a tech conference like these, people usually talk about disrupting traditional industries. And especially when it comes to fintech, often people talk about disrupting traditional established banks. So in this kind of context, you guys often come up as the victim, as the story of yesterday. But what are you doing right now to actually keep yourself in the picture and also to keep being competitive?
Well, as I mentioned in the beginning, the change within the banking has never been that fast or that speedy as it is today. So our concept is that we change the way we introduce new solutions and go more into an exploratory phase. So we have a lot of sandboxes, or actually what we did, we founded a little lab. We call it Accelerator for excellence and acceleration. Right. And we invite outside companies to help us integrate their solutions into our banking environment. So we do a couple of competitions. In these competitions, we invite people to show their solutions, and then we pick some of them and take them inside our premises. For example, here in Hong Kong, we did the supercharger. So we were one of the founding members here. The second batch has just been running a couple of months ago, and two of these companies are now invited to do a test, proof of concept, in our bank, and let's see whether this is successful. So it's merely, on the one hand side, there is this technology which you need to enhance your user experience and to improve the service. But moreover, it's the way how you act, how you do these solutions, design these solutions. And that definitely has changed in the banking environment. While in the past there was a lot of waterfall development, so people were specifying something, then a couple of months or even a year later, this was then set into production. We all embraced agile development, and this is the new norm in banks. So that's the same development methodology which in all fintech companies are used. So when you combine the strengths of smaller companies who are very nimble and talented with the experience of the bank, who have actually the customer base and also the international network to deploy these solutions, then you come to greater customer service.
Right. Obviously, these experimental steps seem to be quite dramatic for a traditional bank. But when you talk about today's fintech giants, you can never avoid mentioning the names of WeChat and Alibaba and Paytm, all these big players in various markets. These guys are relatively new, yet in terms of size, they're huge. In terms of market capitalization, they're often bigger than banks. And these guys are usually seen as nimbler and more daring to take on risks. So in such an environment, how do you compete with them?
Well, there is still a lot of space for banks in the environment of the big tech giants, the retail customers, and the merchants. When you look at the strengths of each of the entities, so the tech giants, they have a user interface, undoubtedly. WeChat, we talk about 800 users, so therefore everybody in China, in mainland China, has a WeChat account. But obviously, how do you connect these capabilities? How do you connect these customers to merchants, to companies? So here the bank is playing a role. For example, we have been teaming up with Tencent to establish an e-commerce solution which enables small and mid-sized enterprises to get money or deal with the Tencent webpage, and then obviously get the money in their account. Or here in Hong Kong, we have linked our retail account to the Alipay Hong Kong solution wallet. So what we are doing, we are combining the strengths of both parties into, a good outcome for the end users.
Right. Just now in the backstage, we also talked about these recent partnerships seem to be pioneered by the Chinese government between Chinese tech giants and major Chinese state-owned banks. There have been 4 or 5 such marriages, which seem to be hastily put together within a very short period of time. What's your take on what's happening between the banks and the tech giants?
Well, it's interesting to observe that space. While the tech giants were grabbing a lot of land in the past years, so this announcement came a little bit surprisingly to many of us, that they are kind of, I wouldn't say forced, but they're forged into a relationship, the tech giants and the big state-owned bank. So my assumption is that, the government wants to combine the strengths. I mean, banks traditionally have a lot of knowledge about risk management, about regulation, about dealing with customer on a more individual basis, while the tech giants have the technical capability and the interface to the end user. So if you pull this together, and I think this was a plot behind the idea of forging these alliances between the state-owned banks and the large tech companies in China. So if you go along that line, I think this makes a better offering for the end users as such.
Right. Later on today, on the same stage, we're also having a conversation with a senior executive from Tencent Pay. As you just mentioned, as Chinese tech giants like Tencent and Alibaba try to break out into the international markets, they're having a lot of difficulty. And this is where major international banks like yourselves could come in some kind of advantage. Yet, to many people, to many observers, the tech giants are not really sincerely looking at partnerships. They're only working with you guys for now to help them overcome some obstacles they're having. But in the end, they want to take everything. They want to take your lunch and your dinner. What's your observation on that?
Well, it's hard to predict the future. The fact that I'm working for Standard Chartered is that I'm still confident that there will be a place for a bank. So our concept of banking in the future is a digital bank with a human touch. So undoubtedly, everything what the user wants to do in the regular basis on a day-to-day thing, this has to be done digitally. I mean, there's no choice in that one. But when you look at the 4 basic banking services customers are looking for, it's storing money, it's transferring money, lending money, and it's creating your wealth. So in your lifetime, there will be some moments where you really want to talk to a person because you are insecure, and all the chatbots and all the websites and all this kind of stuff doesn't give you the right answer, or you just want to have a warm feeling to talk to somebody, and then the banks are there. So if you manage to bring all the knowledge, all the wisdom of the banks to that moment of truth, then there will be banks around in the next 500 years. I'm sure about that one.
That ultimate face-to-face interaction, the presence of a wise-looking banker dressed in a 3-piece, is that your final advantage?
I think so. So when you think about a merchant or even large company who wants to go to Asia. I was just talking to European companies who want to conquer the Asian markets. I mean, honestly, based in Europe or based in the US, they are overwhelmed by the variety and by the complexity of Asia in its totality. So therefore, they talk to us because they want to have us to help them organize their collections. They want to help them organize their cash in the different countries with all the capital restrictions, all the things around. So at the end, it's really good to put a face to these services, to put a face to the whole offering we are giving. And then last but not least, it's good to have somebody to talk to if things go right or sometimes things go wrong.
Right. As you mentioned, it's very hard to predict the future. But could you give us your best effort at envisioning the financial world in 5 years' time? Where will the major banks be? Where will today's tech giants be in terms of relative size and strength?
When you look about the banking space, you can observe that most parts of the bank are fully overbanked. I mean, we have more than, I think the latest count was about 16,000 banks, and many of them are in the western part. So what I see, obviously, is a major consolidation of banks all over the places, which has been taking place over the last couple of years. On top of it, I will see that these banks will survive who follow that concept of the full digitalization, but then with a true human environment and human touch. So therefore, I think the tech giants will recognize that only offering digital services which go beyond just basic transactional stuff is hard.
Right.
You know? And banks actually will recognize if they don't fully embark on the digital train, they are lost. So somewhere in the middle, I think we will meet, and I foresee more ventures, more collaboration between these two entities than competition.
Great. Looks like we're out of time. Thank you very much for sharing your thoughts with us.
Thank you so much.
Thanks.
Thank you. Thanks. So coming up on stage now, next, we've had a bit of an exploration around from the China perspective with Standard Chartered. Now let's go through and have a look at what the Indian financial services space is looking at. And fintech has grown at a really tremendously rapid rate, and we're seeing that in deal spend and so forth in the region, aided by a rising digitally savvy middle class. But what should we expect out of fintech 2.0 from an Indian perspective? So to help explore this topic, we'll be having a conversation with two Indian fintech founders, the founders of Policy Bazaar and IndieFi, and they'll be having a conversation with Una Galani from Reuters. Please welcome them to the stage.
Thanks, Patrick. Thanks, Patrick.
Hi, thank you. Hi everyone, thanks for joining us. So as many of you know, India is a laggard in Asia when it comes to many things, economic development, social indicators. I recently moved there 3 months ago myself, so I'm seeing a lot of this firsthand. But one of the things that's really striking is that India is actually a pioneer in the world of fintech, and there has been an extraordinary policy effort in recent years to roll out some extraordinary infrastructure that you really just don't have anywhere else in the world. And the potential to grow in this industry there is attracting some of the biggest names in technology from Asia and in the US, both as investors and as participants in the market. So I'm really lucky today to be joined by Alok from IndieFi and Alok from Policy Bazaar. I have two Aloks. Not everyone in India is called Alok. But these guys are old friends, so this should be fun. I'm just going to let both of them start by telling us a little bit about, very briefly, about what their businesses do to set the context.
Thanks, Una. I'm Alok Mittal. I run IndieFi Technologies. We are a platform for small business loans, so we act as a marketplace between institutional lenders, banks and non-banking lenders. and small business borrowers. And really the approach we are trying to take is to treat different segments of small businesses differently in terms of product design, in terms of credit design, and so on. So we believe that small businesses are inherently heterogeneous, and we are building a platform that addresses their credit needs in that context.
Hi, I'm Alok Bansal. We run a marketplace model for insurance transactions. So anyone who wants, any retail customer who wants to buy any insurance product, whether it's life insurance, health insurance, for that matter, motor or travel, they can come to the platform, go to a transaction and buy the policy by comparing and doing everything on the platform itself. We've been doing this for little over 9 years, and now we are starting to participate in a little bit of product creation and controlling the process at our end, which till date the insurance companies were doing at their end.
Okay, so thanks, guys. I must start by asking about this fintech infrastructure that's in India. How does it really stand out from what we have anywhere else in the world? I mean, I wonder if you could just take a moment to explain what we have there.
So one of the important things, although India is such a large and diverse country, but we have single regulator, and everything in fintech is regulated. So if you look at countries like US or for that matter even China, a lot of times you have to go province by province or state by state. But in India, you can get a pan-India license if you go to the regulator just once. Having said that, the regulation itself is evolving very fast, and whether it's the introduction of UPI-based payments or whether it's the way the business models like ours have evolved, regulator has played a large and mostly supportive part.
I mean, so what you just mentioned, UPI and Aadhaar and all these things, I mean, these are government-sponsored pieces of real estate. I mean...
So you know, what's happening in India is that there is massive infrastructure development by the government, right? And it's not just a capital issue of who invests the money in that infrastructure, but it's an adoption argument. So over the last 4 years, 1 billion people in India have been converted from having no identity at all to all having a uniform identity that's real-time queried at literally, a cent a query.
So this is basically like everyone in India has a fingerprint
unique identity,
and an iris scan in a system on a 1 billion people on a unique identity database.
Now what they're doing is they're layering other infrastructure which relates to financial services on top of that, right? So there is electronic signing infrastructure that is now layered on top of that. There is the payment infrastructure which is, surprisingly works across all banks in real time for remittances that might be sub $1. So it's a very efficient, frugal infrastructure that exists for that. There is a data interchange infrastructure called consent architecture that is coming up. So for a company like ours, we don't have to worry anymore about putting the plumbing in place. All of that is coming into place at a very rapid pace, and it's enabling a lot of innovation on top of it, because entrepreneurs can now focus on solving the market's problem rather than solving for the infrastructure.
I mean, that sounds to be quite different from what we've seen in other markets, because in India, the government itself has built or has taken the lead in building a lot of this infrastructure and has made it open for everyone.
It is open. And because of the fact that there is a single regulator, basically all financial institutions have been told you got to comply tomorrow. Right. So the adoption has really accelerated because of that. So today all banks in India would be enabled on UPI. 95% plus citizens are covered under the unique identity scheme. And that's going to reach 100% very soon. So we don't have to worry anymore about knowing the customer, about execution of documents, about remittances being made. Right? At one end, you could argue that those things have moved from potentially private domain innovation to public infrastructure, but it's just enabling so much more innovation on top of it. It's mind-boggling.
Just to bring that to life, I mean, it means that if I go out to buy vegetables, just from like a street side stall, a guy with a cart, I can go up to him with my mobile phone, and I can pick whatever I want off the cart, and I can pay him. I can just put my email address in, zap it to him, and he's got his money straight away. And I don't, and it doesn't matter if we both have different banks. It's kind of extraordinary.
No, some of the other things, I think, government has created a lot of these services, but they are not making it compulsory. So government took a step to create something called RuPay, which is a competitor to Visa and MasterCard. It's got about 30-35% market share, but it's competing with the both of these platforms. So there's no mandate that you have to use this only. So government, in fact, is trying to be as efficient as the private sector. Similarly, on the UPI platform, they've created an app which is can be used by any platform that want to use it, but again, not mandatory. So that's the good part about it. It's so you're not bearing with the inefficiencies that a government system can bring, and hopefully they'll continue to challenge the private players.
Yeah, I mean, one of the things that, how is that helping your businesses? Maybe you could tell us a little bit about what that's helping your business do now and where it can take you.
Yeah. So we are in the small business lending domain, right? And we normally go to borrowers who have traditionally not been served well in terms of their credit needs from the market. Now, most of these people would not have a formal banking history. 2 years back, they would not have a formal identity. So there was a lot of on-ground work required in going and identifying the customer, in ensuring it wasn't a fraud, in even getting money to them, right? Now, all of that has gotten streamlined. So today we support instant loan process, right? And the trick about instant is not instant decisioning. That's the easier part about instant, right? The trick about instant is all the process that sits in front of it and sits behind it. And we work with the largest banks in the country, right? So they, from a compliance standpoint, are very, very rigid about what they'll accept or not. But today we can get a customer on board, right? Do an electronic KYC in real time. We can pull data from partners with consent from the customer in real time. We can decision in real time, and then we can get documents signed and make the disbursement in real time. So literally within seconds, right, the whole process is done with full compliance as per the banking norms, which would have been impossible a couple of years back, right? It would take at least a week to get a loan done if you were talking about a tier 3 location because of all the papers flying around.
Yeah. And for you, I mean, how has this helped? I mean, it's been around your business. Your business is a bit more established. It's been around for a bit longer. I mean, how has the sort of like fintech enthusiasm helped policy?
I think the biggest benefit to us is ability for customers to pay online. So we don't take any cash or check any other source. So everyone who's coming to the platform has to pay by credit card, debit card, or net banking. And since the usage of these have gone up because of a lot of initiatives the government have taken, that obviously has helped us. In terms of process also, sometimes whether you are establishing the KYC, whether you are looking at what sort of documents were asked earlier compared to what we are trying to implement today, that has helped. But in our case, specifically to look at the insurance part, a lot of the initiative has to be taken by the regulator also. And they've also tried to push the internet-based sales a lot and ease out the process as much as possible, given the constraint that we work with.
I must ask you, you're sort of eyeing an IPO in 2018, or it has been said. What is the process like for a company trying to, at your stage of development in a vibrant emerging market like India, trying to go public?
So Indian equivalent of SEC is a regulator called SEBI, and you have to go through SEBI regulations to understand what exactly is required there. One of the things is profitability for last 3 years,
so you need to be profitable,
which SEBI on its own can let go, but that's the basic norm today. Another thing is the sort of promoter share and the thinking around the pricing of the individual shares, retail pricing. So some of these things do not really apply to a private business like ours. So you have to make changes to your structure and to your overall cap table to accommodate these sort of requests.
Do you think we'll see do you think we'll see Indian companies eyeing New York markets in the same way that we've seen Chinese companies flock to the US?
I'm not very sure about the fintech sector going outside India for listing. 2-3 reasons. A lot of these businesses are India specific. So if your brand is known in India and your customers are based out of India, it makes more sense to list in India. The liquidity is not a problem anymore. The second would be a lot of times regulators might also have a say in where you list, because for someone who is participating into insurance sector, going outside India for listing is almost impossible. The regulator wants to control a lot of stuff. They even want to control where you host your website. So I'm not allowed to host outside India. So I don't really see them allowing me to go for IPO outside India.
Right. And I mean, in terms of attracting investors now in the current climate in India, we sort of saw a lot of excitement about Indian startups and fintech companies sort of building over the last couple of years. I think the atmosphere recently has been a bit sort of sketchy. What is the environment for fundraising like in India at the moment?
So, I've been in the venture capital industry for over a decade now. I would qualify today's environment as fairly healthy, where good companies are getting capital, but there is not a deluge of that. I would argue a couple of years back there was too much capital in the market. So today, if companies that are executing well have enough access to capital, both from international money, but also there are strong pools of domestic money that are beginning to develop, and I think at some level they provide confidence to international investors as well. So it's a healthy environment. I think in terms of the IPO markets in India, that has always been a challenge, right? Because the IPO windows tend to be much shorter than you would see, let's say, in the US market, right? Our bubble starts 12 months after the US bubble starts, but we crash at the same time. So I think the IPO liquidity is the challenge. So there is a healthy base of companies that is beginning to perform. But I think from a fundraising standpoint, we look like we're in pretty good shape right now.
We've seen we've seen in the last year, we've seen SoftBank, Alibaba, Tencent, Facebook, WhatsApp. I mean, you name it. Everyone, the who's who of global technology is piling into India. I mean, is this a good thing for the market?
Yeah, I think there is a quality difference between the names that you mentioned and the first generation names that we saw coming into India, right? Initially, there were a lot of US players who were coming into India with the pure intent of investing.
So you mean like financial VCs, guys, yeah.
Right. Now we are seeing a lot of corporate interest, which is, people who are looking at the Indian market from an ownership viewpoint. So my sense is that many of these companies that you mentioned are going to land up being big owners of technology-driven businesses in the Indian market, and not just investors there. So what they bring with them due to that viewpoint is much deeper pockets and much more conviction to stay invested in those businesses. As also, I would argue, much more participation in those businesses on operating level as compared to the purely financial investors.
But what does this mean? Does this mean that India is not going to have a chance to have its own homegrown players? I mean, in China, it's an entirely Chinese affair. I mean, in India, are we going to see foreign capital drown out the local players, and these big guys come and sort of like run the businesses?
So the entrepreneurs are still the Indian entrepreneurs. The companies are still Indian companies that they're running. But a lot of our companies that have grown up would have majority foreign shareholding. India has traditionally been fairly tolerant about capital flows in and out, at least for the last 20 years since we started to open the economy up. So there isn't xenophobic attitude towards saying are foreigners owning our companies. I think we are happy taking pride in the fact that these are our companies and these are our entrepreneurs, and they act as role models for a future generation of entrepreneurs to come up. So, in some sense, we would tend to qualify these as Indian companies, even if they land up being majority foreign-owned.
Yeah, I mean, I would make the observation, and I won't quiz you on it, but as many of you know, India and China having some interesting border skirmishes at the moment, and it's quite interesting because we've seen a lot of Chinese capital come into India for the first time, and it's particularly come into the tech and the fintech space, and I think that's an uneasy relationship, and it'll be interesting to see how that plays out, because it's not a reciprocal relationship. So that's just an observation.
This is somewhere for Indian money to start playing into these markets, you need Indian entrepreneurs to make that money first. And as Alok just mentioned, if your company is majority owned by US investors or any foreign investors, even if you have a liquidation event, the bulk of money is made by them. So you don't have that huge amount of pool of Indian money which is ready to get into the digital sector as such. But having said that, there are a lot of family offices who are interested. The ticket size varies and their risk appetite also varies. And they will be little late to the game. They will typically not come at the seed stage, but they still want to drive a bargain somehow. And overall, if you look at the fintech sector, a lot of times because you have FDA regulations, they get a chance to have some say there. But the amount of capital available from foreign sources is definitely much higher. It gives you not only the capital, but also a lot of ideas about what's happening across the globe, which maybe you can incorporate in your business model, and those contacts are very helpful, which a lot of times Indian money may not be able to provide.
I'm glad you raised that point actually, in terms of because we just talked a little bit about what the rest of the world can learn from India with all this infrastructure, but in India itself, I mean, what is the state of regulation and data protection like? I mean, what are the points that India really needs to improve on in terms of, strengthening its fintech foundation?
Yeah, so I think the regulation in India tends to be fairly strong, right? Partly because there's a single regulator, but also because single regulator in banking, single in insurance, but not state-wise regulations. But also because most of these regulators tend to be progressive. And they will allow a certain degree of innovation to happen before they translate into systematic risk, which is when they want to come in and regulate that, right? And that's a fair call. On the data privacy side, I don't think we've been as strong. And a lot of those concerns are now coming into the forefront, also because some of the public infrastructure that we spoke about is creating its own set of security risks.
Yeah.
Right? So for example, I'm part of an initiative called Future of Finance, where the central point is, who owns data, how should we protect it, what should be the obligations of people who are essentially custodians of data. So there is growing consciousness around those things, but I think from a regulatory and infrastructure standpoint, I would rate it as an A+ market.
Do you think we'll see a comprehensive data privacy law in India at any point soon? It sort of doesn't exist at the moment.
I think we will. We will, at least with respect to all the activity that's going on in technology-led businesses.
And do you think it will be flexible enough to allow both of you to continue to tap this amazing opportunity that's out there?
Regulations are not flexible. Entrepreneurs are flexible, right? So we will figure out a way to work with them. But I think it is a long overdue regulation, not just because there is so much data sitting out there, but also because most of our customers are data illiterate, right? So they are not necessarily educated and informed about how they should protect their own data.
Right.
And in that kind of an environment, I think it is incumbent upon custodians of data to exercise that responsibility. Otherwise, you're just waiting for a big blow up to happen, which hurts all of us.
I mean, it's a bit of a kind of paradox, though, because I mean, the drive to develop and to move quickly is there, and it's helping India to leapfrog and solve many social problems. But the privacy concerns are lacking. I mean, given that you've thought about some of these issues, I mean, if there was a model to sort of look to for data privacy laws, I mean, who has a good model for this sort of stuff?
So I think the data privacy models are very sensitive to the social environment you're talking about, right? And to the underlying data literacy of your consumers. So I don't think there is a comparable market. There is also a trade-off between how strict you want to make data regulations versus how accessible you want to make innovation to people, right? So there is that balance to be struck. So my sense is that we will come up with something which is fairly unique to the market that we operate in, and that allows enough room for innovation at the same time protecting the interests of the consumers.
I mean, that's gonna be the real key, right? The sort of balance between innovation and regulation.
Yeah. But so far, I would argue that we have struck a fairly good balance on that count.
Great. Well, look, thank you very much, guys. It's really, I'm really thrilled to have been joined by you guys today, and I think India has really got a very exciting story in fintech to tell. So please watch this space. Thank you very much.
Thank you.
Thank you. Thank you.
So before we get to our next speaker, just a quick announcement. Following this session, we will be having some people from WeChat here. For those that are not fluent in Mandarin or Putonghua, there will be translation services available. So if you would like to be able to get that translation, please move to the back of the room and they'll be able to wire you up with the appropriate equipment. In the current terms, very few words get more excitement at the moment than artificial intelligence and machine learning. It's absolutely peak AI. And from an advisory perspective, nothing causes more concern and fear in the boardroom and in the operational level about what the effect will be for machine learning and artificial intelligence. So amongst the machine learning and AI hype, how do we actually separate fact from fiction? But I think this is really quite critical. So as the former CIO of Google and the current CEO and founder of Zest Finance, Douglas Merrill is better positioned than most to be able to talk onto this topic. So please, I'd like to welcome Douglas on stage to share his thoughts.
Thank you. You don't have to clap till afterwards. You can wait, hold your, because it might suck. So, hey, so thanks for coming. I'm Douglas Merrill. I want to talk a little bit about a hype cycle. So I've been privileged to be doing artificial intelligence for almost 30 years, which is a depressing number, but sounds really good. So it buys a bunch of credibility. So you guys should believe me. I'm gonna do this a long time. And in those 30 years, I've seen a lot of hype cycles. There have been times when AI has been popular, and times when AI has been irrelevant, and we've changed names a couple of times. So this week we're machine learning. But all in all, it's roughly the same thing. The cool thing about hype cycles is the behaviors during the cycle. So when you're at the bottom of a hype cycle, no one cares what you do. You go to cocktail parties, you say, yeah, I do machine learning for a living. And they're like, oh, really? Nice watch. But when you're at the top end of a hype cycle, all kinds of stuff happens. You can't tell what you do at cocktail parties, because otherwise people ask you questions about whether the robot overlords are coming. And the press writes a lot about it. Right? But the worst thing about being at the top end of a hype cycle is the emergence of the true evil. The true evil, the consultant. So what I would like to do today is help protect you from the consultant and their primary weapon, the loathsome lie. Or not. There we go. So let's set some context first. First of all, Mark Andreessen famously said that software was eating the world. He's probably right. But it's very clear that machine learning is, in fact, eating the world. Almost every industry has begun some amount of automation, right? There's some degree of AI kinds of stuff happening, some more than others. There's lots of reasons why. But it's not a really safe position to sit here and say, my industry, my company, my job, whatever, is safe from ML. But when the consultants show up, they're going to lie to you, because that's what they do for a living, right? Consultants, I used to be one, are specialized in separating you from your money. So let's talk through some lies and try to arm you against them. The first lie is that ML is just math, and all you need to do is push a button. Just push the button and the right thing happens. This comes in the form of, hey, look, this particular algorithm solves the world's problems. This comes in the form of, hey, this tool set will allow you to get all the benefit of ML and know nothing. The problem is that isn't really true. So 31337 is 1990s hacker speak for elite. So this says that the right ML program will make you elite. It won't. Primarily it won't, because most of ML is actually an art, not a science. Despite the fact we've been doing it for arguably 50 years, there's still lots of things about the math we don't understand. And then there's special things you just have to learn to do, notably things like missing data. It turns out that missing data has a huge impact on your models. And almost nobody spends time understanding how and why. And the button-pushing solutions don't do the right thing. So you cannot simply buy a box and suddenly become an ML expert. It's ironic that I'm saying this, since my company sells ML tools to help financial services firms underwrite. So I'm a little bit talking against myself here. But nonetheless, it takes some art as well as some science. Don't buy from anybody who says the tools answer the problem. And maybe you guys in the back should just flip. There we go. Oh, back one. Come on. Okay, I'm going to let y'all flip from now on. So the second lie is that the benefit of machine learning comes from some piece of magical data. Oh, if you just had renting data. Oh, if you just had bank account data. Oh, if you just had shoe color data. I'm currently wearing black shoes with like a white spot on top. Does that make me a good credit risk? I don't know. That's not really true. So it is true to some extent. As you add more data, you add more entropy. You add more information, which makes it more likely that a model will yield a good outcome. The problem is most of the time you don't really need that entropy. Zest has no clients who in their first model used anything other than what they already had lying around. And we've gotten really massive wins across all of our client base. It's not, data matters, and getting the right data matters, but you go a long way while just understanding what you already know. It's not magical data, it's the right kind of math applied to the data you have. Ultimately, you're going to have to add data, but rarely at the start. Next slide. Somebody hit? Thank you. Cool. So Every time I do an interview on AI, I get asked the question, oh, are you using Facebook data? We currently have no clients who use Facebook data. For a variety of reasons, not least of which is I think that's creepy. I don't really necessarily think you should be using social media data, but your mileage may vary. But whether you want to or don't want to, it isn't required. You don't have to be creepy to build good ML models. And more importantly still, everyone tells you, oh, you can't understand the signals in this model because they're made up of this 97-way interaction that involves shoe color. To the extent that there's a signal in your model that you find incomprehensible, it shouldn't be in your model. Mortgage and credit applications for many, many years have used payments income ratio as a really important credit signal, right? PTIs in every credit model in the world. It's also in pretty much every ML credit model in the world because it's semantically important. It turns out it matters if you have enough income to make your payment. That doesn't seem that hard. Just because ML is involved doesn't necessarily mean that all the signals have to be either incomprehensible or creepy. Next slide, please. And then I think the most important lie. Everyone knows that machine learning models are black boxes. Everyone knows that you can't understand what's inside a machine learning model because it's a black box. Everyone knows that this nature of opacity, if you will, renders these models extremely hard to use, and particularly hard to use in regulated environments like lending. This is less a lie than a misunderstanding. Take a step back in time, and I'll talk about credit. Credit historically has been run using a fairly simple piece of mathematics called a logistic regression. Logistic regression creates a yes or no decision with some set of signals, and it's sort of happy in the between 10 and 30 signals. Like at 30 signals or so, you can't really crush the 31st into it. It just doesn't work very well. So logistic regression has a sort of a natural limit of how many pieces of data it can handle. It has all kinds of constraints on the kinds of data it can use. Constraints are rarely met in production, but are still there. And so if you build a model to make a credit decision based on logistic regression, it's easy to see what happened and why it happened because you just look at 30 coefficients, right? Like look at the numbers, right? Y equals mx plus b, look at the m's. You get a lot, and you totally understand what happened. That's beautiful. It's very powerful. It allows for things like adverse action and other regulatory requirements where you have to explain to a borrower or an applicant why you did or didn't give her credit. And that's the reason that the credit in many fields have been dominated by logistic regression for many years. In contrast, fields like fraud, where there's no explainability requirement, no one has to explain why a fraud decision is made, there's been some amount of more complicated ML used in fraud. The argument for moving from logistic regression to more interesting machine learning models has been, hang on, how do I find those coefficients? How do I explain to you why I didn't make that decision? You can't do that. True, it's like support vector machines, you don't know why they gave an answer, they just gave an answer. Neural networks, you don't know why they gave an answer, you just gave an answer, that's right. But there's been, in 2004, a very powerful paper on explanations in neural networks was published, an academic study, which said if you take the special form of neural networks, you can, in fact, explain why the network did that work. Oh, hey, hang on, maybe that means that neural networks aren't black boxes after all. And so, since then, there's been various and sundry pieces of academic research, notably done by places like Carnegie Mellon, around how do you expand these black boxes. There have been forms that have been specific algorithms. So there's a commercial product sold by one of the credit bureaus, which uses a very special form of an algorithm with an explanation. There have been sort of more theoretical approaches. We sell a version which is a computational way of approximating, so you know what happens inside the black box. But in any case, there's lots of ways to get into a black box and make it visible, it's just hard. And there haven't historically been any good tools to do it. So it's a lie that ML models are black boxes, and it's a lie that you have to consume a model and assume that the black box nature of it is either true or useful. You can expand the black box. It just requires some work. It's not easy yet. Next slide, please. So with that, I want to leave you without, I think the most important lies of ML, the most loathsome of lies of ML. We're at the high end of a hype cycle, excuse me, about AI, ML. There's lots of stuff being written in the press which is really compelling and maybe not necessarily very descriptive. There is a lot of interesting research and lots of interesting companies, and almost everyone says, oh, hey, we're an ML shop now. Almost everyone says, oh, hey, we use ML to make whatever it is we do better. And that's great. Ultimately, ML is eating the world. All those companies will, in fact, use ML to do interesting things. But between here and there, we have to fight our way through the hype. AI is not magic. ML, whatever, is not magic. It's just math. You can't create information that isn't there. Right? The information is there, and you can use it, or it's not. It doesn't rely upon creepy signals that you really wouldn't want to talk about at a cocktail party. Or if it does, you're not doing it right. These are really compelling lies, sadly. So every time we go to a client, I get all these questions. Probably you are all getting sold these things that are true. So what I would like to have happen, the reason the AI bubble popped in the 90s is that we promised everything. There was lots of, that we promised that we would have human quality decisions made by a refrigerator. That was literally a product. It turned out that that's both hard to do, having human quality decisions made by a refrigerator, and a bit pointless. Because, do you actually care that your fridge can make human quality decisions? I mean, really? I don't, maybe. I think maybe you want to tell you if the milk is spoiled, but short of that, I'm not sure why I care if my fridge is intelligent. Part of the reason that I want you all to be armed against the loathsome lies is because I don't want this bubble to pop. I don't want lies and promises and all those things to yield in a couple of years us all stop paying attention to what is the highest leverage thing around us today. To the extent that we can use AI, use ML, I don't care which expression you use, to make better decisions, to help people make better decisions, and to do stuff that people aren't great at, right, that's an incredible social good. To the extent we let those things be done incorrectly or we overpromise what we can do, and then we stop making progress towards what it can do, is a huge, huge social loss. Thank you so much. Oof.
Thank you very much, Douglas, for that great piece. It reminds me of a really pithy quote that shiny toys aren't silver bullets, and that this is much more than just the technology, but the application side. Just as a moment while we're setting up the stage, a reminder for those in the crowd that are not fluent in Mandarin or Putonghua, there are actually translation services available at the back of the room first. So we will have a translator on stage, but if you'd like to be able to access that, please take the opportunity now. Grab that before we bring up our next speakers on stage. Speaking of which, it's a very great privilege of mine to be able to introduce some people from WeChat. WeChat have really been a bellwether of the fintech and the mobile messaging space, and also a great signal as to the digital progression within China. But the question is, can it now lead China in a space beyond mobile payments? Beyond mobile payments. So Director of WeChat Pay, Grace Yin, will now share just how WeChat Pay is in fact breaking down those payment gateways issues. And to help facilitate that conversation will be Wang Feng from the Financial Times. Please come on stage.
You.
Thanks.
Okay.
Thanks a lot, everybody. It's me again. After 4 minutes. From Standard Chartered, and now it's Grace Yin from Tencent Pay. Actually, Tencent and WeChat dominated much of my conversation with Mr. Gores just now, but if everybody has already got their headsets on, we'll start in Mandarin. Grace, 你好.
Good morning, Grace. Welcome to Rise today. Actually, back on the backstage, we'll talk about the activating users in the worldwide. We have 900 million. And users of WeChat payment, there are over 600 million of them. So some of you may not have a good understanding of how big the sizes are. So on top of these two figures, anything that you can let us know about the market share, for instance, of WeChat in China? Well, according to the last quarter's financial report, WeChat and Tencent, we have 638 million users, and the daily transactions is over 600 million. So this happened in one day. And in terms of the market share, what I could say to you is that compared with our previous performance, we have a great increase. So we understand that in fintech, we are very much sensitive to the market share because there's a fierce competition between different players. So WeChat, in the past few years, you are growing and you are seizing the market shares. How about the speed? How fast are you in taking up the market shares? I would say to you that in big cities, most of people will no need to take their purse with them when they're going out. So it's actually a revolution that is happening everywhere. You could use a mobile phone to make a payment on your WeChat platform. We said that in some traditional areas, especially in hospitals or in some government organizations, you could well use a mobile phone instead of a bank card. And in our daily lives, just how often you lose your purse, how often you lose your wallet. Well, actually, you take out your mobile phone more times than you take out your purse. So I think that everyone can feel that it is now a revolution already. So as a journalist and as a host for today's talk, I would like to say a few words about what you have been doing in China, because every day when we are seeing media reports on fintech development in China and mobile payment in China, well, most of them were mentioned WeChat. If you go with your mobile phone, there's no need for you to take your wallet anymore. You can even use your mobile phone to pay your traffic fines. And underneath our, in our company, in our offices, there are some food cards, and you don't need to pay in cash. You can just show the QR code and you just swipe it and then done. So for businesses as small as a food cart by the roadside, you could use WeChat payment, and there's no need for them to give you an change in cash, and it's better for the hygiene for the food, right? So this is just a small example of how you could use mobile payment. And on the other hand, we are trying to provide more convenience for the small businesses. So in addition to what you have said, I remember when I was visiting Beijing, I even saw some beggars on the street presenting a QR code in front of them and begging for money. And what impressed me most is that you could also use mobile payment for charity purposes. I decided to make some regular donations. Children from rural areas who are very poor, and I don't need to do anything else rather than just click on my mobile phone. Everything is finished within a few seconds, very quickly and very convenient. Yes, because when we were trying to enter into the vertical of healthcare, I found that there are some kids who are from poor family and they need some donation. But traditionally, the hospital would just put a donation box out there in the lobby, but nobody would give it a attention. So if we use the mobile payment method, we just made a poster on the wall, and then you could just scan it and you'll be able to see the information about the kids, what disease they got, and if you feel like making a donation, you just use the WeChat to donate. And with that way, we raise more money, 200% more money than we did in the past. So now that's the end of the advertisement time. Maybe we switch back to our theme for today, which is breaking down borders. How could we go to more markets, more countries for WeChat payment? Well, a lot of foreign medias, they said that in China, WeChat or Alipay, they are very strong already. They already got a very solid foundation. They are even being able to compete with traditional banks. But on the other hand, when you are going to overseas market, you're still faced with a lot of challenges. Some people say that you are relying heavily on Chinese people who are studying and working abroad. So, as you see it, what is the latest development?
Okay, the first half, we think that for the overseas markets in China and the overseas have some difference. So actually, in the China, the users, they can repay the commercial. In comparison, in the overseas, including our partners, not only the banks, actually their understanding of WeChat Pay is not much. So they just think it's a new payment method, and they will question that we already have many payment methods. Why should we add one? So we have to educate them, and this process, for the education for commerces and also for banks are more difficult overseas than comparing to inside. So in China, actually, when we do the charity payment, we have the authorization from central bank, then it's okay. But for overseas, we need more authorization and more regulation. We also need to be regulated by the foreign exchange authorities. And also we have to comply to the legality in China and also in different countries. So therefore, in the China and also overseas, we have faced a lot of challenges. And so, for example, previously we have an example in Thailand, then they don't have a really obvious legality to regulate payment overseas. But after we entered the Thailand market, many of the Thai merchants, they requested for us. So together we explored the security issues, and also together they have set a new law, new regulations, and new license for finance institutes. So therefore, we must work with licensed finance institutes, not just any bank or anybody. Yeah. So in this process, for the communication and for the education, we have faced a tremendous amount of challenge and difficulties. On the other side, I know that you have to work a lot on the regulation and the compliance for this. In China, the policy for regulating the internet also has received some negative feedback from the media and raised some worries and concerns from people. So how do you solve this problem? But actually, for the WeChat Paid, our main audience, our main users are overseas, are travelers from China. So we need to convince the merchants and also we convince banks that the information are safe and secured, and all this data and all the structure for the information securities. After they have evaluated, after they understand, then we'll give them confidence that this is a secure transaction. So for your ambition for overseas expansion, is your ambition only focus on overseas Chinese or Chinese people from around the world, or also internationally? I can say that everything's possible for Tencent. Our vision is to provide the services to serve our customers. So even though our users, when they travel overseas, can they use the same payment method as if they're in China? So we want to make a seamless transaction. So on the first steps, of course, we are focusing on the Chinese audience, Chinese users who are already used to these payment methods. But the next step, we cannot say that we will limit, not to expand it to other overseas markets. But in the short terms, our focus will be on the travelers, mainly from China, who already use this method. Yeah. So yes. So also there are many Chinese people who already live overseas, and then they also work with regulators and other governments. Yes, I understand. I think that when in the beginning in China for WeChat Paid, our development relies on our open policy. So we hope that we can provide the basic foundations and products for our users, and then we will sector different products for different verticals, different industries, and then to provide more systematic services and products for all our merchants. So I know that WeChat very careful for work to operating. So in the next few years, how will you expand to the overseas? I can say that everything is possible. Yes. So I could say that we already have started many things, but we cannot say that. But in the future, how will we develop whether it will be so-called radical, as you mentioned, that we will see. Thank you.
Great work. Thank you. So we're now going to pivot a little bit and look a little bit more deeply into the insurance sector with a section called FinTech. If it doesn't kill you, it's going to make you stronger. And as one of the most powerful insurance brands in the world, Ping An has long been at the forefront of financial services and FinTech. But how do they stay ahead in a space which is moving so rapidly? How do they remain at the forefront of competitive advantage? So Ping An Technology's CEO, Ericsson Chan, will now outline from his perspective that far from hurting the financial services industry, fintechs are actually making them stronger. Please welcome to the stage Ericsson Chan.
Hey, thanks. Hi, everyone. I'm Ericsson Chan from Ping An Technology. Ping An Technology is the fintech arm for Ping An Group. Everybody knows Ping An Group as the big Chinese insurance company. And in the last 10 years, Ping An Group has evolved from a large insurance company to a fully integrated financial group. And particularly in the last 2-3 years, it has been leveraging fintech and turn into a technology company. In actual fact, our chairman, Peter Ma, has publicly spoke about it. Within the next 10 years, the whole group will be evolving into a technology company. So definitely, Ping An has been using fintech to make ourselves stronger. And I would like to share a bit more with you today. And we just heard the story from WeChat. Both WeChat and Ping An is only 45 minutes drive north of here. But the atmosphere for fintech is quite different than here. So when technology is working in China, it penetrates very far. You heard the story about WeChat. It's not only about shopping in a shopping mall. Even in a wet market, you're spending half a dollar, US dollar, buying raw vegetables. You have many different e-wallet options. And when something goes viral, it will go tremendous pace. Like a rental bike, it can go from 0 to 1 million within 3 months' time. That's China. When a lot of the fintech buzzwords, like blockchain, peer-to-peer lending, and the one that I like a lot is robo-advisory, they tend not to go into any proof of concept or pilot stage. It goes straight to production to offer a customer service to the customer right away. And this is one of them that we have offered about 2 years ago, is help you to do asset allocation and rebalance your portfolio through a simple app. And fintech in China goes beyond the normal buzzword. Of course, the exciting part is artificial intelligence. And fintech in China, and particularly in Ping An, is beyond the buzzword. We'll go even into area like facial recognition, voice authentication, micro-expression. The area of fintech's a lot wider. So, what we have learned, the Ping An journey. There's a few key drivers to make this work. One is scale. Second, we call it scenario, use cases, data, speed, artificial intelligence. Scale is obvious. It's because of, if you have scale, you can afford to invest a lot more. And you have a lot more data. Ping An is the largest insurance company on the planet Earth by market cap. A month ago, according to Forbes, we are the 16th largest company today, globally, and ranking 41st end of last year by Forbes, Fortune. Figures, 137 million financial customers we have today, and growing by the minute. And more interestingly, when we talk about online customers, we normally say how many % of your customers, financial customers, they're online. 30, 40%, that will be doing quite well for a bank. But for us, it's 270%. So obviously, how we run our business model is very different. We have 376 million online users. Quickly talk about how we structure Ping An. We focus on both finance and healthcare. It's a two key area of focus. On the finance side, insurance, banking, asset management, supported by fintech. And then on the other side, TechFin, I call it the TechFin and TechLife. Basically, it's a technology-driven business model. So to offer finance, products and services, and other lifestyle products that we are creating 4 ecosystem, finance ecosystem, housing, health, and automobile. Why are these ecosystems? These are the biggest purchase in your life. And that is why we want to help every customer on every financial needs, end to end. And we have full financial service license. That gives us plenty of scenario use cases. This is one of the apps. It's for the car driver, car owner. It's called 好车族. And with this app, it's everything you ever need as a car driver. It manages your traffic ticket, help you to find where you get the gas station, How do you fix your car? Where's your repair shop? You even have a Top Gear-ish forum to talk about car news. And more interestingly, on the second from the right, as a screenshot, is your driving behavior. We will analyze every second of your driving behavior. This is one day, it's in Hong Kong. In fact, I was in a hurry, taking my kids to play badminton, and obviously I'm driving a bit too fast. Turning the corner, slamming the brake too hard, it will tell you, and I'm getting a 66 score instead of 100. The purpose is so that we can help you, help the customer to manage, to save money, to reduce the petrol cost. But as you can imagine, if we can, using this data, we can absolutely give you the tailor-made products and price it accordingly. With different ecosystem, we can collect data about you to know you so much better, 360 degree, different dimension. Speed is paramount of what we do. We automate everything if we can. Our entire SDLC lifecycle, automated testing, development, deployment, 150 seconds is taking us to deploy a whole new technology environment, because we put 80% of our infrastructure on cloud. So as a result, 59% of our software release from end to end complete in 14 days. 89% of our software releases complete in 30 days. It's wow, if you're thinking from a financial industry. But we compare ourselves with all the fintech startup here. We look at it differently. So if you talk to any fintech startup or startup, matter of fact, yeah, this sounds about right. Maybe a little bit above average. So AI is the buzzword. We heard about ML earlier. We focus a lot on AI in terms of perception, prediction, and prescription. We digitize the entire, using fintech, the customer journey from acquisition and product lifecycle all the way to risk control and product. And I'll highlight some of the examples here. How we run our business model is very different. I mentioned about not fintech, but techfin also. What is techfin? We use technology first to create like marketplace for different products owner to put in the marketplace, different channel hook up together, like Lufax. Everybody is a more famous subsidiaries of ours, one of 28 companies within Ping An Group. Lufax, 陸金所, 陸金所. And beyond Lufax, we also, beyond open marketplace, we also do open platform. 30-some banks, hundreds of corporate customers, they are my customers today for Ping An Technology. Because we offer service to small and medium-sized banks and some international banks that they don't want to spend the effort on building channels, building latest modeling using big data, so we can help them. So they will focus on how to treat the customer instead. It's a win-win solution. It's low asset requirement for Ping An. It helps them lower their investment. So we create a whole ecosystem using TechFin model. So about AI perception, we go beyond robo-advisory. We develop our own facial recognition engine. In June, we benchmark on LFW benchmark. It's the world #1 accuracy. I was very pleased about it, 99.8%. And why do we do that? Because we believe this is very core for financial business. Because we can able to tell if you are you. We applied it in our personal loan product. Someone can download an app, then they can apply for a loan for taking a few photos of your documents. We do a FaceTime-ish video conference through the app. Immediately, we know if you are you. We use even micro-expression engine, knowing if you are happy about what we are talking about, or if you're nervous, or should I ask you a few more questions? The end-to-end life cycle is taking only 6 minutes. Money is in your account. that is the micro-expression engine we have also built, and it's being used in many different use cases. Voice print authentication is what we're working on also, as some of the use cases in auto insurance, credit card products, the life cycles. Some of it we don't need to ask you if, hey, what's your birthday? What's your address? We know you are you by you asking me a question already. So beyond perception is about prediction. We leverage our artificial intelligence to help cities like Shenzhen, Chongqing, using the medical data from the government hospital. We predict in the next 2 weeks what kind of illness will be coming, so we can warn the public so then they can take precautionary action. Therefore, we'll minimize sickness in the public, better health, and obviously will also benefit health insurance company. Prescription. So once you have all these technology, we can also apply photo recognition technology. With our car insurance business, you use the app. If your car is damaged, you take a few photos, upload it. Our engine will know if this is your car, if it's a Mercedes, it's an E-Class or C-Class, what kind of damage, do you need paint job, body work, or replace the panel? Link up to the supply chain inventory, we know how much it will cost to fix it. One of our customers, and because of the typhoon in southern China, car got damaged. Take a few photos while the typhoon is still around, upload it. Before the typhoon left southern China, money is already in his account. We have all these different AI technology built. And why do we do that in-house? We do it in-house. And then we have individual AI. When we link them together, it will create a very rich experience that is like never before. We are not digitizing a process. We are not just automating process so to increase productivity. We are not just building a faster and faster horse. We are building a car. We are not playing in the same game. In fact, we're building a race car. So the game is different already. This is all the products in a simple graphic. From cloud, business control products, we put it all as a IaaS, PaaS, SaaS cloud services. Why do we do that? It helps ourselves because it's fast deployment, but also because we can share. We want to share. Why do we do that? Because it's not only to bank to unbank. This is what we always talk about. Even the bank today, they do not have some of the services that some of the tier 1 city. If you're sitting in tier 3 city, you might not enjoy the same service level and products in tier 1 city. And if you're in the mass market segment, you might not be able to afford to get the same level of service as a high net worth client. We want to share so that this technology can be used by even small and medium-sized banks. In fact, we're helping bank in South Africa so that the entire demand for the industry will increase. With the demand increase, it's benefiting everyone, including Ping An ourselves. This is why we want to democratize fintech. So, yes, fintech could kill you if you're not prepared. But I rather think of it, if you spend some effort to prepare for it, invest, partner, even get the staff understand it better, fintech will create a much stronger financial industry for everyone. Thank you very much.
So we just had a look at whether fintech will kill us. Well, our next area is going to be exploring another part of the corporate space that also fears possibly killing us, regulation. So how do fintech startups continue to push innovation when there are so many regulatory frameworks that they need to address? And in fact, is RegTech a silver bullet to address many of these regulatory hurdles? Well, as it happens, to examine this in more detail, can you please welcome to the stage three different players in this space. Firstly, we have Tim Huang from Fiscal Note, John Schrader of Duff and Phelps, and Gurjit Singh from ASD. All of them now on stage with a good friend of mine, Andrew, of NextChange. Please welcome to the stage.
All right, thanks, Matt. All right, ladies and gentlemen, let's get to it. We are talking RegTech. It's exciting. Good morning. It's still a little bit of morning left. I'm Andrew Work from NextChange, the social platform connecting professionals to financial services and innovation. And we also do FinTech, which means RegTech. And we have got three speakers here from the United States of America. They have come from New York City and from Palo Alto. To speak to you, I'm going to give a quick intro from each of them, and then we are going to get into it. Okay, gentlemen, Tim Huang, I'm going to let you kick off with a quick intro about the exciting work that you're doing.
Sure. Hi, everybody. My name is Tim Huang. I'm the founder and CEO of a company called Fiscal Note. At Fiscal Note, what we do is we aggregate all of the world's laws and regulations into one singular platform and use machine learning and natural language processing to automate legal processes within about 1,300 enterprises globally today.
Okay, sounds good. John, what do you got for us?
Hello, everyone. I'm a managing director at Duff & Phelps, which we're a large independent corporate and valuation firm located throughout the globe, and I specialize in working with fintech companies doing valuation analytics.
Okay, sounds good. Gurjit, you're bringing us the artificial intelligence in RegTech.
That's right. So I'm Gurjit Singh. I'm one of the co-founders and the executive chairman at Ayasti. We are an AI-based company. We sell regulatory solutions into large financial services organizations for using AI, such as regulatory risk modeling and anti-money laundering and such.
Okay, so this is very cutting-edge stuff that we've got up on here today. RegTech, a lot of people are really interested, and there's a lot of changes coming down the pike. And we've had a bit of a discussion before this, and one of the things I got from you guys was that there are challenges in the sector. Like, a lot of people are struggling with this, but that also creates opportunities. Gurjit, I'm going to start with you, and can you tell us a little bit about what some of those challenges are and how you're addressing them?
Yeah, absolutely. So I believe every challenge is an opportunity. Two specific examples I can talk about. In regulatory space, one of the bigger challenges that large financial services institutions face is around regulatory risk modeling. Today, it's a process that on an average takes about 5,000 hours. And it's a very complicated process where you have to have people who build risk models, people who consume risk models of business, and the regulators kind of all have to agree on how to sort of agree on risk. Building these models takes a very complicated, very large amount of time. So one example of the use of AI in this is, how do you use AI to, take large complex data sets and reduce the number of variables that you can use for regulatory risk models such that the models are still understandable. That's one example. The second example is on things like anti-money laundering. Now, if you think about most large banks in the world today, a large bank like Citi or JP Morgan and HSBC employs anywhere from 6,000 to 10,000 people. And these people essentially investigate individual transactions. Now, luckily, 98% of their work does not result in a suspicious activity report, right? So most transactions are good for everybody else here.
Sure,
right?
most of it's cool.
That's right, most of it is good. But at the same time, to keep your risk profile, you waste 98% of the effort of 6,000 people.
Yeah.
So this is another opportunity for AI where you can dramatically reduce the number of investigations you have to undertake while achieving the same or the better risk profile. So these are two examples of using AI in the RegTech space.
I mean, Tim, you're right in that space using, is it deep machine learning or AI in terms of attacking the RegTech issues. Tell me about what you're doing.
Yeah, so what we do at Fiscal Note is we take the front end of the regulatory process. So I think that it's hard to have a conversation about RegTech without talking about what's going on politically around the world, right? You have things like Brexit, you have the the rise of nationalism in multiple countries around the world. What that's doing is that's essentially fragmenting the regulatory process and the rulemaking frameworks that a lot of industries are operating within. And so within that context, you have a fragmentation of laws and regulations that all these different operations need to be a part of. And so if you're talking about a large financial institution, a large energy company, a large logistics company, they now have to operate with hundreds of different regulatory frameworks in their minds. So what we're doing is we're pulling together all those laws and regulations, all those court cases, all those different pieces of legislation, all those different statutory changes, pulling them all into one singular platform, and then using natural language processing to target each of the individual business units in a specific country to say, hey, business line manager in Indonesia or in Australia or New Zealand or France, here are the new requirements that you have in operating your businesses in the specific region. And we strongly believe that, I think, in the long term, the work that a lot of these regulatory and compliance professionals are doing, at the front of the process, monitoring these laws and regulations, mapping them to individual policies and procedures, working with specific business line managers, and actually making sure that they're compliant, all of those things will be automated in the long term.
I mean, all this, the kind of the growth of the regulatory regime around the world is really, it's created opportunities for you guys. I mean, John, you guys are in deep, in particular in finance. Where do you see some of the biggest challenges in the world of finance and fintech and how that relates to RegTech?
Well, I think you really break it down in financial institutions to the disrupting fintech versus the established institutions. There's a great opportunity for both of them. Cost benefit to financial institutions of being able to handle fragmented regulatory regimes, evolving changes, the obstacles they've historically had with large established cumbersome systems. There's a great opportunity there. I think where it gets a lot more involved is with the fintech and the startup and the disrupting new technologies that are out there, because when you're talking to the regulators, there's a newness and a familiarity with the products that have been put out there and the ability to understand how those products, are they responsible products? Do they breach any regulations and laws? And if you're going to embed these technology solutions towards regulation, are you going to have the transparency to make sure that all of the existing framework rules are established? So we spend a lot of time talking to fintech companies, discussing what the opportunities are with regulation, but also in talking with the regulators to discuss how to understand these fintech disruptive businesses, given that they pose substantially different systemic risk than the established institutions.
Yeah, because there's one part of RegTech where you've got companies trying to make it more efficient for traditional business to deal with regulations, but then the fintech guys, and technology being applied in other sectors is just changing everything. When you guys come along and say, oh, we've got a RegTech solution for you, we're going to tell you how to collect information, how to package it, how do the regulators take that? How do they like that when you guys come along and say, oh, we're gonna tell you how we're gonna solve your problems, regulators, right? How do they react to that? I'm like, whoa.
So my experience with the regulators has been quite amazing in general. I would have expected it to be a very stodgy, institutional, federal government-based.
What, regulators? No, I couldn't imagine.
So I have to say, before I say anything else, I love regulators. If there are any regulators in the audience, I will give you a hug right now.
Any regulators in the audience?
So
need a hug? No? Okay.
So I think what I have found is regulators are actually quite eager to learn about these technologies, and they are also quite eager to see change in the ecosystem as well. Right, I was in Shanghai last week talking to regulators, and one particular regulator from Singapore said, in a few years from now, maybe 5 years, maybe 10 years, hopefully, or less, hopefully, I want to be in a situation where I don't want people to do regulatory reports anymore. I just want access to some parts of their data, so I, as a regulator, can make my own determination as to what's the risk and so on and so forth. Right. Similarly, regulators in Australia, for example, have done a very good job setting up sandboxes, where they let smaller institutions, but then also larger financial services organizations to, experiment and learn new things and, learn new things about the market. And one good example is in UK, for example, RBS has a separate entity called bluebank.io, where, they have regulatory approval to be able to try a few new things with real customers and so on. So I think overall, I found regulators actually they do want to innovate and they want to participate.
Okay, now those are regulators. I mean, we're big on fintech. We do fintech, but I mean, it's not just fintech. I mean, how about regulators in other sectors, Tim? Because you're doing healthcare, you're doing agriculture, in addition to finance. How are those regulators reacting to your types of solutions?
Yeah, so it's really interesting. So 2 points. The first thing is I think we've been very lucky as a business to work not only with the traditional players like the UPSs, the JP Morgans, the Cargills of the world, but more of the up-and-coming players. So we started working with folks like Uber and Lyft, Zenefits, Coinbase, DJI on the technology side of things as they're coming up and trying to become a lot more compliant in the regulations, right? So as Uber has been sort of expanding into multiple different regions around the world, they've obviously seen major regulatory challenges as it pertains to ride sharing or food delivery or logistics. The same thing goes for any of the fintech companies. Any company that's operating in healthcare has tremendous requirements with respect to data privacy and the like. And so what's been interesting is that the challenges are actually the same. Whether you're a large company or a growing company or a startup, and one of the interesting trends that we've been seeing actually increasingly is that startups, particularly those that are in regulated spaces. So if you're doing online lending, or if you're building a telemedicine application, or if you're building a rideshare application, startups are increasingly making the investment upfront to speak with regulators and get their solution out there in the marketplace. But the same thing goes for on the regulatory side of things. I think regulators are now much more willing to speak with startups about the regulatory challenges and work with them around trying to figure out how to make their business models work. For us as a business, even as we think about our business, we depend on regulators and we depend on governments to publish laws and regulations and legal opinions so that we can pull all that information together. So yeah, even in our own internal operations, as we work around the world, we do sit down with regulators across the table and say, here are the requirements that we have, here are the things that we need you to do in order to make sure that our business thrives. And regulators traditionally have been actually really great at working together.
Yeah, I mean, regulators are trying to deal with startups like you guys, but I mean, John, you come from Duff & Phelps. They've been in this business for a long time. What do the regulators say about these startup guys when these guys aren't in the room? When they've got like one of the old hands in there?
I think what you're hearing from the couch, from the panel here, yeah, I mean, regulators historically are pretty, I would say, stodgy. It's years of experience and understanding all these diverse and evolved rules. But the regulating world is very hindsight 2020. It doesn't have a huge prospective view in how bank examinations, et cetera, are performed. So what RegTech offers them is tremendous in the efficiencies of not spending 75% of their time doing reconciliations, but actually setting intelligent policy. And so I think they're very much looking to embrace it. And these sandboxes you hear are looking to be set up now in the US, they're in UK, Australia, Singapore. And I think that becomes a very fertile ground for industry and regulators working together. But I think they want to embrace it. But there's going to be, as much enthusiasm as exists, some timing and an education process. I think it was Joanne Barefoot in one of those last month RegTech seminars in the States asked people to raise their hands, and I think there was probably, when they went between regulators to industry, which was about 50-50 of the population, 3 people on the regulating side understood AI.
Wow.
So it's not that they're completely unaware of technology and development, but RegTech and it's say a young person's game. They're in a different awareness and readiness to embrace the technology. But I think the desire is there and the need is definitely there.
Yeah, when you talk, you bring up sandboxes, and we talk, we see a lot of regulators now, especially in the fintech space, are creating regulatory sandboxes. Are they starting to think about how they can incorporate AI and how that can feed into what they're doing in that space? Have you guys been consulted on that front in terms of how they can use AI?
Absolutely. So in particular, in the US, for example, I've spent multiple days with parts of the Fed where they basically say, hey, you're doing this new thing, we are really interested, we've heard customers really like it, and explain it to us. What do you do? How does it work? And they went pretty deep, asked questions. I've spent multiple days doing that, and they've been pretty open. Some things they are good at, other things they're not, and they're willing to learn and invest time to do it, actually.
Yeah. Okay. Tim, how are you finding that? Are they coming to you and saying, we want to try something new? How can you help?
Yeah, I mean, for us, it's less about the regulator side. It's more about the enterprises. So we typically come in, and for a lot of our firms, the regulators are actually embedded within the firms, right? So I think those challenges are similar, and they're actually related to the enterprises. The bigger challenge, of course, is getting the customization right for each of the enterprises. For one financial institution, the way they actually organize their business lines may not be the same as how another institution does it. And so mapping policy procedures, laws, and regulations is a little bit of a challenge, but I think from that perspective, we've seen culturally that regulators and enterprises are very, very willing to work together.
Okay, but they all have to deal with the same set of regulators, but internally they've got different ways of doing things.
Right.
Yeah,
right.
John, you must deal with that all the time. Like, how are you guys finding that? In terms of how you deal with the regulators, and you're in New York City. You must be talking to them on a call. I know the guys in Hong Kong and Duff and Phelps. They talk to the regulators here regularly. How about New York?
Yeah, I mean, again, for the segment of the market that I touch, it's the fintech startup or the fintech existing business in the States, because of the way U.S. regulation works, you could be choosing to do a state-by-state or an issuing bank model, which in the States means you have your originations done out of one state and export those state laws to get around having to comply by 50 states. But if you're a fintech platform, such as a Lending Club or Prosper, and you issue notes, you're regulated by the SEC because those are deemed to be securities. If you're doing the issuing bank model, you may be following one bank like Utah, but that doesn't get you around state regulations for collections and servicing. So the conversations are always around how do you comply and how do you adopt your business and your originations, your servicing practices in order not to get tripped up, because in this space, regulation is coming to town and it's changing very quickly, because marketplace lending or peer-to-peer, as far as that part of the fintech, isn't an unregulated business. It's just a newly regulated business, and you have some different changes out there. Right now in the States, a lot of the conversation is around the OCC fintech charters, and this would allow fintechs to apply and get a national bank charter. Conversations there with the OCC surround how do you look and regulate this business, because the OCC has a very standard way of looking at lending institutions. Typically, they have taxpayers and FDIC insurance behind it, and thus the different systemic risk, because this business doesn't have that. But conversations are around how would you look and set regulatory capital, liquidity capital? How would you do the charges for a fintech startup or a fintech business when it poses different risks and they're funded either through institutionals or marketplaces or some hybrid structures?
Yeah, I mean, it gets very complex. Ladies and gentlemen, we're getting close to the end of our time here, so I'm going to wrap up by thanking Tim. Forbes 30 under 30, but that was a couple of years ago, but he assures us he's still under 30. He is the CEO and founder of Fiscal Note. You can find him in New York City. You can also find John Schrader from Duff and Phelps. As you've probably figured out by now, he is their financial major domo on the regulatory front, also based in New York City. And we've got Gurjeet Singh from IASD. He's in Palo Alto if you want him, track him down. Ladies and gentlemen, this has been your RegTech panel. I'm Andrew Work from NextChange. Thank you. All right. Let's take it off stage, gentlemen, and hand back over to our MC.
Well, I'm almost exhausted listening to Andrew talk and present, so let's see if we can keep that energy pumping through to the next section. And for those in the audience that are not fluent in Putonghua, we actually have translation services available at the back of the room. So the next session will be in Putonghua. If you'd like to be able to listen and you don't understand that, please take yourself to the back. They'll be able to set you up so that you'll be able to gain even better insights from this next session as we talk with Tiger Brokers. So 2017 has absolutely been the year of Tiger Brokers, and they have done a tremendous job in simplifying the brokerage process for Chinese investors. the Chinese investors. So sharing his vision of the future, we're very proud to pronounce the Tiger Broker founder, Wu Tianhua, will now outline how Tiger Brokers are shaping a new generation of internet brokers in China and beyond. Please welcome to the stage, Wu Tianhua.
Good morning. I'm very honored to meet you all here in Hong Kong to talk about Tiger Brokers, how we're thinking about fintech and how we're thinking about the entire industry. For a long time, we've been thinking that a lot of small businesses and the going down of some big companies is actually because the new generations, they have new choices, they have different tastes and different habits from the previous generations. For instance, when some elderly people, they prefer to use WeChat to talk to each other, maybe the young people will go back to ICQ and to use some of the social medias. And comes to investment, well, my parents, they love to listen to the news broadcast to find some investment opportunities. They want to invest in SOEs and the in national banks. However, for young people, those who are born in 80s and 90s, they will prefer to choose the investment opportunities from what they love. And also, they will invest in overseas markets such as in the EU. Let me give you an example. This is a very popular movie in China called World of Craft. That is because there are a lot of game players who really love this game and they will invest in this company even though they are listed in the US. That is because they love to play this game. And I think a lot of you here are a big fan for Steve Jobs. And I think that maybe you would love to invest in Apple from Apple iPhone 1 to iPhone 4 and to the latest version of iPhone. There are a lot of investment opportunities, and if you keep an eye on what Warren Buffett had said on the annual general meeting, you noticed that Warren Buffett started invest in technology, and he thought that he might have been making a mistake not investing in IBM. So my point is that choosing to use iPhone is only a very chic lifestyle. Behind that, there could be an investment opportunity. So some of our young generation, they are choosing stocks by their habits and love. So because of this change, as broker, we have to provide better services for the young generations. We can see that in China, we have a short history of brokerage. In 1999, we were just seeing the establishment of Shanghai Stock Exchange. We only have 20 years of experience, whereas the US market has been developing for more than 100 years. So you could see that there are a much wide variety of products being available in the US. In China, we're still budding. The derivatives in China, we were just starting making some derivative products, and the brokers in China, they are still they're still having some local operation instead of a national one. I maybe would choose to go to China Merchant Bank because there is just a branch near where I live. So I think that if you look at the logos of those brokers, you'll find that they're more or less the same. But in the US, the market is more diversified and is more mature. When 1975, when the US regulators lifted the restraint on the brokers, we're seeing that our American counterparts, they are growing very tremendously, and they have their own features to attract different customers. This is quite prominent. And some brokers, they focus on international transactions, some focus more on derivatives, and some focus more on novice guidance, and some brokers will focus more providing API connections and interference to have some quantitative trading. So they all have their own features to attract different groups of customers. Otherwise, it's very difficult for them to survive. That is why we think that in the future, the next generation of online brokers must be a technology-driven fintech company. We all know that in the past 2 decades, technology has been developing very quickly and dramatically. It has changed our ways of living, have changed our way of transportation and living. However, in fintech, to some extent, I should say that no matter it's China, Europe, or the US, there's not much difference. However, there are a lot of good technologies such as machine learning, AI, and database. They're now available in the market, and I think that's going to impose a very heavy impact on our industry. For instance, the traditional broker software would focus on Hong Kong market. On the US market, you have similar interfaces, you're receiving similar news, but it's more or less the same. However, for Tiger Broker, we could analyze your behavior, and we would know that how long you have stayed in one page. We would know that you focus more on the Hong Kong market, US market. For instance, you look at Tencent, you look at Meitu, and I know that you are using it mostly during the daytime. And another guy may just tend to open the app at 9 p.m. You're looking at JD.com, you're looking at Google, and then I will know that you are more focusing on the US market. So when Baidu is releasing their financial report, we know which target group we should send this piece of information to. So different markets acting differently. So we would like to provide a distinguished and also tailor-made information to the users. So this is an example of machine learning. And there are a lot of technologies out there that we could tap into. For instance, we can provide better data information. When you are investing in the US market, I want to know the transaction record. I want to know about how much people has choose to put and call option. So this requires a higher requirement for your system. So compared with traditional brokers, we are a self-developed technology structure. For instance, from the top level, application for individual users, and to the bottom level, you have the order execution, the clear system. We have consolidated all the functions in our systems, and we're developing technologies by ourselves. We have about 200 engineers across the world, and over 50% of them are working on the technology. So we think that this advantage is not to help provide better information, we're also providing better experience. Because when we are talking to the US people, we found that the average age of the users is older than those in China. And some young people, they will hate a bad experience if the app cannot provide them with a good experience. So we have to grow very quickly, very fast. So as you can see that in 2 years' time, we have over 40 versions. In 2016, have like 15 versions, so that we would be able to provide a better experience from the bottom to the structure and all the way to the user experience. So you have a feedback complaining of not having a function, and in 2 months' time we will add that function in our app. So you can see that in some other similar applications that are quite popular in other industries, but it's not yet available in financial industry, then we would love to add that in our app if our users and customers require that. So we think that will be able to provide more convenience and a more efficient application to all the users who love to invest in the US and other overseas markets. You could easily handle your investment in 3 different markets with just one application, so that we'll be able to enjoy a higher return. Well, in China, usually we say that we use Baidu, Alibaba, and Tencent, and we are rising their revenue, and we're playing LOL and making and to let Tencent earn a lot of money. In the US, you could see that the market is also developing. Tencent's stock price is growing dramatically, and also the same case for E's Internet. However, who is really reaping the benefits is the big investors like SoftBank. And I would also like to send my gratitude to the investors of our company, including Jim Rogers from Wall Street Investment, and also we have the investment from Lei Jing, who is the CEO of Xiaomi.com, and also Wang Xing, the CEO of Meituan, and also we have K2VC and many other big investors. Over the past year, we think that China's market is just start to embrace the world market, and in 2016 we have a transaction volume of 120 billion, and we have a 30 times year-on-year growth. This is a tremendous achievement. That was why we were listed as one of the top 50 China fintech company by KPMG. So we want to do more than a broker. Private funding is just start to grow in China. There are some good investors in China. They want to set up their own hedge funds and their own private funds. But it's very difficult for them because they have to understand the regulation. They have to understand the laws and regulations overseas. So maybe we would love to help those investors to help them grow into the future Rogers. We want to provide tailor-made services for those investors to be a babysitter for them, so that they don't have to try and understand each and every detail of the law and regulations. We want to help them save time and money and just focusing on their investment strategies. We could talk to law firms overseas and also the service providers overseas, so as to reduce the cost of the private funds in China. We can lower down the threshold from 20 million US dollars to 10 million RMB for a hedge fund, so that more investors will be able to set up their own funds. And that concludes my speech. Thank you.
Thank you.
Thank you.
Thank you. So we explored earlier today one of those really great bubble terms at the moment, artificial intelligence and machine learning, and whether there's hype in that or not. Another key word that has been very prominent over the last 12 months since the last RISE conference has been cryptocurrencies in different forms. This is something that needs to continue to evolve and understand. So the technology behind cryptocurrencies themselves, the blockchain, continues to evolve and have a really profound impact on the definition of money, how it's used within business, and the world in large. So on our very special panel coming up next, we have 3 global thought leaders in this ever-evolving space. This is a space that continues to move at an extraordinary pace. The first is Yoni Asaya from eToro. We also have Sol H-Tite from Dianrong and Bobby Lee from BTCC. And I think I've butchered at least one of those 3 names, so my apologies. They are going to share their unique insights in conversation with Jenny Chen from Campaign Asia. Please welcome us on stage.
All right. Now I have three gentlemen who needs a new introduction, but who are actually from three very different blockchain companies. Now, Yoni looks at the investment potential and the value of Bitcoin and blockchain. Now we have Sol representing what banks and financial institutions can use blockchain for, and then Bobby, basically sort of a renegade Bitcoin native, the first Bitcoin exchange in China. So, as you can see, I am wearing this hat, Make Bitcoin Great Again. I am not a supporter of Trump, nor Bitcoin. I'm basically, on neutral ground. My job here is to ask questions.
Nice hat.
Thank you, thank you. I borrowed it from, one of them. No guesses who. Where is the hint? But this hat is a very easy opener to the question of, the reputation and the image of blockchain and the wider user adoption. We can't deny that blockchain and Bitcoin basically has an image problem. From the perspective of journalists, media, when we write stories, basically it falls into 4 different categories. Whether it's like number 1 would be either the criminal, shady dealings of Bitcoin using blockchain and using it to circumvent sort of mainstream systems. Number 2 would be like, oh, hey, this government is using, for example, Georgia and Singapore has started using blockchain, adopting blockchain to protect banks. Number 3 would be like, oh, hey, businesses and startups launching new products. So it's like at a product level, at this technology level. And then number 4, which is pretty rarely
in real time, it trades like a foreign currency, trades like a stock. So in that sense, it's been very popular over the last few years. And then this year, recently, of course, with the ICO boom, initial coin offerings, it's almost like people think of it as like IPOs for cryptocurrencies. So whether it's the altcoins or the ICOs, it's been a very, very big boom this year.
So you have a view about ICOs?
It's a personal view.
Yeah.
I don't think we need to solve a problem that does not exist.
Which problem is that?
So access to investors, access
to
capital. I think good companies will have access to capital. If anything today, we have a lot more capital than good projects. But that's a personal opinion, and I could be proven wrong in the future.
So you're saying that there's plenty of access to capital, we don't need the ICOs.
I'm saying, let's talk about China, for example. Every month I issue $500 million. I have $600 to $700 million of capital, and I cannot...
But that's debt.
Well, it sounds like debt to you, but to the small business owner...
There's an interest rate.
It is an interest rate.
So it's debt.
Yeah, sure.
Okay.
But to the small business owner, that's his funding that allows him to grow his business. So it's access to capital. What is that? What is his investment?
Well, there's debt, there's equity. It's very different.
I think, by the way, token sales are
yet different
altogether.
Complete
Paradigm shift for any type of financing. You can finance debt to something that you understand you can pay the debt with. What you see right now in ICOs are financing dreams. People write a white paper, crazy white papers. They're saying crazy things in the white papers, like buying sovereign land and making the government use their blockchain as the government, and are able to raise money for that. VCs can't invest in this. This is really not debt. This is the highest possible risk type of investment. But if one out of these dreams comes true, like Ethereum did, which was also an ICO, a token sale, it's amazing. It's just on a different scale. It's selling future revenues of a dream where you're in the very, very initial stage of that dream and you're just describing it. But I think it's valid because it's like Hollywood, right? Hollywood spends $200 million on financing a movie, and that's all we got. All we got is this lousy movie. This is spending $200 million in an ICO. Okay, so you paid $5,000 a ticket from 10,000 people, but maybe you won't just get a movie. Maybe you'll get a sovereign state run by a blockchain government. So
even you admit that is a crazy idea.
To answer that, not just Ethereum being an ICO, but the world's most successful and the oldest ICO is Bitcoin itself. In fact, the ICO has been running for 8.5 years. It's still going on. Every 10 minutes, you can invest in more Bitcoin.
I think I understand.
So this Bitcoin ICO has already spawned $40 billion of value just in the token, and multi-billion-dollar industry.
Wonderful. So I think
you don't like it.
Let's hear from Phil.
Let me answer from my personal point of view. I wouldn't invest in ICO for the simplest reason that I don't understand what's behind it.
But that's just you.
Exactly. I'm speaking for me.
Everybody's speaking a personal opinion right here.
I'm speaking for the market. Look, I like to build businesses that are within the common sense of what the majority of people know. I'll give you a simple example. There is a reason why the first product on Amazon was music and books.
It was books.
Because those products have a universal value. I know that book costs $20. If I can get it at Amazon at $16, I know what I paid for. But, and I'm probably touching a sensitive subject here, I don't like crowdfunding because I could be investing in the next Google, or I could be investing in something that's going to die tomorrow. So as a customer using the internet to access investment opportunities or to access buying anything, I would like to know what deal I'm getting into. But if you're talking about investors, they have a different logic. And I am not an investor. I build systems and products for the common people. So I have to do everything within the law, within compliance, and most important, it has to be super transparent. That's what I use blockchain for. I don't answer the question for investors. I answer the question for the simple person.
I think, again, it's a range. So that's exactly the point. Like, if we were talking, 150 years ago about the invention of electricity, you could have people arguing what is it good for, right? Eventually, it's good for so many things that we just need to understand that the baseline of this technology is as disruptive as that.
Yes,
because
that I very much agree with.
You can invest in dreams, okay? You can invest in Hollywood movies that might come to reality, and you can invest in real businesses and real solutions for supply chain management. Very, very different parts of the ecosystem, both becoming reality through blockchain.
Yeah, I'll add to that. It's really about choice. Just like there's debt financing, there's equity financing, there's token financing. Just like there's real estate, whether it's precious metals or stocks or other types of investing, you can put your money in bank accounts and get CDs and stuff like that. So what we're saying now is with digital currencies and the whole notion of Bitcoin and crypto assets, it's a new asset class. You now have a choice. You have a choice to put your money either in paper notes in a safe of a bank. You could put your money in an interest-bearing account. You could put your value in stocks, in real estate, in gold. Now you have a choice to invest in Bitcoin, Litecoin, Ethereum, or other ICOs. And I think the more choice people have, the more transparency people have, the better decisions they can make in terms of what their risk tolerance is and what their reward and gain requirements are.
I subscribe to what you're saying. Choice is good because today customers are well educated, they have a lot of information, they have a lot of knowledge, they can make the decision. I like choice. I am only arguing the level of transparency in an ICO versus the level of transparency when you buy something on Amazon. I have a simple question. I have investors, and I have to give them so much information about what their role does and what is the growth and the strategy before they can make that decision. Yes, they are making super large investments. How can you give the same level of information to someone who is investing a very tiny amount?
So in theory,
without making the information about the company public, which is the New York Stock Exchange and the Hong Kong Stock Exchange.
So again, in theory, not in practice, but in theory, that's exactly why you have the blockchain. So when you raise money in an ICO, and your money is all digital on a blockchain, and you spend it on the blockchain, you basically have an audit every 17 seconds of all of your financials.
I'm talking before you invest. What information do I have before I invest?
I think the level of transparency, so I invest a lot, and I love investing in tech stocks, and I invest in IPOs. I love investing in a lot of different things, so I'm using that choice that I have through the internet. And I agree that there's a lot of information out there for tech stocks, for any type of stocks, but it's still, for me, for example, to invest in stocks in Korea or even in China is still hard. Okay, the reports, financial reports, etc., are in Korean or Chinese or every place in its own language, usually not necessarily translated into English. It's in the local currency that I don't necessarily understand. Where when I invest in ICOs and in Bitcoin, blockchain-related projects, I actually feel that I do have a lot of transparency. It's still, by definition, high risk, but I think there is an interesting extra transparency when everything is public and debated in Bitcoin blogs and by finance geeks.
Mm-hmm. But this sort of bring the level brought up to non-finance applications, right? I mean, when we talk about blockchain is to finance like email is to internet, if you remember during the early internet days, it was only used for email, even though there are like 1,000 other applications, music streaming and all that. So right now it's still the same. We are now entrenched in this tiny insular discussion in order to, when you talk about having a choice, if I want to make a choice, I only consider it as a choice option when I trust that particular option. Right now, there is still no trust by perhaps regulators, by users, and it is a multi-decade problem. So unless we hit the point where we're able to persuade other industries, music copyright, creative industries, programmatic advertising, that's what we write about, to adopt blockchain as a technology that's moving away from just banking. Obviously, it's still not mature yet. Then we're able to talk about transparency and trust on a broader macro context. So the question is, how do we move forward? How would you sell? If you move away from investments and finance, and you move away just from trading, giving away the bitcoins.
How does society embrace it?
Yeah, how would you accelerate the acceptance by society?
To me, it's actually a big problem. It's a problem with education, meaning the fact that we have this panel discussion, the fact that we're still talking about Bitcoin blockchain, 8.5 years into it, it means that it's been really complicated. It's been really hard. The fact that we have this panel discussion, the fact that we're still talking about Bitcoin blockchain, what is the big deal with half years into it? With Bitcoin, it means that it's been really complicated. It's been really hard to understand. And the vast majority of the public a long time. Don't really understand what is the big deal with blockchain, of electricity, or the discovery of electricity. There just weren't that many use cases. And unfortunately, it's taking a long time. I think even 8 years, 100 plus years of electricity, the discovery of electricity, there just weren't that many use cases. Other than the 100 years, everything will be blockchain. So today, 100 plus years after, we have everything. Well, but there's the humanity will give it 100 years. Everything will be blockchain and digital currency. This is a really, really big deal. But there's the humanity will go on.
TCP/IP, the foundation of internet, took about 30 years.
This is a really, really big deal. 40, 50 years into it. It'll take tens of years. So
TCP/IP, the foundation of internet, took about 30 years.
Yeah, it's we're 30, 40, 50 years into a TCP/IP. So we're only 8.5 years into blockchain and Bitcoin.
I have a different point of view. Evaluating you can't find a single bank today that does not have a team working on blockchain. The fact that people are evaluating the technology, they are working on it. My opinion, fintech companies all around the world, the real economy, the fact that blockchain attracts all these people is like the real economy is what we do every day, and this is again personal technology to make it real economy. If we deploy the other economy, in the real economy is what we do every day, and how I can use technology to make it better. If we deploy it completely in the real economy, you will see adoption much faster than 8 years that Bobby is talking about. Of course, if we come up with a completely new economy, in our customers have to understand concepts that have never it is very severe. It makes the adoption very difficult. Companies have, in our case, we focus on supply chain finance, and it's because it is a very severe problem that both core companies have and small suppliers do have. And it's easy for us to explain that, look, if you are on this blockchain, you will get funded anytime you want. Blockchain is not as fast as it's supposed to be.
I just quickly think the best way to increase the speed of adoption is if simply more people actually do invest in Bitcoin, in Ethereum, in the existing crypto. Market cap reached 100 billion. If every person interested in it, people here would just invest in it, the market cap will reach 1 trillion and the world will simply change faster. So it's really about us deciding we want to see this technology progressing faster, we're investing in it, the value goes up, more companies get funded, and the world moves faster.
Oh, great. You have a supporter there. But any of your personal views and attitudes sort of representative of the markets that you play in, you know? Because there's a lot of this cultural underpinning to the adoption. When you talk about having a single use case, concentrating on a single use case of blockchain first and then slowly expanding it out, but you can see that Yoni is very risk appetite is much higher than for Seoul, for example. It's a different...
Sorry, I'll play the devil's advocate on this panel. We're still going to be friends tonight.
We're out of time, so we should wrap up.
Okay, 3 minutes. 1 minute.
So gambling uses some of the best algorithmics in statistics and probability. It's not by building more casinos that we're going to make the gambling industry big and it's going to help us achieve dreams. That's one model. If we use statistics and probability and all the genius that is coming from the gambling industry, we can create solutions for the real economy. That's the point that I'm trying to make. Science can be used in multiple ways. It's not about forcing one side versus the other.
Okay, so my final thoughts are, I encourage all of you to get yourself more knowledgeable and learn more about Bitcoin, blockchain technologies, and digital assets. I think it will do well for your investment portfolio.
Great. Thank you very much, gentlemen. Give a big hand for Yoni, from eToro, So from Tianrong, and Bobby from BTCC.
Thank you.
No problem, it's good work. Thank you. Thank you. Thank you. So far today we have gone the lengths and breadths of fintech. We've explored topics including AI, machine learning, regulation tech, the important role of agents through that ecosystem. And now we're going to bring a lot of that together with our final session of the morning section, a debate. And this will be talking again about AI and will it determine the future of the financial services space. For a long time, traditional banking and finance have relied on algorithms. But yet it seems now we're seeing new claims about the role of artificial intelligence and how it will go through and define the future of FS. Do we believe the hype? Will AI ultimately go through and take over everything and determine the future of the financial services space? Well, in this last session, the debate, this very point, we'll start welcoming to the stage Douglas Merrill from Zest Finance and Melissa Gutzi from Arbor Ventures. And the debate will be chaired by Zila Chan from TVB Pearl. Please welcome them to the stage.
So I can imagine a more awkward setup, but I'm not sure how we could do it.
I don't get a podium.
You don't have a, you want mine here?
No, I'll stand in the middle. Okay, hi guys, welcome to our panel discussion. My name is Zela Chen. I'm with TVB, the largest broadcaster in Hong Kong. And we are doing a debate on artificial intelligence will determine the future of financial services. Now, can I just get a show of hands of who agrees with this? Artificial intelligence will determine the future of financial services. Hands up.
That's an uncommitted vote. Like everyone took, Zila had to call 3 times for anyone to raise their hand.
It was 40%.
Maybe. I'm not sure. I think it's.
Okay, so a show of hands of people who disagree with this.
Raise
higher.
Don't be afraid.
Okay, just a few hands. There are a lot of people who are undecided in the middle here. We'll see if our speakers can change your mind. So arguing in favor, we have Douglas Merrill. He is the founder and CEO of Zest Finance, a fintech company that uses machine learning and data science to help lenders make better financial decisions. And before that, Douglas was the CIO and VP of engineering at Google. And over here arguing against, we have Melissa Guzzi. She is the founder and managing partner of Arbor Ventures. She has more than 25 years of experience as an entrepreneur and a venture investor in Asia and Silicon Valley. So, Pro goes to you, and you will have to convince those undecided people in the audience.
Yeah, perhaps. So I think ultimately it's a little bit the wrong question. I think we're probably gonna talk about lots of random stuff, but hopefully at least it'll be compelling, because I think we're probably the only thing standing between you and at least lunch, if not the bar. So we'll try to be fun. I mean, it's interesting that I'm arguing pro AI in financial services, because I think to first order, machine learning has had no impact on financial services. I mean, there are, maybe outside of fraud and program trading, but by and large, nobody who's not a client of ours uses ML to make loans. There's almost no automation of servicing. There's almost no automation of risk management, risk capital computation. Like, actually, generally speaking, ML's a little bit small beer in the financial services world today. So the argument that I would have to make is not only is it going to be important in the future, but going to be important in the future in some reasonable time frame. I mean, historically, AI has always been the next big thing and will always change the world. I started doing this in the 1990s, and as of yet, Google notwithstanding, it's not clear that it's changed the world much anywhere. So the question that you should ask yourself is, where is there stuff that people do that doesn't actually uniquely rely upon the things that people are really good at, as opposed to stuff that people do which actually we're not that good at. We're not that good at seeing trends. We're not that good at kind of doing mathematics. We're not that good at being super repeatable. But we are really good at seeing images and parsing intangibles. Like, I don't see a world in which there are a lot of human VCs, or AI VCs. That's a Freudian slip, sorry. But I do see a world in which there's a lot of AI in lending. So, like I say, will AI be the future of financial services? A, I don't know, and B, I'm not sure it's the right question. But it is clearly the case that the world in 5 years is going to look a lot different, technically and process-wise, than it looks today.
Okay, well, let's back up here and go and...
Hang on. That's not fair.
Please go ahead.
No, let's just back up and do the groundwork for this, because we do talk a lot about chatbots, robo-advisors, machine learning, cognitive computing. So what exactly are the benefits of using AI in banking?
Well, I'm not sure it's any of those things. So,
oh, come on, chatbots are great.
Okay, chatbots are fine. All right, fair. I like that, yeah. Ask Microsoft. Like, Tay worked out really well for them. Come on, for those of you who have your phones out, do a search. TAY, Microsoft. Be a good learning experience. Come on. So, ultimately, AI is the idea that you can take knowledge from the world in the form of formal propositions or in the form of syntactic data, do some grinding on that to yield a recommendation. That recommendation can be, oh, hey, you should invest in X, which is like the core chatbot for financial services. It could be, hey, you should loan to this person, which would be the core output of one of our models. But what you're trying to accomplish is you're trying to specify the way a behavior should occur and then build a system that makes it roughly logically entailed that that will occur. It's a pretty broad suite of things, but we have clients that use our software to make loans, to do marketing, to decide who to call in collections, to decide on risk capital. Like, I mean, there's lots of different things that you can use ML for in a financial services kind of thing. But what's interesting sort of is a lot of technology companies, particularly in China, are doing really interesting financial services things as well. So the space is quite broad.
Okay, let's get Melissa in here. You're arguing against artificial intelligence will determine the future of financial services.
Melissa's like, no, I'm not. I'm an investor in Miss Data.
Yeah, we're an investor in AI, so pretty hard to argue 100% against AI. But I think what I do argue against are companies or AI companies, and then ultimately they're not really using artificial intelligence, they're barely using big data. And what does big data actually mean? We were having this discussion earlier, but I mean, I think, fundamentally, AI's been around a long time. I mean, Airbus flies by wire. That's artificial intelligence to a certain degree. You just have to make sure you land it on the runway and not in the water. But it's still AI. I think it's been around a long time. I think one of the negatives I'll argue against right now is there's just too much hype around it. And when you go to do due diligence on companies and you look at what they're doing, you're like, you're using one variable or two variables. Tell me why that's artificial intelligence. That's just, basic statistics. So I think we're not against AI by any means. Will it change the world? It'll change the world sometime eventually to a certain degree. But I think if you take certain industries like robo-advisors, there's not a single super successful robo-advisor that's a startup. Why? Because they need such tremendous scale. And is predictability by using artificial intelligence as artificial intelligence exists today better than predicting by the index? It hasn't proven necessarily to be true. So I think you have to take where AI is today and say that AI is not necessarily going to be replacing everything in the world immediately. AI 5 years from now, 10 years from now, you won't find anybody more excited about it than myself. But we need a reality check. What's AI? What's deep learning? What's machine learning versus, some basic R that most of us could do without getting a degree.
Oh man, you brought up deep learning. You can't speak the name of the devil or she'll appear. No.
All right, this goes to you, Douglas. So you have a fintech company, and earlier in the year you launched a machine learning platform for your clients. So how does it work, and is it a game changer in financial services?
I certainly hope so. Because otherwise it's kind of a big waste of time.
But see, that's the key thing. What is game changer? So define it, right? A game changer meaning I can eliminate all humans, I can eliminate 50%. So I think that's one of the keys, and actually, Doug, it'd be great. How do you guys actually define game changer when it comes to AI?
Thank you for the high-hanging curveball. What a great question. So our clients use the XAML platform, some to do marketing, which is basically, if you will, do account management, decide to whom to mail. Several use it for underwriting to decide to whom to make loans, and there's lots of other stuff that gets done. We have Baidu is a public client of ours. Baidu tripled their approval rate overnight of their loan product from going from their very good model to the XAML platform, which enabled some stuff that they couldn't do. So I think that's a game changer, but not enough. We have two of the top 5 largest credit card companies in the world are clients, one of whom discovered $100 million in loss reduction. That's material.
Okay.
But not everywhere. Like the point is, I believe actually most people who say they're doing AI are really just pushing A or B, and that's probably not going to have that big an impact, right?
That's right.
So what do you guys think? There was a recent tech article that claimed that ignoring artificial intelligence, financial services firms will fear losing 40% of revenues to fintech rivals.
Wow, what a precise number, 40%.
It was an algorithm. That was really predictive.
Strong. I suspect the error bars around that 40% are roughly 39.
39.
No, I think the article is more just if existing financial institutions ignore the innovation around fintech, that they have a risk of losing 40% of potential revenue. But sure, I mean, any industry that's been around a long time that doesn't innovate has a chance of losing all of their revenue. So I don't think it's necessarily related to AI by any means. It's just that if you get too comfortable and you think that you can continue to do things the old-fashioned way, or just offline, or just and not use technology, then you're going to be obsolete. But I don't think that's necessarily specific to AI. I think that's technology in general.
I mean, back in the 90s, it was a truism amongst consultants that you go to a financial institution and say that within 10 years, the word bank will only be a verb. It will not be a noun, right? Like everyone should wander around saying this. And it turns out that so the notion of bank being a noun is that they're branches, right? It turns out now, 30 years later, they're still bank branches. There's this artificial precision around this piece of technology or this piece of innovation is going to drive this vast change. Well, probably it's not. It's probably a whole bunch of small things, but ultimately, let's set it right. Like if you don't grow and change over time, you die.
Yeah.
So do you think the banks are a bit slow on adopting these technologies, artificial intelligence, digital transformation in general?
I mean, I think banks exist in a world where it's very hard to adopt AI, where it's very hard to adopt machine learning, where it's very hard to adopt big data, because of sort of, kind of capital computation worlds and regulatory worlds. It's very, very challenging to go in and say, oh, we're going to completely change the way we model our risk, and so our Basel III, balances are going to change. Congratulations, regulator, have at it. Like that's a painful conversation. In the United States, it's very hard to say, I'm going to completely change the way I underwrite loans, and here's the risk value. And those are hard conversations. It's a little bit unfair, right? The playing field is totally tilted towards fintech companies at the expense of banks, but ultimately, the large multinational, multi-product financial institutions are going to have to be engaged in ML if it's ever really going to matter.
What do you think?
I mean, I think you're right. I mean, Doug brought up a really good point. The banks are somewhat hampered by regulation. When you think about fintech, this is the other thing I love now. It's not only fintech, it's tech fin. So somebody will someday explain to me what the difference is. But the fintech companies aren't bounded by the same regulation as the banks. So if you're thinking about a bank and you want to use alternative data sources, I mean, one of the first things that comes to their minds from a compliance officer perspective is, am I actually allowed to use that data source legally in that state, in that country? And so I think the banks have been sort of hit hard as to they're not moving fast enough, but they're also bound by a significant amount of regulation around the world. I would say this, I think they're doing a much better job now of setting up these fintech labs. They're getting data sets that are organized ahead of time that they can then reuse and actually see how startups can use those data sets. And so I think they're learning and becoming more progressive as what they can do within the regulatory sandbox that they have to live within.
Mm-hmm. All right, so earlier you said that there's a bit of hype around artificial intelligence, especially this year, right?
Just add .ai to your name and your valuation goes up by 30%. And it's not that dissimilar, I'm dating myself, but not that dissimilar to the .com back in '99, but if you add .ai, 30% premium today for your startup.
Arguably the best business is actually the domain registrar for .ai.
Yeah, thank you. That's a good idea.
We should have done that.
That's tonight. That's tonight's exercise.
So this year especially, there's been a lot of articles and press around AI. So is that all fake news, you think?
No, come on. No, there's no such thing as fake news. There's news. Everybody has a perception of what's fake or real. Maybe AI can help sort that out. But no, I think in all seriousness that there's certain things like autonomous vehicles where we're clearly seeing where AI is going to play a very important role, especially in VR, because you're going to have to determine whether something is crossing the street. But yesterday I saw a great picture from Matt Dill at Visa, which he showed a blueberry muffin and a chihuahua. And he had this matrix of pictures. And he said, can you tell the difference between a chihuahua and the top of a blueberry muffin? Mm-hmm. And in some instances, it was very hard to tell. So I think, one of the things about AI is that we just also have to be realistic of where it is today. But with that said, there's some absolutely tremendous companies getting funded. My only issue about the hype today is that exactly what I was joking about is we're an AI company for this or that. And then realistically, when you start to do due diligence, there's not anything AI that they have, but they actually are just sort of on this hype trend. And I think, like all venture markets, hype starts, lots of money flows in, money will flow out. We had drones a little bit earlier, right? We had, virtual reality. This is the typical flow. But I think right now we are in a hyped market for .ai.
All right, so Douglas, how smart is AI right now in 2017? And how smart does it need to be?
You're an ex-Googler. You got to answer this realistically.
Really dumb. Really, AI is incredibly dumb. It's humorously so.
Yeah.
So in the late 1990s, there was an AI program called Mycin 2, which was a program, the notion of which was you'd give symptoms to it, and it would predict whether or not you had a small set of bacterial infections, which seems like a really small, really easy problem, and it was beautiful. A guy named Doug Lanatt came up and described his car. The question was, without telling you, the question was like, what color is it? Well, it's kind of green. Does it have spots? Well, yeah, it's rusty, so it's got spots. Is it making wheezing noises? Like, well, yeah, when you turn it on, it sounds horrible. So he got the mice and two to diagnose his car with smallpox, which is humorous for two reasons. One of which is humorous, and second of which it's not a bacterial infection. Leaving that aside. So, and in some sense, that's still true. I mean, if you look at the state of the art in vision work is generalized adversarial networks, and they generate those sort of 2D pictures with the matrices between them. And it's actually pretty surprising how you've got hundreds of millions of neurons in the back of your brain devoted to just object recognition. You'd think that would be redoable in a computer, and it turns out to be pretty hard. And vision is, I think, the uniquely smartest thing we've got in ML, because the way we do it doesn't have anything to do with the way humans do it. We didn't try to do it the same way. Language generation is really hard. A woman released a hilarious neural network that she trained to produce like fortune cookies, like aphorisms, and so she gave it thousands of fortune cookies as a training corpus, and it came back with a bunch of answers, including ones like cow before sun. Okay, I don't know what that means, but my personal favorite was, when death comes, it will come alone. That's actually kind of plausible. That's probably true. I think AI is remarkably dumb, but the problems we've attacked so far, and attacked incredibly well so far, are things where being dumb is good enough. Where I don't know how we get to is when you have to get really, really smart. So like I take cheap shots at chatbots, a little bit for fun, and also because to really do that well, people have weird things they do in communications. There's pauses, there's like, all these sort of second order signals, right? Like when Melissa started hearing me, she looks down, right? That's a common human signal. You look down. How do we do that on chatbot? I don't know. That's hard, but we need to do that. So I think we're pretty dumb. I'm excited about the runway.
I like chatbots because you can actually get something addressed on off hours.
Fast.
Right. I mean, so yeah, they may not be the smartest thing, but at least, I don't have to wait for a human being to get on the phone.
And for what they're good at, they're great.
Yeah.
So when is this future reality supposed to happen? We all hear the hype out there, right? That it's all going to be run by machines. They're all smarter than us. 50 years, 100 years, 200 years?
What is happening? I mean, it's not going to be we wake up tomorrow morning, it's a light switch, and the world has absolutely changed. It's incremental. But just think about this, is that today a computer cannot even do what a 2-year-old can do, which is recognize their mother's face from another one, right? So specifically. So computers can't do exactly what a baby can do today. So that's the wonderful part about what we do, is we're in the early phases of progression to where AI will eventually go. That's the exciting part about it. But we're still in the early phases of it. And so therefore, you just have to understand that you can't completely rely upon it necessarily today, but it will progress.
Okay.
I mean, I think none of us are excited about our robot overlords. So I think probably that there's no one who's going to vote in pro robot overload. But I think Melissa just got it right. Like, when do you want to work? You want to work in a field where the answers aren't obvious, like where it matters what you do every day, and that's where ML is.
All right, so it sounds like this future reality is quite far off in the future.
Well, I guess that depends on what you think future reality is. I mean,
and far off.
Or far off. I mean, that's right. I think we are in a period of AI development, a rapid AI development, but that doesn't mean it stops. I mean, tomorrow innovation will happen, and great technologists will continue to innovate and iterate. But we're really at the beginning of it.
Okay. So final thoughts. Douglas first.
So I'm hoping that all of you who didn't vote up front at least now have an opinion, or feel brave enough to vote had we asked, whichever one it is, shyness or lack of opinion. I mean, ultimately, we're asking the wrong question. The right question is, how can a computer do something which helps make your life better? I think all of us in the industry and on the entrepreneurial side, on the VC side, would say, if you have an idea, if you've got some place where you think technology would do a better job than human, go found a company. There's a lot of innovation to go and a lot of value to be created.
I couldn't agree more. Innovation will change the way healthcare is delivered, financial services are delivered. But it's going to play an important role, and it will help a lot of lives as we go forward.
All right, let's see if you guys change anybody's minds here. So we'll do a final vote. Show of hands, artificial intelligence will determine the future of financial services. Did you convince more people?
Job. No, it looks like I unconvinced people.
They went the other way, I think. So, okay, so who agrees or disagrees with this? Artificial intelligence will determine the future of financial services. Show of hands.
Maybe
wow, we're about the same.
It's a wash.
Yeah, we got to work on this one, I think. All right, thank you guys.
Thank you.
Douglas, Melissa, thanks for your time on stage. Thanks, guys.
Well, thank you, everybody. That draws to a close our first session for MoneyConf. I hope we've all found it informative. It's been a key area to go through and understand that this is changing and that the focus needs to continue on value. We will be back here in 20 minutes. See you then. Enjoy the rest of the conference.
Good afternoon, everybody. And welcome to the afternoon slot at Rise. Welcome to the MoneyConf on stage. We've got a great afternoon for you today. We've got some really interesting speakers coming up from Zhong'an, from eToro, from JP Morgan, and of course from my own organization, HSBC. Just a short introduction. I'll be with you through the afternoon. My name is Andrew Connell. I look after the digital group for HSBC in Asia, but also the innovation and partnership group globally for our retail and wealth bank. My background is actually a host of jobs through telecoms, not banking, and then my own startup in the US, and then I stepped into the finance industry because I thought it was one of the places where innovation was yet to happen. There was a huge digitization that was being driven by consumer behavior that was super interesting. And in the last 2 years since I've been here, we've invested almost $1.7 billion at HSBC. We've hired hundreds of new people. We look for startup mentality, the ability to really operate at a global scale, and really that mentality of thinking about the consumer first. So we're very proud of the changes we're making and the people that we've got with us today. And I think through the various panels, you'll see many of the topics that we're passionate about within our own organization. The session today is all about creating the next great fintech concept. And we've got two great speakers to kick us off, Kari Kalaja and Melissa Guzzi, from City Fintech and then Arbor Ventures, both of which got great experience in really going from that first idea, whether it's a scrap of paper or sitting in the back of a garage, and trying to take that through to reality. They're going to be joined in a conversation with Melissa Hekolia of TVB Pearl, and they're going to come up and now share with you all of their perspectives on what it really takes to make one of those ideas a great reality. So please give a warm welcome to them as they join you on stage. Thank you.
Thank you, Andrew.
Okay, well, welcome to the Money Conference stage. As he mentioned, the next big concept in fintech. Now, Kara, you are working on the Bank of the Future, and Melissa, you're investing in fintechs here in Asia. For you, how do you see the Bank of the Future?
That's a big question, Melissa. Yeah. I think many of us have different points of view of what the Bank of the Future is. But when we start to anticipate where we want to go as an organization, and specifically in Citi, I mean, there's no doubt that the disruption that has happened in each of the sectors of financial services has caused us to reimagine the type of company that we need to be, particularly with our global footprint. And part of that is, and you've heard a lot of this, is understanding what the customer needs are and really working from the outside in. But it's also trying to imagine what the world will look like 5, 10 years from now when money starts to become invisible and transactions that happen in our day-to-day life that we habituate now become transactions that start to notify us that they've happened or give us pre-warnings before they happen, before they actually do. I think Uber's been an example of that, where there's no friction at all in what happens with money exchange, and we see that evolving not just in the payment space but in the wealth services space as well. Insurance, you've heard a lot of that from Ping Am of what's happening there, and anticipating what that is and building towards that is part of our objective.
Okay, Melissa, you've looked at a lot of fintechs in Asia. Is WeChat the bank that we're looking at of the future? Is that kind of how we're going to be developing?
So we'll step back just for a minute, and we asked ourselves last year, because every year we try to challenge ourselves to think about what's going to change about the future. And so we asked ourselves about what are the largest populations in the world today. And what's interesting is that only 3 are countries that are defined by a government, a reported GDP number, or a geography. And the rest of them are now social networks. Mm-hmm. And so then you start to think about how these social networks start to transform services and even banking or insurance and wealth management. And so if you then take it one step further and you say, what's the largest bank in the world today? It's WeChat. And then take that beyond and say, what banks, 3 banks have 1 billion customers? It's Ant, WeChat, and Uber. And now we're seeing the rise of non-bank banks. And so that's how we think about things. We think about the macro level. How is the world changing? How are we redefining ourselves as societies or for different services? And so as we think about that, then we start to think about how payments start to change. They're now borderless. We start to think about banking services. We're going to see the rise of non-bank banks. And so we think about it in this context, and then we look for, startups that can actually change the world according to how we already are changing it.
So if it's about who owns the relationships, whether it's aggregators, social media, what then happens to banks? Are they just utility companies? How do they evolve to be more than that?
You want me to answer that one?
You can go first. I'll let you go first.
Well, I'm actually going to comment on what Melissa had just said. Is part of the recognition of being a large institution that's been around for 200 years is when we started, banking was a destination. You had to go to the branch to drive an interaction, to do a transaction. The reality is it's not. And I don't foresee it being in the near future. And so when you look at those populations of where are consumers, where do they live their lives, you have to find a way to be there with them. And part of that is unbundling the services that you have. Other aspects of it, it's really starting to challenge us to say, what is the additional value we're going to create on top of what's being commoditized? Because it is being commoditized. And so part of the investigative approach forward is really deepening our understanding of is there disruption in certain experiences with startups that we need to partner with, and sometimes it's without having the big brand, and it is about white labeling or co-branding, and then where are others where the consumers really do trust the brand, and we need to show up, and I think in a more obvious way, but we need to figure out where to be where the consumers are and adding value on top of that network.
Sorry, go ahead.
No, I think it's a great question, and the way we thought about it, if you think about some of these challenger banks, they've been really good at getting early adopters, and they can get a couple of thousand, maybe 20, 30,000 accounts, but that doesn't build the next city. So then we thought about, okay, these challenger banks, are they really being successful, or are they just they're still sitting on top of somebody's rails because of regulation? So they're an aggregator of small groups of people. But then you turn your attention away and say, well, wait a second, Square is going to start a bank, Square Bank, and you have Uber. So maybe these non-bank banks are not the challenger banks, but maybe there's their aggregation of flows. And where do they go eventually? I think they'll get some banking licenses, but I think, to the point is that at some point, as they get scaled to a certain size, they're going to have to deal with the regulatory environment, and then I think they end up partnering with the large institutions who understand a lot of these aspects. But I don't think banks go away. I think we see the rise of non-bank banks and these partnerships. And I think that is clearly the difference between FinTech 1.0 and FinTech 2.0. 1.0 was all about, we're going to kill the banks. In FinTech 2.0, it's about partnerships. And so that's how we see it.
Yeah, I will add to that. I was in Dubai about a couple months ago, and one of the gentlemen on the panel that I was facilitating was from TransferWise. And he had got up and he had talked about the importance of partnerships. And if any of you remember some of the TransferWise marketing media events that they had where it was down with banks, I definitely took the opportunity to call them out on looks what's transpired. And the reality is if you really want to meet the customer's needs, you've got to find a different path forward. Because just like Melissa said, that you've got Clarity Money and others that literally have created 200,000 accounts in the first 3 months. But where's the business model? Where's the economics? And how do we, from a regulatory perspective and the things that we do really, really well, partner with them to actually deliver what's needed?
Okay. If you do, let's say this partnership happens between banks and non-banks. Are we going to see other services growing, say the robo-advising area? Is this something that you see as a huge growth area? Is it going to be a premium or your kind of standard level service? And is this something that you as an investor are really interested in, or do you see maybe some downside to it?
Go ahead.
We do not invest in robo-advisors. And here's the reason why. It's really simple, is that you need at least 40 billion of AUM to become relevant in the world of asset management today. And if you take Wealthfront and Betterment, two fantastic companies, What are they at? 8 billion today. It's a long ride. And plus, if you look at their valuations are way ahead of where they are from AUM to become really sizable. And we have not seen terrific exits in the robo-advisory space. So as a venture capitalist, I don't like the space for investing today. It could change. I think AR and VR may change that space completely, so I'm there. But do I think that robo-advisories are, the service is incredibly important for established asset management firms and banks? Absolutely, it makes total sense. And I want to just separate, sometimes there's great investment opportunities for venture capitalists. Sometimes it doesn't make sense for a VC from a return perspective, but it absolutely makes sense for a large institution from a technology adoption perspective.
Yeah, I would second that. I mean, it's a spectrum when we start to, I mean, first of all, you look at robo-advisory. There's robo-advisory and there's robo-investing, right? And you do have to separate the two. I mean, the Betterments, the wealth funds of the world have a combination of each. Robo-advisory, I look at some of the new technologies, whether it's artificial intelligence or other aspects, where how do we start to engage with our consumers further upstream? So when you look at managing the funnel, typically the large institutions and the banks are only there when a transaction needs to happen. The reality is consumers have started to get accustomed to in other industries of trial before using, trial before engaging in a relationship. And so our belief is we have to figure out how to engage with them further upstream as they're making those critical decisions in their financial lives. Part of that is around new entrants into investing and doing it in a way that's simple, doing it in its way where there's not a lot of downside and a lot of risk, and doing it in a way where you can educate them along the way. But it is a spectrum, robo-advisory versus handheld, white glove, private wealth management. We will always have that spectrum. I think our goal is to figure out what's going to meet their need depending on where they are at a given time.
Right. I mean, we had talked a little bit earlier about how banking is really becoming borderless. In this sense, where do you look for inspiration when you're thinking about how banking will evolve and how fintech might evolve?
I mean, I'll briefly touch on that. I mean, I look, so I'm a big believer in reverse innovation, where, and particularly being an American and in the US, I think there are many times we're very myopic about what's happening in the States, happening in the rest of the world. That is absolutely not true. I mean, you see it here in China, you see it in Africa, you see it in India, where they haven't had the boundaries or the limitations of what has prohibited us to be innovative in the States. And so a lot of what you're seeing in these emerging markets where they have an opportunity to potentially leapfrog some of the traditional services is very inspirational for me. So looking outside and figure how do you take that in? How do you look at pay-as-you-go services in the banking sector like you've seen in some of the emerging markets? How do you think about showing up in these large ecosystems where we don't have that in the States? I think becomes very, very relevant to what we need to do day in, day out.
Mm-hmm. Yeah, I think on the inspiration side, it's removing your own boundaries of your own mind, right? I think, we challenge the team constantly and ourselves to think about what is next, what is possible, where do we go in a borderless world of transactions, a borderless world of how we now interact on social networks. That drives the future. And so I think if you can remove those borders, then you can start to think about what is possible and actually what is happening, and we're seeing it as we speak. I mean, cross-border e-commerce, $1 trillion with 1 billion shoppers by 2020. Who would have thought that 5 or even 10 years ago? And so I think our inspiration comes from these changes, and then we try to think about the startups that can serve, the new world we're going to live in.
Mm-hmm. The other thing I would add, Melissa, too, I think it's looking at other industries, at least in the financial sector. So if you look at the media sector, if you look at the e-commerce sector, if you look, there's all these other industries that have gone through a similar transformation like the financial sector has. And with media, it was, buy a big bundle and consume everything. And then it completely became fragmented and you could pay as you needed. And so inspiration, I think, needs to come from seeing what's happened before that's not necessarily in your industry. It's completely outside.
Right. Do you see a lot of, obviously there's a lot of innovation in China. Are there a lot of interesting fintechs that you see there and ideas coming out?
It's not only China, it's everywhere in the world today. I mean, I think China, if you look at the alternative lending sector, they redefined the boundaries of alternative lending. I mean, Lufax is by far the largest in the world. And then you look now at the wealth management aspects of that. So they've taken alternative lending and and mirrored it with wealth management. That was not done in the US. So, you know, there's a great example where China led the world. China has led the world as far as payments go. I mean, the fact that digital wallets, you can leave your house and you don't need a wallet. You can use your WePay or WeChat account for everything. So I think China has clearly led the way, and partially that's to, you know, the government has been very forward thinking to let these industries grow up without tremendous amounts of regulation day one, and then come back in and regulate as necessary. But I would say it's not only China. We're seeing a lot of innovation now in Southeast Asia. I think that will continue. And, you know, if you think about Japan, no one thinks about Japan necessarily as an innovation center. They're the world's leader in Bitcoin, and you know, as far as regulation goes. So regulation happens all over the world. As an American, I would say at some point in my life I had that issue as well, but having lived here now for over 10 years, you know, innovation in financial services, I think, is driven more outside of the U.S. than inside the U.S. today.
Is that because these emerging markets precisely don't have a lot of these regulations? So you can foster these new ideas, and then as you see them growing, put down regulations when you see them needed.
I think its legacy infrastructure doesn't exist.
Yeah.
I think, you know, you know, just if you take the infrastructure, if it doesn't exist, you get to create it new. You get to build it on the latest technology at the lowest cost, and you can build in SaaS models from day one. I think the U.S., the infrastructure has existed for a long time.
Well, and the infrastructure and the risk that has been associated with that, you know, good or bad, with a lot of the security fraud and, you know, and money fraud that you've seen happen around the world. But I will say part of the issue is, I mean, regulation can play an amazing role in driving innovation. It's when you're regulating before the issue happens, where you're actually regulating out innovation. When you do have some of these emerging markets and you get to create net new and you have a broader net of what you can create, and then it's controlled, you know, where you're not putting society at risk, I think becomes really important. But you look at Estonia, you look at Dubai, you look at places where the government, India, played a role in driving a digital identity. And you've seen just this incredible acceleration of what has happened in the financial sector because of that. I mean, that's fantastic regulation that serves a purpose.
You had mentioned, both of you had mentioned digital currency, I think, or you had mentioned digital currency. Do you think that this is the way it's going, and are we moving towards one currency, or is it just all currencies digital on one system?
Oh, I don't know. I mean, who could guess that? I think the innovation that's going to be interesting is that the blockchain is simply a new database structure with messaging built in, and I think what we're going to see is new database structures emerge that will probably replace the blockchain. But the fact that you can think about a database structure in almost a three-dimensional way with messaging built in is an interesting innovation. But I couldn't guess about cryptocurrencies, but they're here and people are trading them, and so it's part of reality.
Okay. Any last words on the bank of the future or the next great innovation in fintech?
You know, I'm not going to comment on the bank of the future because it could be so many things for so many people, but I think that we are going to see a heavy emergence of the incumbents playing an active role in partnering with those that have disrupted us. And Melissa said it earlier, where you have these single use case providers and they do it really, really, really well, but what transpires is they need either more capital structure or they need to build new services to go the full end of what a financial kind of offering would be for a consumer or for a business. And so that partnership, I think, is what is going to be part of defining what our future is.
Okay.
I think we're in one of the greatest periods of innovation that we've been in the last probably 30 or 40 years across the world, and I think that's only going to continue. So to say it's one particular sector would be shortchanging another, but we're extremely optimistic about what we're seeing.
Okay, great. Thanks a lot, Carrie and Melissa.
Thank you.
Thanks.
Thank you. Well, that was great, wasn't it? I love Melissa's comments about China. Certainly, I think the role of regulation there and the way that fintechs have been able to start has been something that has helped speed the growth that we've seen there, and something that we've been trying to also tap into a little bit with HSBC and our growth there. The next topic is a fascinating one. So the insurance industry has often been referred to as one of the slowest moving industries for years. But now that technology and insurtech is really taking off, there's a really big debate about whether that's going to go even faster than the fintech industry could with the provision of data, etc. So we've got a great panel for you today. We've got representatives from both investors, incumbents, and startups. So please join me in welcoming him to the stage. Wen Zhu from Jing'an, Jing Wu from Qming, Frank Devine from AXA, and all going to be led by Pamela Ambler from Forbes for a fascinating conversation around insurtech. Thank you.
Good afternoon, everyone. We are talking insurance and machine learning. It's not exactly the sexiest topic when it comes to technology, but as most of you know, insurance, the industry generally doesn't get a whole lot of opportunity to have positive interactions with the consumers. But with the advent of machine learning and artificial intelligence, it's changing changing the way the industry is working now and how that process is when it comes to dealing with the consumer. And so maybe we can start off with Zhong'an Wayne here. Wayne has a personal injury to his left foot. He came on stage earlier with a walking stick, but maybe you can tell us about the process of how AI is changing claims for your customer and maybe for yourself.
Okay, thank you. So as Zhong'an is actually the first online insurance company in China, so we are actually an engineering-driven company. We treat artificial intelligence, machine learning as a very, very basic capability, and we have been using that to keep optimizing our business operation in different perspectives. And as Pamela just mentioned, this claims is definitely one of them. We categorize that into better user experience. Like what we are doing right now, so I have an injured leg. So in China, so we still don't have a back office connection between insurance company and hospitals. So we still need to process a lot of hard copy, and we have been using this machine learning process to do fraud detection, to process this hard copy into digitized information. This is one thing. And there's a lot of the other idea about better user experience, like we are providing image recognition so that the user don't need to come to our branches. Well, actually, we don't have branches. We have to do everything online, for we are having this online license. So we know our customer based on image recognition, so for better fraud testing, for better user control. So these are the application areas, and we also have the other area, keep optimizing our pricing process, and we have been using machine learning to try out new products, which is very important, so that we can start small and let model to do the rest.
With AXA, AXA has, unlike Zhong'an, is not just online, and you have been around for a very long time. So for a company your size, of your scale, how do you try to incorporate and innovate? Is it different in your different market segments?
Yes, absolutely. So at AXA, we are protecting 103 million of customers in 60 countries. So when we definitely want to improve and deliver a superior customer experience, we think at artificial intelligence to speed up the process of claims. This is one of the initiatives that we are launching in many different countries. We also look at fraud detection, so using machine learning, artificial intelligence to look at how the correlation between different claims and how we could potentially also speed up and identify where are the fraud to reduce the price for the customers. We are doing in some countries some telematics also projects, so which is related to artificial intelligence as cars are becoming autonomous. We also try to change the behavior of our customer. So talking about health, we are launching in Hong Kong well-being coach app that is today managed by a physical coach, but that will be replaced by step by step by artificial intelligence and a chatbot. So chatbot, fraud detection, artificial intelligence to deliver a superior customer experience.
Jing, you have been looking prior to this at a sort of fintech, lending tech, and now you're looking at insurance tech as a sector as a whole. You had mentioned before that this is kind of an early stage of startups kind of and corporations moving in this direction. What's your observation so far of the assessment of this industry?
InsurTech is actually part of the larger fintech movement. The fintech movement started about 4 or 5 years ago, maybe even earlier, globally. It started from the more advanced countries, and then it becomes very big in Asia Pacific, especially China. But if you look at the data, if you look at the investment amount across global, since 2016, you can see the number that in the US, the investment into insurtech companies have surpassed the traditional fintech, the lending tech or the wealth management related to fintech companies. So they have become taking the larger investment amount from investors. However, in the Asia Pacific, it's just starting. InsurTech is still just starting, and lending tech still takes a larger share of the investment money. We have, at Qiming Venture Partners, we started looking at the broader fintech space about 4 years ago. We've invested in several successful lending technology or wealth management companies, for example, Cashbus, Wacai, and WealthBridge. And we started looking at InsurTech about a year and a half ago, and we definitely see the opportunity is big for the industry, because we think the time is right with the advancement of the mobile technology and the data accumulated through the internet, as well as the advancement of machine learning. Time is right for technology to transform the traditional insurance industry. However, I do see there's a lot of challenges for startups to really make it big in this entire space. For one thing, if you compare with the lending technology or the previous generation of fintech companies, if you look at China from regulatory point of view, it's tougher, it's stricter. There's stricter requirement for startups. First of all, you need to get a license to be able to offer insurance product, and it's very, very tough to get a real license. So for startup companies, so that is different from the lending technology, because in the initial several years, government just let the startups grow, and without issuing any specific regulation. And the startups had these opportunities to grow big. And in the meanwhile, the government learned how to regulate this industry. But for insurance, because this is a special industry, it's related to people's health. There's a lot of requirement from a regulation point of view. So I see that there's a lot of innovations across the value chain, from precisely targeting customers, from product design, from claim processment. But for startup really to grow big, there's a lot of challenges. And for one thing, it's regulation. The second thing is, of course, the larger companies and traditional insurance companies, they are also eyeing for the opportunities. For startups, it's a better strategy to work with those companies, but at the same time, if you, at some point, it might cap your future growth potential. So we are still learning about this industry. We hope that we'll find some good startups to invest on the insurtech space.
But you did mention it was the same case for fintech. When that first started, there was also no policy in place. And so given how new this area is, you actually, or companies or startups have the possibility of helping shape the policies.
It's a little bit different because in the first several years of lending technology, there wasn't any clear regulation, but there wasn't any forbidden for you to do things, for startups to just launch products and then grow and then try to comply with the regulations that came later. But for insurtech, from the beginning, there are certain things you cannot do. So there's stricter regulation from the beginning.
On investing, with ZhongAn, you have a very different structure. You have some big backers, Alibaba, Tencent, and Ping An. We heard a few people from Ping An on stage today talking about the innovations that they're doing. How much of a collaboration is there between you and the technology companies?
I would say there's a lot of synergy. So directly from our shareholder, we get a lot of support so that we share the vision at the very early stage. So we actually formed the concept of insurtech in China. So we proved that this scenario-based insurance can actually work. And based on this concept and the business we have been running, we have been building our core technology platform, including the core system, the big data analysis system, the fraud detection system, which is purely optimized for this scenario-based insurance. So that's our starting point. And I still think there's a lot of synergy between online insurance company, insurtech company with technology platforms for insurance can't really sell by standalone. So we are cooperating a lot with the scenario providers. So for us, we are trying to provide a flexible enough agile product development process to do better pricing. And we still want to work closely with our partners to really understand their scenario, to really understand their customers, so that our products will be really customized for this scenario, for this group of users. I think that's the biggest difference from between online insurance and traditional ones. The traditional ones is more like you develop a very standard product and try to sell it in different channels. That's totally not the case for the insurtech-driven company.
Frank, you mentioned at AXA you're working about a dozen different initiatives in utilizing machine learning and the data that you have, which I imagine you have a lot. But where do you see the most opportunity?
Well, I think that the next wave will definitely come from the solutions innovation, the type of products, the type of solution that we could design specifically for our customers. Chatbot being one of the channels that we are addressing more and more, because people are requesting a lot from chatbot channels. We do collaborate with Messenger, for instance, in France. But the claims process, the automatization, the way we could speed up the claims process will be definitely overtaken by something which is new about what kind of risk we could protect that we could not protect by the past. So I will take you an example. If we look at sharing economy and how sharing economy is transforming the way people behave, it gives you an idea on the way for us insurance company we need to reinvent the way we are protecting customers. So if you don't own your car and if your car is autonomous, what will be the risk that we will need to cover, and how we could help you accessing to this data, how we could help you to be more well protected.
So it's a more customized offering, and so people are actually shopping for insurance instead of being sold insurance. Is that the idea behind that?
Yeah, but I think that shopping insurance could look like a pain point, right? So in some countries it is mandatory, so you have to buy a car insurance product for your car. But here I'm talking more about something which will be fully contextual, meaning that you are shopping something, you are buying something, and then the products, the insurance solutions will come contextually with this product, as you are doing, guys, very well in China.
With about a minute and a half left, in the news today, recently it's been reported that ZhongAn is going to have a Hong Kong IPO of $1.5 billion. That's a significant amount of initial public offering. Given you already have the financial backing, what was the decision behind going public?
So we have been running the business for 3 years, and the InsurTech concept we have been backing has been proven via a lot of businesses. So I think this IPO is, on one side, it's more for, it's a signal for this InsurTech. We think that's a signal that China will be having this arena for this InsurTech to grow up. And for us, we are moving from this scenario-based insurance to more and more the other product lines. And for us, we also need a marketing brand. So that's basically the rationale behind it.
And really quickly, Jing, so from your assessment, seeing that InsurTech has a future of public offerings and larger scale opportunities, is this a very bright outlook for InsurTech?
There are definitely opportunities. Of course, for startup companies, it's probably I see two specific areas that I will think will give startups enough room to grow. First is channel-related innovations to leverage internet and new technology to distribute, to reach customers directly. That's one thing. And the second one is to work as an enabler, to work with larger traditional insurance companies, provide technology, become the technology provider. So those are the two areas that might be more suitable for venture capital firms like us to work with the startups.
Great. Well, thank you very much, Wayne, Jane, and Frank. Thank you.
Thank you.
Thank you very much. That was a fascinating conversation, wasn't it? To get into different perspectives from the players in the industry. Again, China gets raised as a place where things are being done slightly different. And I think that's very true, and is obviously, for all of us that are based here in Hong Kong, is one of the things that we think about a lot. So our next speaker is no stranger to me. He works for the organization that I work for, HSBC. And Daryl and I work actually very, very closely together in terms of collaborating to bring our technology and our business teams together on almost all of our areas where we're trying to transform the organization and build new ways to both outreach to fintechs and third parties, but also on transforming some of the core technology areas to make it stronger for our end consumers. The kind of things that we've managed to do together, just instead of this being big company blah blah, in less than 12 months we built a wallet called PayMe in Hong Kong, for those of you that are familiar with that. It's been a phenomenal success for us. It's growing very rapidly, and that was really a great collaboration in terms of bringing in people who had startup thinking and mentality and bringing that to build a product in a modern way to then launch into the marketplace. We've got another one called Smart Save, which is currently in pilot phase, which again we're trying to speed through. So I'm going to introduce Daryl in a second, but first of all we're going to just run a short video showing some of the work that we're doing.
We are living in a time of rapid digital change, where the only limits are the scale of our ideas and degree of our dedication. The technology ideas of today will be the intuitive habits of tomorrow. Never before has innovation promised so much, touching so many in so many different ways. Our frontier is financial technology. It's changing the way we work, make money, and the way we trust each other. To succeed, we need to adopt the mindset of the Silicon Hubs of the world and create an incubator of free thinkers, thought leaders, innovators born of collaborative spirit, all fueled by a belief that technology will enhance our customers' financial lives. To imagine a future beyond what we already know, creating a team with the power to transform the world's leading financial enterprise. We are technology.
Good afternoon, everyone. Wow, thank you. Nice welcome, thank you. So good afternoon to all of you here in the room and also to our friends watching on the HSBC Facebook live feed. Probably be millions of people out there, who knows. It gives me great pleasure to be here this year at RISE, with HSBC being a platinum sponsor of this amazing conference, this RISE conference here in Hong Kong. I've been at HSBC now for a couple of years, and I have the privilege of leading an awesome IT team that is at the center of an amazing transformation, working collaboratively with the business to transform HSBC into a simpler, better and faster bank, one creating great customer experiences. So what I'm going to talk to you about today is how we're doing our transformation, how we feel about startups and fintechs, and at the end I'm going to wrap up with some advice for those of you in the room who are from a startup or a fintech. Now, I don't think HSBC needs any introduction really, but for those of you who don't know that much about how a business operates, we are present in 70 countries and territories. We have 4,500 physical branches around the world, 37 million active customers. Those customers range from individuals to small businesses to small and large corporates and governments. And 45% of our clients have an international presence in some aspect of their business. So in terms of our presence in the markets where fintechs are alive, we're very much in those markets. Now, I thought what I'd do is just to get some definitions right about what a fintech really is. So I'm going to steal the definition here from an excellent report that's just been published by Ernst & Young. It's the Ernst & Young FinTech Adoption Index report. And here they have a definition of what a fintech actually is. So an organization that combines innovative business models and technology to enable, enhance, and disrupt financial services. Now, clearly, they're talking about not traditional players like us. And the thing that we always challenge ourselves with at HSBC is, why can't we behave like a fintech? Why can't we enable, enhance, and disrupt our own business model to improve the customer experience? Now, this fintech industry has been booming in the last decade, and I'm using some material here from Boston Consulting Group, who have been a fantastic partner with HSBC over the last few years. And they have a service called the FinTech Control Tower, and they study the whole evolution of the fintech market globally. And you can see here from this presentation from 2005 to today, it's been a massive growth, going from $6.8 billion in 2005 to well over $100 billion of cumulative investment in fintechs today. And you can see the migration from data analytics right through now to the more recent developments in crowdfunding, marketplace lending, and increasingly more in e-payments, and some emergence in blockchain as well. Now, that 107 billion is spread interestingly in this fashion. The North American market still seems to be the place where most of the investment is happening. You can see 30 billion in payments, 20 billion in lending and crowdfunding. We have the EMEA group somewhat lagging the US, and APAC is coming up fast in second position, with most of the growth in the last couple of years coming from Asia, with 22 billion. And it's interesting to see that of this money, 95% of it is coming from venture capital companies. The BCG report also shows where this money is being spent in terms of sectors. You can see retail, corporate banking, and small and medium enterprise finance is where most of the money has been spent. Although more recently, in the last couple of years, we've seen massive growth in insurance, capital markets, and in pure tech plays in the areas of data and analytics, security and biometrics, and infrastructure. Now, the E&Y report talks about adoption rates. So when you look at this report, the way they've done this is they've surveyed 22,000 digital natives that consume services online across 20 countries, and they've measured adoption rates. So an adoption rate, an adoption is basically if somebody uses a new fintech service twice or more in 6 months, that registers as an adoption. Okay, so this is the statistics that they've been reporting from 2015 to 2017, and they've asked the respondents where they think it's going in the future, over the next 2 or 3 years. And you can see in all of these core markets that we operate, payments, savings and investments, financial planning, insurance and borrowing, there's a massively increasing adoption rate from people who are operating online. So clearly this is a massive issue for an organisation like HSBC. We have 37 million customers globally operating in all of these markets with these types of services. And we're finding that the fintechs are starting to get some serious adoption rates with their products. So we have to be really mindful of what's happening here. The BCG report, and I agree with it actually, it talks about the bank of the future and how it will be architected and what sort of commercial assets we'll need to be able to function. So at the customer interface level, you're going to have highly mobile interfaces. We now have a mantra within HSBC of everything is mobile first. We're developing all of our services and customer journeys with the mobile in mind as the first channel. There's clearly going to be more interfaces with social networking. We already have built our links with WeChat in China, for example. And there'll be more bionic customer interfaces with chat and robotics at the front end as well. The products and services the banks will be offering will be very much based on marketplaces. Yes, if the lending and deposit products will be in a marketplace type environment with an open API architecture. We're going to have more contextualized solutions using big data and artificial intelligence to provide better experiences for customers in real time using what we know about a customer. And at the infrastructure level, we're going to see much more robotics. There'll be no paper. There'll be no passwords. Biometric know your customer will become standard. Cloud computing solutions and architectures will be commonplace, whether it be on-prem or with the cloud providers. The banking industry globally is moving towards an open API architecture, which is clearly both a challenge and an opportunity for HSBC. So with this set of assets in mind, we then thought about asking our own customer base what they thought about the trends in technology. So I'd recommend you go to this URL. It's a free report that we've just published, which was an extensive survey of 12,000 customers across 11 countries, which really asked our customers globally how they feel about technology, what's their level of awareness, their propensity to adopt technology, exploring how they feel about new entrants into the market, and some key top technology topics like AI and future innovation. So this is a free report. All of the startups and fintechs here, I recommend you go and read this because there's some actually very interesting learnings that you can have about our customers. So what are our customers telling us? Well, it's a very interesting fact, so I'll just sort of throw out here to give you a flavour of what the report has covered. So 68% of people trust each other naturally until proven otherwise. But when it comes to using technology, there's still a fair amount of reticence to use technology to do the most basic things, like opening up accounts, bank accounts. Although customers believe technology is really key and important, it's actually something they're still not quite sure about. So an education is required here. Interestingly also, people think that security is actually just as or more important than how we manage their money. So clearly thinking about how we secure the services is really going to be very important. Some parts of the world still have old technology. Apparently in India, 39% still have a pager. Who's still got a pager here? I don't. On new technology, China seems to be leading the world in the speed at which new technology is being adopted. On security, what we found is that 70% of our customers still rely on traditional passwords, and they still don't really understand the biometrics, fingerprints, iris scanning, voice ID, these things which are now becoming available to customers. They're still not quite sure about that. Clearly under geography, east meets west, you have 40% of our customers in China using fingerprint technology. And the big takeaway is the need for education. Once you explain to people what biometrics is, we saw that their understanding and propensity to use it tripled. But actually 69% of people never heard of a robo-advisor, so there you go. And these are all interesting things. I think the key takeaways and what we call the path to high trust is really the conclusion of this study, which is interesting for us and for fintechs to really grasp, because trust is critical to banking. Trust and confidence in what we do is really paramount to our business. And I'd suggest for startups and new businesses as well, you've got to really build a high level of trust and advocacy for your product. So it's things like investing in education, bridging that gap between people's adoption of the technology and what the technology can do, and educating people, working with the various channels to raise awareness of how to use the technology. A thing called kite marking, which is allowing the product to have a label given to it to give it some credibility around security and resiliency. There's various standards organizations around the world. In the UK, they have a program called Cyber Essentials, which gives a brand to a product to show that it has the very standard and basic and reliable security measures around the product. So these types of brandings are quite important. Obviously, simplified interfaces. I mean, it goes without saying that if you design a customer journey that's very functional, very performant, and leads the customer through a journey in a seamless way, it'll be very easy to build trust in the product. I think the biometrics and behavioral security points that I mentioned before are going to become much more important. If you can build a product that's integrated with this biometric approach of doing customer authentication, you'll have much more trust in the product. And the last key learning was regulation. Interestingly, 75% of the respondents to the survey said that they would welcome high regulation from the banking regulators and the financial services regulators to assure that the products that we're delivering are actually safe and reliable. And clearly that's a challenge for fintechs and some of the startups who aren't yet regulated in the same way that the banks are. So I recommend you take this away and read it. It's a really great piece of work, and one that we've had fantastic feedback from our customers. So therefore, what does this all mean? Well, of course, this picture is actually not HSBC. This is all of our competition here in the middle. The hippos, the slow-moving, not very fast-moving, not very innovative people. And what's happening around this traditional provider of financial services is a whole range of fintechs and startups that are really eating away and challenging our value chain. So we need to respond to this, and we need to learn from this. The other challenge I have is actually implementing technology in a bank. So if you're a fintech startup, you'll know the bottom part of this picture is very simple. You create your app, you put it in the app store, and within a few days or hours even, you've got it running on a client's mobile phone. The journey internally in a company like mine, 150 years old, some of our banking platforms, 40, 50 years old, very robust and reliable, but old technology. And we are constantly, daily, riding this dragon called legacy software, okay? Where we're building all the channels. We're building all the channels, and they look fantastic. We've got to get it interfaced back into these core systems that has all the data. And you can see here the trail of dead bodies of project managers that actually try and ride this, this sort of dragon of legacy tech software. So this is a big issue for us. It's a challenge for us. So how do we respond to that? Well, we are transforming the way we do things in response to this to be more like a fintech, actually, with a culture of fast-paced, customer-focused innovation. So first thing we're doing is we're changing the way we deliver solutions. More like a fintech, we have adopted company-wide, and I think this is an unprecedented transformation in terms of the size and scale of our company. We have the whole company now talking about agile and doing agile methods. We used to be, a very traditional waterfall approach to delivering solutions. It took a long time, very cautious. Now we have co-located multifunctional teams. We have state-of-the-art software delivery tools to have this continuous integration, continuous delivery type of delivery. So it feels very different. If you came and visited my team, you'd find that it feels more like a fintech startup environment than it does a traditional enterprise and certainly a bank. So we're doing all of this in scale across the whole company, and it's making a massive difference to our speed of delivery and the quality of the software we're delivering. Cloud first, well, this is the typical picture of the evolution of data in a big enterprise like HSBC, where you start up with the good old-fashioned databases and your traditional data warehouses on-prem. Then we, a few years ago, created this Hadoop ecosystem on-prem, had difficulty standing that up and getting it all working. we've sort of come to the conclusion that actually the best way to solve this problem is to partner with the cloud providers. So we have active partnerships now with Amazon, with Google, with Microsoft, and increasingly with the cloud providers here in China as well. So this is as I said before, a fintech jumps straight to the cloud picture. They don't have to worry about all this other stuff. And we are solving some of the critical business problems using these technologies and partners. So these are 5 use cases which I've talked about in other fora, where we are taking massive data sets that require very intense compute capability and producing business outcomes that delivering huge value. We can't do any of this type of stuff properly if we try and do it ourselves on-prem. So once again, acting like a fintech, partnering with the cloud providers is delivering real value. We have a network of partnerships that we're developing, an ecosystem, if you like, around the world. We have an amazing partnership here with Astri here in Hong Kong, where we work with them now for over a year or so now with in AI, biometrics, blockchain, cyber, and data analytics. We're a member of the Alan Turing Institute in the UK, which is a data science consortium put together by the UK government to do data analytics for social awareness and social good. And we're building, as the slide shows, a series of labs in the major innovation centres around the world. So I think this is really quite key, because we can then stay in those hubs of innovation where the fintechs and the startups are really challenging our traditional business model. We've also assembled a very impressive group of people called our Technology Advisory Board. So you don't typically find people with this type of background in a bank. Yeah? So we thought, well, the way to actually keep close to what the fintechs and the startups are doing and the leading edge thinkers are to assemble a group of advisors in key areas like blockchain, AI, e-commerce, machine learning and data science, some venture capital, which I'll talk about in a minute, cyber, and open banking. So these folks are all part of this advisory board. We meet with them regularly. They consult with the management team, and they work with our board of directors as well. So I think this has been a great innovation for a company like HSBC, which typically has been more insular than looking out on the outside. And this has been a great innovation, much more like a fintech would behave. Now, as well as changing our technology, we're also changing our ways of working. So I showed you a video at the beginning of the type of culture that we're trying to embed within the company. And what I say to everyone in the bank is, I'm running a large tech firm within a bank. Yeah, the bank has over 200,000 people. The IT function has over 40,000 people. Okay, and we need to run our business like a fintech. It needs to be fast-paced, innovative, using latest tools, with a culture of people that actually want to do things in a fast-paced, innovative way. So there's a whole range of things we're doing around creating manifestos, training our people about how to lead and behave more like a fintech. Where the rubber's hitting the road is in retail banking. We have a range of things we're doing in these core areas. Andrew mentioned earlier we've been very successful with our e-wallet PayMe here in Hong Kong, which was launched back in February. And we have a similar program running in the UK with the SmartSave application. And all of these areas of focus are exactly the areas where the fintechs are nibbling away at the hippo. Okay, so this is an area we are very focused on. We've organized ourselves like the fintech. We have a site here in Hong Kong in Causeway Bay where if you went to that site, you would see us working there. It's just like going into any sort of fintech environment. Very fast-paced, innovative, business and IT people together, standing things up, using agile methods, very, very different to a traditional enterprise model. So what have we done so far in total? I guess the other thing that we should mention is we do have the capacity to take equity stakes in startups and developing technology businesses. And the areas of investment themes are on the top of this picture here. So, and over the last couple of years, we've made some equity investments in some of the areas that are mentioned on this page. So we are actively investing. We're typically, we can be at a very early stage right up to Series C, Series D, pre-IPO funding in any sort of company that we feel has strategic value. So we're a strategic investor. It's not a passive investment. We would invest in a company that has a product or a service that we feel we can ingest into HSBC at pace and really help us transform our company. So a strategic aspect to the investment, and we have a big appetite for this. And the other things that are on here, we've been implementing biometrics with Touch ID. We have now voice recognition in our call centers. We have robotics happening in the back office and lots of customer interaction as well. So things are happening. It's not just all marketing. There's real things happening. Customers are seeing the result of the transformation. So I'll finish with just a piece of advice. We see fintechs as potential partners, and we welcome the competition, frankly. I think it's very healthy to have these people thinking, challenging the way we do things, making us feel, I think, very differently. But I think if I was in a fintech, this is the type of things I need to be thinking about. So going back to the Trust in Technology report that we published recently, you've got to build some way of getting advocacy for your product. So building trust in the product is really important. And there are various channels that if you're a startup, you'd have to work with those channels to get your product, accredited the right way to make people build that trust in using the product. Very statement of the obvious, but so many people do lose sight of it. Keep focused on the customer. Customer focus is absolutely critical. Talk to customers, talk to consumers in the space that you're operating, really understand their pain points and go after those pain points at pace. Patience is a virtue. I know some people probably think that we're slow moving, but we are a regulated business. We have processes actually and controls because we're a regulated business. So we can't just go and deploy a piece of software to live and hope that it works and test it in live. If my customer channels have any issues, all the journalists here will have Twitter, and they'll be onto the Twitter feed straight away saying the mobile app is down, the desktop is down, and after about 30 minutes, if I don't get it fixed, it's going to be on the banner of Sky News in the UK. So this whole thing about regulated businesses needing controls does frustrate startups and fintechs, but you have to understand that in our business, it does require a steady approach to implementing things. I suggest you find a friend, meaning a systems integrator. I have partners with all the major consultancies, the systems integrators, and they do a very good job of introducing startups and fintechs to us as a company. So align yourselves with the SIs would be a good way to start getting your networking going. I know many people who are entrepreneurs. They're very passionate about their product. When you sit down and you pull it apart and tell them how bad it is, they get very offended. Okay? My advice is be open to feedback. Don't be too sensitive, because that feedback will make you a much better entrepreneur. So be open to the feedback. And the last point is it's pretty obvious, but you need to engage with business leaders and tech leaders in companies like mine, because we are very keen to engage and learn and partner and collaborate. That's all I have to say today. Thank you very much for attending, and I hope you are all HSBC customers. Thank you.
Thank you, Daryl. So, you can see a little bit of what we've been up to. It's been a busy 2 years in our business. I think to Daryl's last point, sometimes the pace looks slow from a distance, but when you step back and look at what's happened over a 2-year period, it's really very significant. So we are very open, and we now have an infrastructure which is designed in order to be able to talk to other startups or later stage businesses, and we're very interested in those. Now, there's a bit of a, for those that were waiting for the banking as a service session, that's now going to run a little bit later at 3:45, but it's still on, so hang around. And then this is a bit of a first for the MoneyConf stage now, and we're delighted to welcome Yoni Asir onto stage. He's going to, from eToro, and what he's going to do is actually introduce you to a new release that they're doing, which is a cryptocurrency copy fund, and hopefully do a demo for you there. So it's a new thing for this stage, so I'd like to welcome Yoni on stage and give him a warm hand. Thank you.
Hi everyone, I'm Yoni Asir, the CEO and founder of eToro.com, the world's largest social trading network. I'm super excited to be here on stage and do a product release. We're launching today our crypto fund, which is the easiest way in the world to invest in the top 6 cryptocurrencies in the world. With one click, a user of eToro can invest in Bitcoin, Ethereum, Ethereum Classic, Ripple, Dash, and Litecoin in an allocated portfolio that we create and manage for him. Before I dive into the product demo, I want to give you a couple of minutes about eToro. Then I'll walk you through our product and through our new copy fund. eToro's vision has always been to open the global markets for everyone, trade and invest in a simple and transparent way. We're a global brokerage where people can trade stocks, commodities, indices, ETFs, currencies, and cryptocurrencies. We believe the world of financial markets should be open for everyone, and people should and could invest in the global markets. When we started the company, we realized it's not only about access and a great user experience, which we focused on, but it's also about learning how and when and why to buy the right financial asset. And around that, we've built a social network for traders and investors. So every user on the platform automatically publishes all of his trading activity, and everyone in the network can see, follow, and copy top traders from all around the world. Copy trading is basically money management 2.0. When you copy someone, for example, if I'll find a trader from Germany who's investing in tech stocks and cryptocurrencies, let's say 10% in Google, 10% in Facebook, and 10% in Bitcoin in his portfolio, and I look at his performance and I see that he's generated 30% return in the past year. You can see all of the track record on eToro. When I copy him with $10,000, it automatically allocates those $10,000 exactly to his portfolio. And every time he trades, it trades at the same proportion, the same time, and the same price in my account. So if he'll generate 30% returns in the next year, I'll make $3,000 on my $10,000. And as the World Economic Forum explained it very nicely, social trading platforms basically offer effective means for individuals to sell or share their investment expertise and competing with traditional investment managers. This is not only for retail investors from all over the world. This is also now for investment managers and investment professionals. We recently launched our Copy Funds product, which I'll show later on, which enables investment houses and investment professionals to set up their own trading strategies on eToro and open them for the global markets for everybody to copy their portfolios on the internet. eToro today has over 6 million users from more than 140 countries. We've transacted to date on the platform more than 220 million trades, and we have 370 employees worldwide through Israel, Europe, London, Russia, China, and setting up now in Australia and Latin America. We've raised to date $62 million, our last round from three of the largest financial institutions in the world, Commerce Bank from Germany, Sberbank, the largest bank in Russia, and Ping An, the largest insurance company in China. And since then, we've started expanding globally. Our platform today is in more than 12 different languages, and we're servicing clients in different languages from all over the world. What I'll do now is I'll do a deep dive into the platform. I'll show you everything that we've built within eToro. Of course, it's a cross-device platform. You can trade the global markets. It's fast. It's on your mobile. And if you get bored while I speak, you can simply, on your phone, download it through the App Store and download the app and register while I bore you. And now I'll move to the product. Can you switch to the product, please? So what you see here is actually my stats. So every person on eToro has the same profile that everybody on the internet can see. You can actually see that I've generated 158% returns over the past 12 months. You can see my returns, and I can jump into my portfolio. Again, it's public. My own account is public for everyone in the world to see. You can actually see all of my investments across all of the different asset classes that I'm investing in, including, as you can see, a lot of the copy funds in eToro. what does it mean that we're a social trading network? It basically means that this is a social network where I can follow markets or people. So if I jump now into the watch lists, you can see all of the different markets that I'm following on eToro. Google, Facebook, Bitcoin. You can see that I'm also following in my watch lists different people. If we'll click my watch lists, you can see a lot of different watch lists in different categories. Now, each of these people or markets have their own page. So if I'll go up and, for example, click the Google one, then every market in eToro has a feed. So you can read what people around the internet are saying around Google. You can see, by the way, in the feed, people from different countries are sharing information about the Google stock. I can see the chart of Google easily, and in the chart I can also do easily technical analysis and share my technical analysis with others, and I can even see research on the internet of what our analysts in big banks are saying about Google, the price targets, and get from here information about Google and analysts saying about Google. Now, if I go to my news feed, it's basically the feed to get updated about the market. So I build my different watch lists on eToro, and then I can read my news feed of people talking about Apple and Amazon and Bitcoin and Ethereum and the people that I'm following and appreciate their trading strategies, and I can see that they're talking about what's happening in the market. Without looking, I'd be guessing a lot of people are right now shouting and screaming what's happening to the price of Ethereum. And basically this is how I get updated. So I have Facebook to look at kittens and babies, and I have my eToro account to see what's happening in the financial markets. So how does it work? How do I operate in eToro? I can go into trade markets, and in trade markets I can actually see all of the different markets in eToro. You can see on top in trade markets you have cryptocurrencies, ETFs, stocks, indices, commodities, currencies. If I'll click on stocks, you'll see that we're constantly adding more and more markets from more and more exchanges around the world to truly open the global markets. And it's always easy to buy and sell with one click of a button. You just click on an asset, click on an amount, and that's it. The uniqueness, though, of eToro is really about copying people and seeing what people are doing. So if I go to the discovery page on eToro, I'm able to see, just like I'm seeing the markets, I'm able to see people's portfolio from all over the world. This is like an app store of investment managers. You can see people where they are, you can see their percentage of gains over the past 12 months, and for each of them, I can drill down like I showed you in my profile, and I can see their stats. I can see this guy from the United Kingdom generated 148% returns last year, so far generated 21% returns this year. I can see that he has 500 copiers. This means he is managing money for 500 people under our portfolio management license. So we're an asset manager, and we outsource the research, basically, of the investment strategies to the crowd in eToro. I can go down in the stats page to see also different, the strategy and different statistics about what he's doing. You can see that he's doing 3 trades a week, and that his holding time is about 3 weeks. And I can actually see the internals of his portfolio. So if I click portfolio, I can see that right now he owns Apple, Google, Facebook, Netflix, etc. And at any point in time, if I simply want to copy him, all I do is click copy, and just as simple as buying a stock, I just choose an amount, for example, $1,000, and I click copy, and that opens all of these trades directly in my account. People a lot of time asked me, how do I choose who to copy on eToro? How come I generate these results? And the answer is I cheat. I have a quant team in eToro who actually runs machine learning algorithms to find the right people to copy. And that's how we build the discovery page. We wanted to help people actually make money, so we've built machine learning algorithms to look at all the hundreds of thousands of portfolios on eToro and pick the best ones. And last year, we've actually built a product out of it. We call it the Top Trader Copy Funds. And you can see here, this is basically a copy fund which automatically copies for you. So you invest in a copy fund, and that copy fund invests in the top 100 traders of eToro based on machine learning. So if we click into the active traders copy fund, you can see the performance over time. And if I go to the portfolio, you can see that the beautiful thing is it's a highly diversified portfolio of both stocks, commodities, indices, ETFs, because what you do here, you're investing in 100 different people that are investing in the market for you. So we've collected basically the wisdom of the crowds, and using machine learning, we wrapped it to make it simpler for people to get exposure into the global markets. And if I go back into the copy funds, you'll see that we didn't only build the top trader copy funds, we also build the market copy funds, which also take the wisdom of the crowd, and what it does, it actually breaks it down to specific themed investments. So for example, if I go into the big tech, a lot of our users are investing in technology stocks, the most popular segment of stocks in eToro, but a lot of them don't necessarily know how to pick and choose technology stocks. So we've built a big tech copy fund, which basically looks at all of the data of the users, picks the top tech stocks that our users are investing in, and then with one click of a button, every user in eToro can now get a portfolio of all the top tech stocks on a market cap weighted average in eToro. So this is a brief intro to eToro, and what we're launching today is our cryptocurrency copy fund. And over the past 6 months, we've seen a huge rise in the value of cryptocurrencies, specifically Bitcoin, and even more than that, Ethereum, which went from about $10 in February to $400, and now everybody's complaining because it went down to $200. But what we've built with the cryptocurrency copy fund and the crypto fund that we're launching today is we'll build a simple way to actually invest in those cryptocurrencies. So everybody are looking at this as a new asset class, but for most people, investing in cryptocurrencies is extremely difficult, especially if you want various cryptocurrencies, because for each one, it's a different wallet, it's a different technology, it's a different way to secure your private keys. A lot of the small exchanges might have support for a lot of different cryptocurrencies, but they disappear with your money. Okay, so eToro is a large financial institution, a regulated entity, and we take care of all of that for our users. This cryptocurrency copy fund is investing on a market cap weighted average on Bitcoin and on Ethereum. You can see it generated 93% returns since late April when we launched it. And what we're launching today is the crypto fund, and for the first time on eToro, we're actually launching more cryptocurrencies. So we're launching on eToro basically a way to invest in the top 6 cryptocurrencies, which are together about 90% of the market cap of the cryptocurrency space, which was 100 billion, now it's about 80 billion. If you can show the crypto fund, Jasper? Just search for crypto fund. Jasper, managing director of eToro China, where we have 40 people and growing our business in China. Just search for crypto fund in the search tab. So the new crypto fund basically lets you invest in various cryptocurrencies. You can see the breakdown here of Bitcoin, Ethereum, Litecoin, Dash, and Ethereum Classic. Obviously, over the last couple of weeks, the new cryptocurrencies in general went a bit down after there was a huge spike up of 4,000%, which, in my opinion, not investment advice, might be a very good opportunity to tap into the market. So this is a new product launched today on eToro. Thank you very much, and happy to see you as our customers.
Thank you, Yoni. All right, you're halfway through this afternoon's session, and I've been asked if you would mind standing up, which I'm sure you don't after you've been sat down for an hour. The later sessions, there's people going to be coming in from the side. So if you see a seat towards you this way, could you just kind of shuffle in, and that will enable people to come into the later sessions just by the side. So if you can come in a little bit, that would be great. I was sitting listening to Yoni and just, I think the last few sessions, data has been obviously one of the key things that has tied together many of the speakers. And the transformation of the businesses that's being provided through data and those insights. And I was reading a book by Seth Stevenson called Everybody Lies, which is a fascinating thing. They've looked at all of the Google searches and then the contemporary normal research when you ask people questions and the difference between those two things. And it's quite profound in terms of consumers' behaviors. There's a big piece on the US election and who said they'd vote for Trump versus not, and then who did. But then it goes into lots of other things. Our next session actually is all about data. It's about big data, and it's really about how the trends there are enabling us to change the way that credit and credit information is being used. We've got a great panel here of 3 practitioners from the industry: John Sun of Avant, Jing Zhou of Dumio, and Kenneth Lin from Credit Karma. They're going to have a conversation now with Isabella Zhong from Barron's Asia and really talk about what trends they've been seeing coming through that industry and how we can really, for consumers, start to really provide where it should be enabled and how that's being led by the way new big data trends are happening. Thank you. Please welcome to the stage.
Thank you.
All right, thanks for the introduction, MC, and good afternoon, and welcome to this panel on big data. So, big data where credit is due. So let me quickly just reintroduce my speakers. So to the left, to the right, I have Zhou Jing, CEO of Beijing-based Dumiao. And Dumiao is a digital consumer lending business that leverages on technology and big data to make automated credit decisions. And next to Jing is Kenneth Lin from San Francisco-based Credit Karma. He is the CEO and the co-founder. And Credit Karma is an online personal finance company that provides free credit scores and reports to borrowers. And Credit Karma has been a major disruptor in the consumer finance industry and has served millions of customers around the world. And finally, we have John Sun, co-founder and chief credit officer of Chicago-based Avant. And Avant is an online lending platform that applies algorithms, machine learning protocols, and analytical tools to create tailored loans for individual borrowers. And Avant has served more than 350,000 customers and lent more than $2 billion since 2012. So let me start off the panel with a quote from the co-founder and CEO of online lender Kabbage. So the quote goes along the lines of, "You don't disrupt banks by focusing on the advantages that banks have over you." Most online lenders thought by calling themselves a technology company that essentially it makes you one. So what are your thoughts on this, and how has the part about not focusing on the advantages that banks have over you applied to your company? So I'll get Jing to start off.
Sure. I do agree. Improve over the experience, and therefore they choose us maybe over the other competitors. So I do agree with that comment, which only technology can enable that. And today, if we grow our business 100 times, and our system can handle that. So the speed and the scalability and the efficiency is really drive the cost down, and eventually that help us to actually get more customers.
Okay, so starting off by having the right infrastructure in place.
Absolutely, yes.
And how about you, Kenneth?
Yeah, I think for us, we took a slightly different angle. We focused a lot on building trust and rapport and value with the user. So our perspective is, if you take a look at lending over the last 100 years, from a consumer's perspective, not that much has changed, right? From a banking perspective, there are CDOs, there are a lot of great instruments, there's been a lot of great innovation in terms of what banks have created in terms of the financial instruments. But from a consumer perspective, it's really hard to know what the best loans are. It's terrible to get qualified. It's very opaque as an industry. So we took a different angle, which is I think that those are the areas that consumers are most frustrated with banks. So our perspective is solve those consumer-oriented problems and everything else will come along. And I think in many ways that's why we've been able to build a user base of almost 75 million people, because we focus on the consumer experience rather than the technology now. We are a technology company, but from a consumer's perspective, I think they very much think about us as solving a problem company, right?
Okay, so pretty much focusing on a niche and targeting the weak spots.
Yeah.
Okay, and how about you, John?
Yeah, absolutely. So if you look at Avant, there's two main parts of the Avant business. One is the Avant lender, which is actually the financial company that lends money directly to consumers to try to make it easier and cheaper for people to borrow. And the second half is actually a software as a service kind of lender in a box platform where we actually collaborate with banks. So in both of those, I think we've taken the view that we don't really want to attack the bank's strength directly. So when you're looking at the FinCo lender, one of the biggest bank strengths is their access to cheap capital through deposits. So if you think about a typical consumer, the more prime that consumer is, the more of the total cost of issuing a loan to that consumer comes from the cost of capital, and the less of it comes from cost of kind of underwriting and cost of losses. So in order to not directly compete with banks, we basically stay out of the prime and super prime areas and really focus on using really advanced machine learning algorithms and predictive analytics to predict who's going to perform better out of what we call the near prime population. And on the second half of the business, the actual software platform side, we're actually collaborating with banks in the spaces that we don't plan to compete in. So for example, the prime and super prime customers, to allow the banks to provide kind of a superior product and customer experience to their customers, which they know best.
Okay, so speaking of analytics, and this could be some of a touchy subject for online lenders, but let's talk about the merits of big data. So big data, does it really empower the underbanked, or is it simply just a tool for dressing up lending to subprime groups that banks won't really lend to? So I'll get Kenneth, your thoughts on that.
Sure. So, I mean, I think that big data is the great equalizer, right? So credit is a pretty powerful tool. Credit scores, credit data, credit reporting in the US and I think just about everywhere else in the world where it's a very developed industry. And as a result, you can really rank order well credit risks. I think big data is a good it's a good substitute, right? I think it tends not to be necessarily incremental, but I think when you don't have great credit systems, I think then big data can play a role, and I think that it's the great equalizer. So if you're underbanked, if you are in a situation where you don't have a great credit system, I think big data can be a great equalizer for the people who don't have access. But I think if you have a very sophisticated credit system, then I think it's a little bit more of a fool's errand to think about trying to create something better than credit data through your social network or your China Mobile, accounts. I don't think those really work as well. Well, they don't work as well as credit data. So I think it's pretty powerful, but I also think that people need to recognize where the value is.
And then let's look at the customer base that you're lending to. So personal debt, it's been spiraling and spiraling in many places around the world. Recently in the US, household debt has hit a new time high of $1.2 trillion. So as an online lender, do you feel comfortable still tapping into this pool of potential customers given the amount of the debt that they're already carrying? So I'll get John to answer this one.
Yeah, absolutely. So the kind of increasing household debt is something that's very concerning the U.S. lenders, and as a result, a lot of us, especially kind of us at Avant, have instituted a lot of risk control policies to make sure that we're not overburdening the customers. So there's strict limits on kind of what % of your monthly income can go towards repayments, what % of your monthly income can go towards servicing all debt. But at the same time, that number is also a bit misleading because there was kind of a massive decrease in the amount of household debt following the market crash in 07, 08. And if you look at kind of the growth of that debt back, we're essentially replacing some debt classes with others. So for example, HELOCs and home equity lines of credit used to be a major source of consumer debt, whereas today it no longer is. And a lot of that is because the technology and the kind of servicers behind issuing personal loans have gotten kind of so convenient that they're basically replacing HELOCs as an asset class. So as a result, you do see this kind of net increase in certain debt classes, but they're really just wiping out other debt classes.
Okay, so John, you once said that Avant has focused on, quote, lending niche for customers with tarnished records who are still good risks. So can you please elaborate on that? So, someone pointed out that there's a little bit of a contradiction between customers with tarnished records and who are still good risks.
Right. So I think a lot of that really just depends on how you define good. In the US especially, traditional banks are very hesitant to service any customers that are below what's traditionally known as prime and super prime. So if you look at a typical bank, like a Citibank or HSBC, they're not going to be comfortable issuing even 12, 13% loans, right? So as a result, there is kind of a lack of products for these consumers that maybe have slightly imperfect credit, but also shouldn't be taking out short-term high-cost credit. So what we do is really we incorporate a lot of big data to identify kind of the good actors from the bad actors in terms of the people who are just below this prime segment, right? And the largest part of that is understanding, rather than the banks who look at more of a static view of the customer, more understanding the customer holistically. Are they getting better and passing through this kind of near prime area? Are they getting worse and passing through this near prime area? As well as understanding more deeply the customer's kind of basic economics and cash flows to be able to determine whether we should be lending to this customer or not.
Okay, so there's good bad credit and there's bad credit, pretty much.
Yeah, I mean, I think that's the differentiation that using more data points and big data really allows you to make in the context of using more credit data.
Yeah. So you're able to get deeper insights about an individual. Right. Yeah. So I've got a question for you, Jane. And China, it's a very exciting space for online lending providers, and it's a market that it's enjoying. But at the same time, banks have been digitizing as well, and they've been trying to explore this space at the same time as startups. So what edge has big data given to online lenders like yourself in making smart decisions in lending compared to traditional banks? So what edge do you have over these traditional banks?
As I mentioned earlier, that it's the cost structure. I emphasize that over and over again, is that we can actually offer a lending product as low as 100 RMB. And traditionally in the past, you have to offer a lending product at a certain ticket size to cover the acquisition costs, underwriting costs, operating costs. But because of our entire process is pure digital, so the incremental cost is very minimal. And then we could go out to far rural areas to reach out to customers. And at the same time, our incremental cost doesn't increase. And therefore, we can compete in those we call long tail of customer, both base and also ticket size. And therefore, manage costs in an efficient way that compete with the banks.
Okay, so essentially going around the banks, looking at customers that banks wouldn't traditionally target. So the long tail you mentioned.
Yeah, I wouldn't say that we just target customers that banks don't do because of a credit profile. It's more of a, we go out to reach out to customers that maybe it's geographic too far or the branches doesn't reach them. For example, we work with an offline telecom company. In their stores, we offer walk-in point of sales product real time to their customers without having to have a salesperson going out there. But that data and the information we can collect and process real time and offer customer good experience. But probably the banks will have to send out a salesperson out there, or other competitor have to send a salesperson out there. So the cost structure is different, and therefore we can reach these customers. Okay. So that's how we differentiate ourselves. Today we can offer these type of point of sales products, both online, offline, to both personal to both individuals and SMEs. So it's a pretty wide range, given that we have this big data and AI infrastructure.
So it must require some pretty heavy-duty technological infrastructure. And I just want to ask you a bit more on that one, because so you talked about the huge data warehouse that requires a lot of underlying infrastructure at Dumiao. And is this something that banks won't be able to replicate in any time in the near future? Will you be able to maintain this advantage that you have over banks? Because right now they're starting to turn their attention towards investing more in technology and digitization. And will this competitive advantage that you have be eventually eroded by the efforts that banks are putting into this space?
I never say never, but I think today, we built this up from ground up. Basically, we connect to many, many different data sources real time, and then the information comes in at real time speed. So I think to build that, you require different organization structure, and also 2/3 of our staff are IT or data science. So for now, I think we have a lead on it, but I'm sure if the banks eventually want to come to speed, they can. But just besides the data and the data warehouse, it's also the customer experience itself, the process, the account management, and also risk management. So we build out this end-to-end digital solution for our customers. And also, my group company is called PingTech. We not only offer digital lending, but we also offer wealth management solutions.
Okay.
Also through mobile, digital, and then through big data. So it's hopefully in the future, the customers, when they come as a lending customer, but as they grow in their lifestyle, they'll become wealth management customers
offering
as
portfolio
well.
of services and
Exactly.
all-in-one experience for the customer.
Yeah.
Okay, so we only have 2 minutes left on the panel. So I'd like to get you to take a look into the future and envision what is in it for big data decision making. So will humans become completely obsolete in the process? Will all lending be made by machines? So what do you see in the future for big data and online lending?
Yeah. I mean, I think it has to go that way, right? Because I think that there is too much data. I mean, if you think about the longitudinal data and the fact that banks have had access to this information for so long, they just haven't fully utilized it. And I think that the best decision making is going to be in a sort of a machine learning environment. And that's probably an overused term, but if you just break it down to the basics, underwriting is way better than a person looking at a credit decision or an application. And I think that generally has to be the trend. And that's the big missing piece in internet. So if you look at search, you look at e-commerce, you look at travel, everything is big data oriented except for finance. And I think that's why fintech is in such big demand.
Yes. And any thoughts from you, John?
Yeah, no, I would definitely agree. The kind of one caveat to that is changes in business cycles, because there's been so few instances of it. And one of the problems with big data and machine learning is you really need a lot of data points to be able to figure out exactly what's going to happen the next time. And there's a cycle every 5 to 8 years, and in all of our kind of recorded data, there's probably been 10 cycles. So it's very hard to predict what's going to cause the next one and how consumers are going to behave. So it's still important to for lenders to have not only the automated underwriting, compliance, and really risk controls.
All right, thank you, John. And I'll get to you, Jean, to wrap up for us.
The whole Dumiao and also our PingTech is based on databases and also financial products, and we see ourselves as an enabler of these financial products to both customers and also our business partners. So yeah, definitely, I think this is the trend and it's irreversible.
Great. Well, thank you to our 3 lovely panelists, and thank you for joining us on this panel.
Thank you.
Thank you.
Right.
Thank you, guys. So again, I think that was a fascinating session. Personal experience, Credit Karma. I moved to the US 4 years ago, and it was that service that enabled me to finally realize when I had enough credit to be able to get a mortgage. So a thank you to Kenneth and the team. That's, obviously only one use case in terms of how big data is beginning to help people who are transitioning across the world and being able to change. So hopefully that was an interesting session for you. It's my Great pleasure next to welcome Bobby Lee on stage. The topic is about Bitcoin. And Bobby has been the CEO and co-founder of BTCC from the get-go, so has got the experience of the past, the present, and hopefully the future of Bitcoin. So I'm sure it's be a great session. Please join me in welcoming Bobby to the stage. Thank you.
Thank you. Good afternoon. How's everyone doing? So I'm here to talk about Bitcoin. I'm going to also give away Bitcoins for free after the talk. Who's into that? All right, 50 people, okay? Line up afterwards. So instead of talking about BTCC, our company, I'm going to talk about Bitcoin and tell you why this is such a big deal. This is my third time here back at Rise. Very happy to be in Hong Kong. I'm a Hong Kong citizen. My father was born here. My grandparents actually moved here to Hong Kong in 1949. So who's been here since 1949? So they actually moved here from Shanghai. My grandfather and grandmother, they just brought their luggage and on a ship, and they just came to Hong Kong. And in fact, only thing they had with them was just the luggage and some pieces of gold and silver coins. So why is that important? Because back in the old days, ownership was only about physical possessions. So I'm going to talk about Bitcoin from the perspective of ownership. So you've heard about Bitcoin as a digital currency, but I'm going to tell you why Bitcoin is a big deal, why it's different. From the perspective of ownership, all throughout history, we've owned things by physical possession. And this is what I mean when my grandparents moved to Hong Kong. Their luggage, whatever they had on them, the gold and silver coins, allowing them to start a new family. So whether it's gold coins, jewelry, physical possessions, even today, some things carry on. So the clothes we wear, the eyeglasses you have on, or the cell phones you have, these are owned by physical means. Even the red wine you have in your home cellar. However, the modern day ownership by physical means is no longer possible because when things get larger, whether it's cars, automobiles, whether it's real estate, or intangible things like stocks and bonds, or even money in bank accounts, it's no longer owned by physical means. But rather, the vast majority of what you own is actually owned by identity. What I mean by that is the ownership is conferred to you because your name is recorded as the owner of that property, of that asset class. So think about it. Obviously, your bank accounts are under your name. Your brokerage accounts, your stocks and bonds, investments, your real estate is under your name. Even your cars, if you're fancy enough to own boats and airplanes, those are also registered by your name. In other words, the physical possession is no longer necessary. So the person driving the car is not necessarily the owner of the car. The person living in a unit or a flat is no longer necessarily the owner of the apartment. So in modern society with government and law enforcement, we have ownership by identity. And it's also true for finance. Banking and finance today is all owned by identity. Is that right? That's why we have the concept of identity theft. That's why criminals try to steal your identity to steal your goods and steal your goods and assets. So all of finance, banking is all identity-based. But what's the catch? Not just the, okay, sorry, there's no catch yet, but I'll talk about even digital. In the online digital world, whether it's airline miles, hotel reward points, you have credit cards that give you points, even the gift certificates, all of that is also tied to your identity. Is that right? So if you look at it that way, that's how we look at Bitcoin being very, very new. So what's the catch? Well, it turns out identity-based ownership, which is the vast majority of what you do, is actually always controlled by a third party. Well, think about it. If something's tied to your identity, someone else has to verify your identity. That's why, Bill Gates, Warren Buffett, very rich people, if I show up at Omaha, Nebraska, and I say, my name is Warren Buffett, I want to withdraw $2 million from the bank account, will they let me do it? They probably will not, because I don't have Warren Buffett's passport or driver's license. So identity always has third-party control. And the photo here you see is of Cyprus, Bank of Cyprus. 4 years ago, there was a run on the bank in Cyprus because the government decided that they can actually tap into the bank deposits of the people who had accounts in Cyprus. So if you had euros, over 100,000 euros in Cyprus bank account, they could take a haircut, 20% off of it. And that's why people are lining up, because they want to get their money out of the banking system in Cyprus. So all of a sudden, if you had euros in Cyprus, it was less valuable than euros in Germany, or less valuable than euros in Spain, because in Cyprus they took their money away. So whenever someone else has ownership of your assets, you are not completely the true owner of it. So the point is that identity-based ownership, in that case, you're not the true owner. Think about it. In China, this is where I live in Shanghai, the real estate in China, if any of you own real estate in China, you're subject to the government's control on when and how you can sell the real estate. Buyers are subject to qualifications where they could buy the real estate. So the fact that the real estate is owned by title, you are actually limited in how you can transact in it. And that's true for stocks. Stocks are not traded 24/7 because the stock market is only open Monday to Fridays. That's true for real estate, and that's probably true for cars as well. They might have limitations on when and how you can buy or sell cars. So now, let's talk about money. The money you have in your wallet, you might think that's physical ownership. True. The piece of paper or plastic. Hong Kong has these plastic polyester 10 Hong Kong dollar notes, right? Okay, so it's getting more high tech. But the point is, even the paper notes and the plastic notes you have in your wallet, true, you have physical possession of it. However, the value is what you care about. Am I right? It's not the paper or the plastic that's valuable, but it's the value conferred upon by the note. That is not in physical possession. That's actually by the government. So if you look at it, recently, less than a year ago, in India, last October, the Indian rupee, the 500 1,000 notes got banned. They just got taken out of circulation. And a month later, Venezuela banned the bolivar, the 100 bolivar note. Venezuela banned that. And of course, even recently, even G7 countries, G20 countries, the United Kingdom, the Great Britain, they took the £5 note out of circulation because it went from paper to plastic. So if you're holding on to the old £5 notes, paper notes, sorry, the value's gone. Note is still with you, but the value's gone. So with high inflation, with governments printing unlimited amounts of money, you risk at inflation and devaluing of your currency. And that's true for the Deutschmark, the pre-World War I, World War II German money, as well as Zimbabwe money, which went into the hundreds of billions of trillions of dollars. So let's talk about the future. The future is not ownership by physical possession. The future is not ownership by identity registration. Rather, the future is about ownership by information. And here's what I mean. Can ownership and value truly be digital? That's a question computer science researchers, technologists have been studying for the last 40 years. And it turns out it's not easy. But finally, the breakthrough was with Bitcoin. So Bitcoin was an invention that created the ability for ownership and value to be truly, truly digital. For something tangible and digital to be transferred from one person to another, from one account to another. And that is the creation of digital ownership. So before 2009, there was no true digital ownership. And here's what I mean. Bitcoin was invented in 2009. It was conceived as a white paper in late 2008. And now Bitcoin's been around for 8.5 years. So we're still very, very young. Imagine when you were around 8.5 years into the invention of the internet, or that would be in the 1970s. If you're 8.5 years into the invention of a computer, that would be in the 1950s. If you're 8.5 years into the invention of electricity, we're talking about 100 years ago, more than 100 years ago. So we're still very, very early. So Bitcoin is a new digital asset class. It's a new asset class altogether because ownership of Bitcoin is by information. I'll tell you about that quickly. So first of all, the principles or the factuals of Bitcoin. Okay, these are the features. Limited to 21 million. How many of you know that Bitcoin is only limited to 21 million? Right? How many people are in Hong Kong? There's probably 8-10 million people in Hong Kong. So if everybody, there's not enough to go around. I live in Shanghai. There's like 25 million people. There's not enough Bitcoin to go around for all of Shanghai if you wanted one. So it's very limited. It's also borderless. It's just information. By virtue, information is borderless. No language barriers, no cultural barriers, no gender gaps, nothing. It's purely free-flowing through the whole internet, through the whole world. It's not identity-based. This is the key point. Bitcoin is not identity-based. It doesn't care about who the owner is. There's no tying of Bitcoin address, Bitcoin accounts to a person's real name or person's identity. So therefore, it doesn't care about citizenship. It doesn't care about gender. It doesn't care about age. It doesn't care even if you're human or a pet dog. Your pet dogs and cats can own Bitcoin if you want. And because it's not identity-based, there is no concept of what? Third parties. Because no one's going to judge whether you own the Bitcoin or not. Because with identity-based accounts, whether it's a stock account, a brokerage account, or money in the bank, someone is judging you. Oh, are you the real Bobby Lee? Okay, if so, we'll give you the money. If not, we won't. But with Bitcoin, it's identity-based, it's mathematics, it's cryptography. Finally, it's just information. So Bitcoin is purely just information. I'll give you a very, very specific example, okay? Look at all the ones and zeros. How much money is there? Well, you've never seen a slide that's worth $1 million. What if I tell you there's $1 million behind these numbers of ones and zeros? Okay, there isn't. If there were $1 million, you could steal it. You could take a photo and just download the $1 million and move it somewhere else, right? But we're going to try that, okay? So Bitcoin, here's a Bitcoin address, an account. So on the top left, you see the account number. That's a long account number. It's much longer than all your bank account numbers. In fact, it's alphanumeric. It's got numbers and letters, lowercase and uppercase. That's your Bitcoin account. The QR code represents the account number. And similarly, there's a private key. So for every public key, there's a private key. Again, this is why Bitcoin is just information. So what we have here is a password. This is kind of like the PIN. This is like the 6-digit PIN. For those of you who are taking photographs, you'll notice that this account actually has 200 Hong Kong dollars worth of Bitcoin in it. And by showing it on the slide, you can actually go and retrieve it. Are you ready? Go get it. Really, I'm giving out money as I speak. And I could give out money on the slide. I could give out money by blinking my eyes. I could blink, blink, blink. That's my Morse code from a Bitcoin account that has $2 million. You know, if you could read Morse, you could see my Bitcoin account. So the point is, with Bitcoin, we could pass money by information only. So who's got it? Who's got the money already? Anyone? Technologists? No one here? Okay. So I'm going to move on to the next slide. Okay, don't regret. People ask me to go back. Okay, go back. Here it is. But the point is, this is only 200 Hong Kong dollars. A few months ago, I put in $1,000, and people just took it. You could put in $10,000. You could put in $1 million. In fact, just put it in this account. If you're generous enough, put your Bitcoins on the QR code to the left, and then someone else can grab it by using a QR code on the right side. It's that simple. So no banks are involved. No government is involved. You know, the organizers of this conference don't even know that I just give out money. My wife's probably pissed at me now. But it's only 200 Hong Kong dollars, okay? So let's move on. So the future of money is here. What we're saying is that the future of money is not about governments printing money on pieces of paper, pieces of polyester, minting coins in, you know, nickel or silver or whatever copper coins. The future of value is about digital. It's digital value that can be transacted from person to person by moving information. The information can be moved by SMS. It could be moved by iMessage. It could be moved by WeChat, WhatsApp, Facebook Messenger. It could be moved by Snapchat, where it disappears after 5 seconds, right? It could be moved by PowerPoint slides, where I show you and then not show you. It could be moved by phone calls, where you tell people the message, the private key. You could move $1 million. This is the future. The future is where I can send things far across long distance. I could send you if I live in Shanghai, I could send you a Tesla electric car by making a phone call, because I'm moving the Bitcoins to you, and you could buy your own Tesla with that Bitcoin in Hong Kong, or in Europe or America, wherever. So this is the future of ownership by information. So welcome to the future. Bitcoin is the world's first and foremost digital currency asset. It's a new asset class where information, mathematics, is the key. That's why we say, in crypto we trust. In cryptography we trust. I will trust math more than any government. We thought for Hong Kongers, for Hong Kong people, 20 years now since the British left? Great Britain, great country, but they just canceled their £5 note. Can you believe that? If you held on to those £5 notes, it's gone. One day the US might replace or kill off its $100 note. I think Europe is already killing off its €500 note. So the point is, money is changing, it's revolutionizing, and Bitcoin is here to stay. Thank you very much. So line up, give you some physical Bitcoins. All right, I'm coming off, okay? One line, single line. Okay, we'll go this way, we'll go this way. Okay. Okay. All right, single file, okay? Okay, single file. Okay. Okay, no crowd. No. Sorry, one please, only one. Okay. Okay. Okay, one, just one. Okay. Just one. All right, okay, no, okay. All right, wow, this is a mad crowd. I didn't know people love Bitcoin. Look at that. Okay, hold on. One more. Yes. Okay, we gotta go. Okay, thank you very much. Okay, we're out. All right, buy them on btcc.com. All right.
Okay, there's 1,000 Bitcoins if you sit down. How about that? Okay, thank you. I think if they've got one of those little voting slips, this may well prove to be the most popular session, but I have no idea why. It's, yeah. If you can take your seat after you have your Bitcoins, please, that would be great. We'll crack on. Definitely going into the speaker's notes for next year. The more money you bring, the better crowd you get. Okay, so this session is all about fintech. And what do we see as the vision of fintech at the next stage, sort of the next 2, 3, 4, 5 years out? So we've got a really great panel here for you to discuss this. We've got Ying Ulrich from JP Morgan Chase, based here in Hong Kong. Barry Freeman from Pintech, a Beijing-based startup. And the session is going to be led by Harry Brumpton from Merge Market in New York. So if you'll join me in giving them a very warm welcome to the stage, please. Thank you.
Hi. So for those of you who are watching it on video lately, after this, we just saw a Bitcoin mob, flash mob, if that's proof of anything. So we're lucky to have a pretty great panel here today. Ray wasn't able to make it, but we've got Barry and Jing. And they're both here to kind of look into their crystal balls for us about the future of fintech. I'm going to start with Jing, actually, because I was reading up on you and you got you were called the Oprah Winfrey of finance. So the first question actually is a very serious one. I'm wondering if we should all reach under our seats and see if we've won a free Cadillac or something. But no, the first question, I'm actually going to start with a quotation because, when I'm talking to sources, I cover mergers, acquisitions, and deal making around a variety of spaces in the US. What venture capitalists and private equity folks always talk about is they say the next 10 years are going to be far more radically different than you can ever imagine. But we always think that the next 5 years are going to be not quite as radical as they actually turn out to be. What I want to look at is from the fintech point of view. Why is that change happening so rapidly? Why is what's driving that change in terms of fintech today? Can we start with Yujing?
Well, thank you very much for the introduction. I'm afraid I don't have any free giveaways. They do call me the Oprah Winfrey of the investment world. Maybe perhaps sometimes I appear on TV, but oftentimes I prefer to be in your seat, interviewing others rather than being interviewed.
It's much easier.
So today, even though we have no Bitcoins or anything else to give away, hopefully we can offer the audience here some interesting insights. Yeah,
Bitcoins.
So in terms of fintech and the banking world, I just want to highlight a few interesting trends. I work for JP Morgan Chase, the world's largest financial institution by market capitalization. So I think our market cap is around $350 billion. We are definitely the largest bank in the US. Fintech is really changing the world. But if you look at the relationship between fintech and traditional banks, in fact, the relationship is not just one of competition. I would say the relationship is one of collaboration and cooperation. If you look at the core competencies of banks versus fintech companies, they're very different. Banks have the scale, we have the customers, we have branches, but fintech companies are much more nimble. They are technology driven. They also have a lot of engineers who are always retooling, who are always testing products, retesting products. So I would say we have to recognize, number one, the fintech world is not a zero-sum game. Banks and fintech companies can both have a role to play. So I think banks can utilize fintech companies to strengthen our core banking business, and fintech companies can tap into the banking world because we have existing banking customers. We also have existing scale. So I would say the relationship is actually one of cooperation. And I would think there's competition as well.
Yes.
But eventually, cooperation should triumph.
It is a different dynamic, isn't it, Barry? Because it's, normally what we see in any disruptive play is that you saw it, in the music industry with Napster. The music industry tried to shut that down. Video was VCR, and the Hollywood industry tried to shut that down too. Why is it so different this time around? What are the strategics realizing in this case that the startups have? And we have seen that. It seems to be the consensus that FinTech 2.0 is not about kicking down the door on the big banks. It's about collaborating with them. What can the banks offer?
No, definitely, I fully agree with Jing's concept of the future of fintech and the future of financial technology is at the inflection point of where fintech businesses and traditional financial institutions can create strategic opportunity and strategic value. I think separating out your question from the standpoint of looking at the China market versus the rest of the world, I think taking a unique, looking at the China market specifically, a lot of things are happening there in the China market that are not happening internationally around things like really consumer uptake for fintech products and services. They're much more willing to embrace a fintech startup than in other parts of the world. And most of that's met based upon this concept of unmet need that's applicable in the China market, where traditional financial institutions aren't necessarily serving the consumer population base in the same way that the others are in other parts of the world. So China is a very special situation, but I do think that the trends that are occurring there around mobile penetration rates and the way that all demographics of mobile users, even seniors, are having millennial type activity about how they use their mobile phone to transact. There's certainly a significant difference there in China versus the rest of the world, but I do believe that these China trends will have impact globally as the rest of the world transitions to the same type of online activity that's occurring in the China market today.
You think it'll be picked up internationally as well?
I do. I think there's certain specific trends that will not, but the concept of using your mobile device for your central transaction point with not just financial institutions or financial services and products, but with all types of daily life is a trend that's global. And I think that the fundamental question on this panel, kind of what about 5 years, what's going to happen is, I do think that there is this transition to consumers using their mobile device and getting access to financial services and products in a place different than a traditional bank. But I do believe that the bank itself will be a central part of that transaction going forward. It will just have a little bit of a different role in the future than it does now.
It's a great place to bring you in,
Yeah,
Jing.
that's absolutely right. I agree with Barry. China really is in many ways the global leader in fintech already, notably in 3 areas. Number 1 is payments. Number 2 is online lending. And number 3 is investments. So if you look at payments, actually China really has leapfrogged the rest of the world. Only about 10 years ago, I think China was still very much a cash-based economy, while the people in the West were using their plastic for all their transactions. But in China, of course they have credit cards, but it's not nearly as prevalent. People basically jump from cash to the mobile phone. And 95% of the people in China that go on the internet go on the net actually via their mobile phone. Many people don't own a PC. They just skip the PC age altogether, right? So if you think about the online payments, whether it's Alipay or WeChat Pay, they're incredibly powerful. And the user numbers, of course, are number 1 in the world. So this is one area where I think China is leading. And number 2 is online lending. The point that Barry made, unmet customer needs. Traditional Chinese banks are very large. You know, each of them has 20,000 branches. Postal Savings Bank has 40,000 branches, right? However, a lot of these large banks are not set up to serve smaller customers or entrepreneurs. So there is a large unmet demand need. So therefore, if you think about Alibaba and JD, they do business with hundreds of millions of people in China. They already have the data on what they buy, what they sell, what they own, right? So the next thing they do is to make small loans to these entrepreneurs and small businesses. So that's a natural step.
I actually sat in on a panel in DC a couple of months back, and they had the CEO of Cabbage on the panel, and she was saying, yeah, that's part of the whole dynamic of collaboration driving things is, you know, regular banks, they want that business. It's not that they've been ignoring it because they didn't want to do it. It's that they were ignoring it because that scale is something kind of below them, or it was something they didn't traditionally want to be dedicating resources to. So now that these startups are there, it's not like they're scared of them. It's just that they can realize that there's a lot to be gained, and 2 + 2 can equal 5.
They also have the data, right?
Yes.
So it's very important when you don't have credit scoring systems in China that's in a very sophisticated stage, right? Large banks don't have the data on their customers. These online e-commerce platforms do. So they know what the habits are, they know how much they own, they know how much extra cash they have in the account. So naturally, they can, you know, make lending part of their business. And the other thing that's very interesting is where I think Chinese fintech firms have done very well is investments, right? Again, this is an area of unmet needs. A lot of Chinese consumers for the past many years would put their money in cash. As you know, cash around the world these days doesn't give you much interest at all. In China, the interest rate is 0.25%, no matter how much money you have. And then there's a stock market, which is very volatile. Some people call it a casino. So what's in between, right? People want to have higher returns on their investments and their savings. They have nowhere to go other than putting money in the bank account or the stock market, which is deemed too volatile. So therefore, Alibaba came up with Yuebao, right? So for your e-commerce transactions, you have some extra cash. You put it in Yuebao, then you earn actually much higher interest than what the banks give you.
It was pretty impressive.
Yeah, I mean, over a year, they had 185 million customers. I believe this is still the largest money market fund in the whole world.
What role is, you know, speaking about Alipay, what role is regulation going to play in that? I mean, banks can help get things across the line. And I think that's part of what's at work with the growth in China as well is that, especially with Alipay and Alibaba just generally from the start, has always been about, you know, getting kind of permission post facto for a lot of things, or at least massaging their way through. How is that what's slowing down the US market in some ways and other global markets as well? You know, it's such a new area. How is regulation going to play into the next 5 years? Barry?
I can say that from our standpoint, I mean, if you look at the regulatory situation in China, it's certainly allowed fintech businesses to get to market much more quickly than they would in other markets. There's no doubt about that. The ability to launch products much more quickly, test certain types of products and services, that certainly is a large advantage. I think that the mindset of being open to how financial technology can solve some of the societal issues around inclusive finance have been supported from the central government level, which has given us a huge amount of support to go do new things. Just speaking, giving you a little bit of an example about something in Fintech's business that's quite unique in how kind of how we look out into the future and how things will work. We believe that the financial services transactions will occur not necessarily by financial services businesses, and we are part of our core business model is in facilitating that. So we integrate our technology into non-financial services type businesses and create financial service transactions out of it. For example, we're doing some very significant work with the online travel platforms in China. China Telecom is an example where we're embedding our technology into their offline mobile stores, where you walk into a mobile store, want to buy a phone, you can apply through our mobile app, which the customer sales agent has, and get a real-time decision to get a consumer loan at that store. And that can be done way out in the frontier markets. in places where it would be impossible for a bank to go and set up an offline store.
Social value.
So we really fundamentally believe that these financial services transactions will occur outside of a but in partnership with a bank at the end of the day.
Absolutely.
Yeah.
Well, we're kind of getting close, and I wanted to get you on really one more thing, and it's a bit of a poison chalice, but we are on here where they did ask us to do some crystal ball gazing as well. So there's a lot of other avenues of fintech that we haven't really touched on, I was reading Erin Griffith, the Fortune writer, she had a piece in her column a few weeks ago. Basically, this is her quotes: "Is fintech is out, insurtech is hot, regtech is next." Of all the kind of fintech areas, we've got so many. It's payments, insurance, investments, deposits, blockchain, crypto even. Where do you see the kind of next 5 years? Which ones are hot? Do you agree with that statement about which areas are in and out right now and where the future lies on some of this stuff?
There are many different hot areas. I mean, I just want to use payments as an example because that's an essential part of daily life, right? I would say the payments area is where you have a lot of new innovation happening. I just want to read you some statistics, which is really incredible. JP Morgan every year, I should say, we process through our QuickPay 94 million payments. That sounds like a very big number for the US. But Tencent, the Chinese company, over Chinese New Year, 5 days, they process 46 billion payments. So over 5 days, a lot of that is red packets, people giving gifts to each other, but that's still a payment, right? And basically that means 800 million payments per hour. Visa has a maximum capacity of processing 25,000 payments per second, but Alipay can process 50,000, twice as much per second. So this is one area, I would say payments, right? We cannot live without payments, transactions, right? So this is one area where I think a lot of new technology will be developed to make it faster, more convenient, more efficient for the consumer.
Barry, your thoughts?
Yeah, I think this concept of fintech is out. I definitely don't agree with that. I think it's just getting separated into different verticals that have much more of a micro focus. But I do, if you look at regtech, which is getting a lot of attention at the moment, I fundamentally believe that every fintech business is a regtech business.
Yep.
So I think of the major struggles that we around developing our business model, changing our business model based upon on Chinese regulatory trends. Fundamentally, we're a regtech business, right? We're doing things to create, better KYC, better AML procedures, understanding these types of policy decisions before they happen. So I think any financial business for the next 5 years, any financial services business, whether it's a bank or a fintech startup, is a regtech business because you're constantly trying to generate or create new technology to solve some of these regulatory issues that will always be prevalent.
Absolutely.
I also think in the next 3 to 5 years, the line between traditional banking and fintech companies will be blurring. I think traditional banks have to, in some ways, become fintech companies themselves, right? So if you look at JP Morgan, we spent $9.5 billion per annum in technology. This is one of the reasons why our bank has been so successful for so many years. We never stopped investing in technology. About $3 billion is dedicated towards new initiatives. And we spend about $600 million per year on fintech investments. So we realize the challenges facing a large bank like ours, right? But we cannot stop investing. So we have a 360-degree approach to fintech investing. Sometimes we take equity stakes in them. Sometimes we partner with them without an equity stake. Sometimes we use their engineers. So it's a very holistic approach to fintech. And I think every single large bank needs to do that. Otherwise, we'll be left without business.
Okay, well, that's a really comforting place to end, isn't it? But I think we'll wrap it up there. Thanks for your time, everyone. Appreciate it.
Thank you very much. That was great. Thanks. Okay, you've endured. We're here to the final session of the day. And we've saved, I think, for me, the best topic until last. So it's controversial. Will banks survive, or will banking as a service really take over? So we're going to have a debate here. I don't think there is a right or wrong answer, otherwise it'll be worth far more than those bitcoins that were just handed out in terms of stock advice. But yeah, so at HSBC, we believe probably not one version or the other. We think we'll endure, but we think we need to change to be able to endure. We need to be more open. We need to build our tech stacks in a way that they're flexible enough to be able to work. We need to open our minds and our colleagues' minds to the things that will be best for our customers and finding the right way of bringing those to market. And that will involve us partnering with some fintechs. It will involve us probably buying some. It'll involve us thinking about new businesses. It will also involve us thinking about businesses we don't want to be in. And so that's really, as you saw, the pieces that we've been doing, that's how we're trying to really frame this up. Very open-minded, do what's best for the customer, don't get run over in the process, and everything else. So we've got 3 great people who are going to come back onto stage. So we have Vladislav Solovsky from Life Schrader, Yuha Sun, who you heard from earlier at Avant, and Isabella Jong from Barron's Asia. So please join me in welcoming him for this final stage, and thank you for your attention this afternoon. It's been, I think, a great afternoon with lots of different opinions. I've learned lots of stuff around some of the data things that are going on that I'm going to try and take forward in the next couple of days whilst I'm here. So thank you for being a great audience, and please welcome the speakers on stage for the final session.
Thank you.
All right, thank you. And it's great to see a pretty full house for this very exciting debate. So banking as a service is the only way banks will survive in the digital age. So to the right, we have Vladislav Solovsky, CEO and managing partner of Life Sarita. Life Sarita is one of the first non-corporate fintech-only venture capital funds, and it has made 22 investments in the US, Europe, and Asia. It has made 7 exits. Current holdings include Basis, which is a banking-as-a-service platform in Asia, and Rocketbank, a leading neobank in Russia. And to my left, we have John Sun, who was on the stage earlier, and he is the co-founder and chief credit officer of Chicago-based Avant. And so Avant is an online lending platform that applies algorithms, machine learning protocols, and analytical tools to create tailored loans for individual borrowers. Avant has served more than 350,000 customers and lent more than $2 billion since 2012. So let's get this debate started. And so my first question for you guys is, how much disruption has it really been for banks from banking as a service? And actually, before we go into the debate, I'll get Vladislav to actually tell us a bit more about banking as a service, because it's a fairly new concept that was introduced only a couple of years ago. So to get us familiarized with the concept first, Vladislav will just give us an overview.
Thank you so much for your introduction and the opportunity to talk about this very important topic today here. I think that we have to spend more time to describe about about the role of banking as a service platforms here, especially in Asia. Why? Because right now so many places like Singapore, like Hong Kong, trying to promote themselves as fintech hubs, or Japan just joined this race, South Korea, but in several years, maybe in 1-2 years, we will see that most of the startups will die. And why it will happen? Because to be launched here, I mean across Asia-Pacific region, as fintech company, it's very hard, it's very expensive, and it's very long in terms of time. In comparison with US or UK market, why it's happening here? Because there is no bank-as-a-service platforms here. For example, if you want to launch a fintech company in United States, you already know that you can go to Bancorp or CBW from Kansas or BBVA Compass. They will be happy to host you. They will provide remotely their open APIs to be integrated with their backends directly. Finally, you will be launched in 3 months. You will invest 20% of your resources, human resources and money which you just attracted from your first investors. And after that, if you will decide to scale from US to the UK, it will be the same story. such old players or new players like Solaris Bank or IBAN First or U-Account, they will be happy to provide you open infrastructure, not to reinvent the wheel. In Asia, whole countries still do not provide their open APIs or on government side, like PSD2 regulation in the UK and in Europe. Whole banks still closed in terms of their infrastructure. You have to be connected with them directly. Finally, you have to spend 3 months here to talk with different C-level guys from different departments. After that, even if you will be agreed with them, you will spend 3 months more to talk with their IT director, because IT director will never care about previous agreements. And after that, you will spend 6 months more to build your direct connection with their backend. Finally, you will waste 1 year of your life, and you will waste 80% of your resources to be launched. And even if you will be the king of the hill, if you will be the leader on your domestic market, after that your investors like Web3, they will push you to go to other markets, and it will be nightmare for you because it will be new bank, new C-level guys, new IT director, new IT infrastructure, and everybody here, even such big companies like Alipay, WeChat Pay, they are not successful in terms of scaling. I think that bank as a service, it is an answer for scaling, and scaling it is the biggest question for today for fintech, especially here in Asia-Pacific region.
So essentially, there's an unbundling of the suite of services offered by banks and a redelegation of the different components. And because I was just looking at a well-known model for banking as a service, and it was something that was introduced from you guys actually. So from Chris Skinner, who's part of the live Sarita team, and so it essentially provide so we have I think. Yes, a slide from you up here, which essentially shows banking as a service in a 3-layer model. So would you be able to just quickly tell us a little bit about that to get everyone on the same footing before we go into the debate?
Our vision that you as a bank do not need to compete to build your fintech services inside. Vice versa, you have to work with fintech companies. But fintech cannot exist only in Hong Kong or only in Singapore, only in Japan. Fintech, it is part of digital world. In digital world, you always have to scale. You always have to provide opportunity for your local talents to expand overseas, and vice versa, to invite foreign companies like Avant to come to your market. You can ask John, is it easy to come to Malaysia or to Singapore right now? It's not so easy step to scale, and our vision is to let each bank in each Asia-Pacific country have to be connected with some kind of independent middleware, which consists from open APIs. It is like Esperanto language, and after that, this platform have to give out open APIs for fintech startups, but not only for fintech startups, for telcos, for messengers, for e-commerce giants. And it will be the same effect, like same result like Amazon Web Services showing right now. In 2012, it was the same hype around e-commerce industry, like right now it's happening around fintech. Several giants told at that time that infrastructure, it is our competitive advantage. Jeff Bezos from Amazon answered, come on guys, you are stupid. Infrastructure will never be a competitive advantage. And he started to lease his infrastructure for new players, even for his direct competitors. And right now, 67% of profit of Amazon belongs to Amazon Web Services. The same story here. Banks already invested thousands or hundreds of millions into their licenses, processing centers, card issuing centers, compliance services, and they can continue to fight with the future with fintech startups, or they can be opened for them, and they can use this leverage of third-party providers, not only across their countries, but across the world.
Okay, great. Thank you for that, Václav. So, John, what is the fintech perspective on all of this?
Yeah, absolutely. And I kind of find myself somehow on the other side of this debate, which is kind of interesting for fintech. But just to give you guys some background, Avant has two main lines of business. So we're a lender that's in a way going to benefit from kind of this banking as a service trend, and really already do, because we utilize banks for a number of kind of outsourced functions like bank level regulatory compliance through web bank. We use our merchant bank and ACH capabilities to be able to kind of issue loans and collect payments. And certainly we're well integrated into kind of this banking as a service ecosystem. But on the other hand, we're also a technology provider to banks, right? So from that perspective, in the equation, we're not so much using a bank as a kind of banking as a service relationship, whereas we're more of a software as a service provider to the banks, right? And I think the delineation on that and what's going to drive which relationship ultimately prevails is really in the bargaining power in the relationship. And I think Vladislav has made some really good points on why fintechs would love a world where banks operate all as regulated utilities in banking as a service type relationships. But I think the real question is, do they want to, and more importantly, do they need to survive? And personally, we just don't really see that as a necessity in the near future, and here's why. Banks today are pretty good at serving customers that they want to service, which is the prime and super prime consumers. It will be very difficult to dislodge those particular customers from banks today. Banks have a natural advantage in that they have extremely low cost of capital from deposits. As a result, they're able to service these customers with products that fintechs can't really compete on. In order to compete in these markets, we essentially provide software as a service relationships to banks to allow them to use our software instead of the other way around. So that's the first thing. The second thing is banks have a lot of different lines of business. So if you look around, basically all of the fintech startups are focused on what we call kind of retail and consumer banking, which is basically a third of a global bank's real business. So in addition to that, there's kind of wholesale operations, lending, money management, that's another third. And then there's global banking and capital markets, and that's another third, right? And there's really nothing on the horizon that's going to cause massive disruption to the bottom two-thirds of the iceberg, if you will. If you think of kind of retail banking as the most exposed part, and everyone's kind of attacking that particular area, there's all of this stuff below the waterline that is going to be extremely difficult to disrupt. A data point there, so I don't know if you guys recall, recently HSBC had gotten in some trouble over some failed AML, anti-money laundering procedures that resulted in like $230 million worth of accounts that shouldn't have been opened, and they basically got a slap on the wrist for it. And to us, that sounds like a lot of money, $230 million of accounts that shouldn't have been opened. But the reason for that was $230 million out of $87 trillion worth of business they were doing, right? So it's a very, very small portion of the overall business. And even if you look at retail, banks have been surprisingly resilient. They've changed substantially over the last 30 years. They've kind of adapted to the market. If you look at the evolution of products that banks are able to offer, so back in 1970s, they introduced credit cards. In 1983, Household created this concept of a home equity line of credit. In the last 5 years, you kind of have same-day ACH. So banks are continuing to evolve their product suite. And we think in the future, how they're going to continue evolving their product suite is by partnering with technology firms like Avant to basically bring some of that tech in-house while still maintaining their advantages over the prime consumers.
Great, thank you, John. So, Vladislav, are banks evolving enough? Or do they have to adapt to meet this model?
I think that right now, I just want to add to John that Avant and other companies, their advantage is not only in terms of technology. Their advantage in terms, to my mind, in terms of relationships. They're much better than traditional banks how to serve their customers better. I think it's very important because sometimes banks thinking about fintech companies on new technologies, fintech technologies, like how to save our money, how to make our expenses less than year before. But it's not true, because fintech, it is about new user experience, how to provide more services just rather than just financial services for your customers, how to, like, for example, with personal financial management tools. Is it about accounting? No, it's about how to set up your short-term, long-term goals, how to choose different financial, and not only financial, because education it is also some kind of tools to achieve some aims in your future. I think that right now banks are not so active. They're trying to compete with the future. They're trying to protect their role on the market. But it's very interesting. We came to Singapore 2 years ago. When we asked leading local banks, are you afraid about fintechs? They answered no. Right now, if you will ask them, are you afraid about fintech companies? Still no, but we're afraid about Alipay and WeChat Pay. Because valuation of Alipay higher than the biggest bank in Singapore. They can buy any bank in Singapore and they will have a lot of money for rainy day. And this is example how you, if you will be not fast enough, smart enough, open enough for new technologies, you can lose your role. And once again, bank as a service, it's not about how to make from your bank commodity bank. It's about how John just explained, it's about how to originate for them new revenue streams, but also give them opportunity to think about new businesses, because for sure banks, they provide some value for market and for customers, but they do not need to do everything.
Okay.
Fintechs, they're providing opportunity to pick up different cutting-edge solutions and to create bundles based on your platform, bank as a service platform.
Great. So, but let's look at the middle layer. So, the middleware, bank as a service, that layer. So, so that is essentially made up of application programming interfaces. And so these application programming interfaces, how much value is it adding to this entire chain? You could have like a model where you had standalone banks, standalone fintech companies that would oversee the entire chain of services. But here you have fintechs on one end, you have banks on the other end, and you have this middle layer. So application programming interfaces. And these things are essentially like the engines that you use to find hotel rates, to find airfare. So engines that help you to find the best deal out there. So in the banking space, how much value is this actually creating?
We have to talk about value for both sides. I mean, for fintechs, for example, if you want to launch your neobank or challenger bank in your country, you do not need to apply for your banking license. You do not need to create your processing center, card issuing center. You just have to think about how to attract customers and how to talk with them. What kind of services you want to add more than just commodity services. If you will use bank as a service platform via open APIs, it's so easy like to create new Facebook page. I mean, you just have to copy paste some lines of code into your app. That's done. You already integrate. For sure, you have to proceed with several compliance processes, but it's much easier than to create one new bank once again. But even if you will create one more traditional bank, how you will differentiate it? There is no difference between one bank and another bank. And for banks, it's opportunity not to work only with fintech companies inside your country. It is opportunity to be opened for any fintech company across the world. Second one, there is no bank today in Asia which is able to cover a whole region. Fintech, they're looking for how to be launched across whole region. And if your bank will be integrated with some bank as a service platforms, you will not need to compete with other traditional bank in your country. You can scale as a bank to other countries too.
Okay. And so, John, what are your thoughts on that?
I mean, I think the theory behind them is great. I think if you look at the reality in at least the US and UK today, they're basically adding zero value. There's not really an open standard for data sharing between banks and fintechs and consumers. If you look at the most common way of acquiring banking data in the US, is still through services like Plaid and Yodlee, which essentially goes out and scrapes data from the bank's websites and maybe has integration with some of the top banks on a ad hoc, very specific relationship basis. In the UK, there's famously kind of this new open banking regulation that forces banks to some level of compliance with the open API standard that forces them to essentially expose some amount of data that's kind of accessible through certain APIs, and then gives them the option, if they want, of introducing kind of a paid level service, which exposes more data, right? So I think it's going to be interesting to see what banks choose to do in terms of compliance, because if they really just do the bare minimum, it's really not going to add much value. But it is certainly a test. If banks are willing to go above and beyond and really create this ecosystem of data sharing, then it's certainly going to kind of create a lot of new advantages for fintechs. I think one of the challenges there is what incentive does the bank really have to expose all of their data to fintechs that are then going to kind of take that data and monetize it and use it to compete with the banks, right? So my personal thoughts is I think there's going to be some banks around the edges, especially the challengers, that are going to comply kind of fully and really roll out a whole suite of products and really become the banking as a service go-to banks, similar to kind of BankBox in the US or a similar type of product. But on the other hand, the mainstream banks are going to be more protective of their data, do less to comply, and really maintain their competitive advantage by essentially not complying.
Okay, so let's go back to the subject of this debate. And banking as a service is the only way banks will survive in the digital age. Yes or no? If no, what is an alternative model that you see stemming out of the relationship between fintechs, banks, and the whole ecosystem out there? And so a case in point would be that of Solaris Bank, which is a middleware provider, but at the same time also has a license to operate as a regulated bank. So I will get John to start off. And so a 1-minute summary, please, and then I'll get Vladislav to finish off.
So I think banking as a service will become a new business line for the banks in a certain way, and there's going to be basically niche middle market banks that are going to focus on it as a primary service line for those particular banks. Similar to how there's industrial banks today, there's commercial banks today, there's going to be a class of banks geared towards enabling fintechs, and I very much think that's going to happen. But the retail of the bank of 2017 has been very different from the retail bank of 2000, and it's going to look very different again in 10 years. But that doesn't mean that all of them are going to migrate towards these back-end kind of banking as a service type models, where the fintechs operate the consumer-facing elements of the front end, and the banks just provide almost as a regulated utility services. I think banks are going to continue to evolve, and they're going to continue to partner with technology providers like Avant to bring a lot of these capabilities in-house. And at the end of the day, they'll evolve, but they'll survive.
All right, thank you, John. Vladislav.
I think that banks have to look once again on Chinese market. In China, traditional banks already lost their competition with new players. And they have to find their role in new ecosystem, in new landscape through these bank-as-a-service platforms. Why? First of all, they are not able to create whole possible fintech services by themselves. Second one, even if they will provide their own open APIs, as John just mentioned, it will be not a standard. Because it will be one more APIs from one more provider on the market, limited only by your own domestic market. What is the value of this open APIs? It will be that solution. Value of this middleware lies in terms of common agreement, how to connect different countries with different regulations with new players. And I think that yes, especially in short term, if we will not solve this problem of infrastructure, lack of infrastructure, especially here in Asia-Pacific region, we will see that most of fintech startups here, they will die. And banks also, they will lose their role in the market, not in competition with new small players, but with big giants from China or from US.
All right, wonderful. Thank you, Vladislav. So that brings us to the end of the debate. So please give a round of applause to our two debaters. And banking as a service, I'll leave that to the audience to ponder whether it will be the only model for banks to survive in the future. So keep an eye on that space. Thank you.
Thank you.
Hi, everyone. I'm Janet Yun. I'm the head of business model innovation for HSBC. We just want to say thank you so much for joining us here today at MoneyConf. It's been a real pleasure to have this dialogue with you. As we embrace the changes in our industry, we really need to look and evolve our way of thinking. And at HSBC, that's really been about adopting a startup mentality, finding talent that can affect change at a global scale. And so for us, really, this dialogue is about really opening it up. And we really thank MoneyConf for having us here. We thank you so much for bringing us all together and having this dialogue together with us. So with that, I will conclude MoneyConf with a reminder that actually we'll be back up here on stage at 10:15 tomorrow morning for PandaConf. Don't forget Night Summit. Check your app for all the events that are on, and see you again tomorrow. Thank you very much.